Good morning, guys. Any response? No? Okay, good afternoon. I stand corrected. For me, morning, afternoon, all this is when I wake up. So it's just been a short while, so it's morning for me still. Good afternoon. I okay. Audio video, good. All right. Great. 1 second. Okay, so who's coming on video? I'm waiting for people to log in on video. This the usual suspects. No compulsion that it has to be them, but someone. Otherwise, it will feel like I'm just talking alone. So Sri Lakshmi has connected. It will be too much pressure on her to stay connected if it's only her. Someone else. So someone give her company when she makes mistakes to questions that I ask. Okay, Jawahar is here. All right. Okay, so we'll continue from the last class that we took. The last class that we had. Yeah. So NPA. No issues, Archana. When you can, you try connecting. Someone else, if you want to connect on video, you can. It's just a couple of people. I'm okay with even 4, 5, or 6 people. So you can come if you wish to. Okay, so what we have done so far is we have started introducing the concept called as non-performing asset. I introduced the concept of non-performing asset. I explained what is asset liability. I explained the concept of non-performing asset to you. Then I also went ahead and explained you the various classifications of non-performing assets. What is a standard asset which is not a non-performing asset? Once it becomes a non-performing asset, what is it called as initially? So first being called as a substandard asset, subsequently it is called as a doubtful asset and loss asset, and ultimately it is written off. So that is the phase with which we stop the discussion. Okay, that is where we stop the discussion in the last class. We are under the broader topic called as banking. I hope you remember that. So inside banking, we looked at the chronology of banking. How has banking evolved in India since say 1800s, 1806 to 1991? We saw Narasimhan Committee recommendations and all those. And after that, we said we'll take a look at NPA. What is the whole issue behind NPA and everything that we are going to learn in this chapter called as banking, where maybe about an hour and a half no, of topic is left, which is why I have taken half an hour extra today. The class will run till 8 o'clock. If you have checked the timing, the class timing is given as 2 to 8. So it will run till 8 o'clock. And tomorrow I am taking that 1 hour extra. So 1 to 4:30 is the class tomorrow. So that 1.5 hours will help me complete banking. And then 2 sessions for external sector, 1 session for financial market. So that is the idea behind the extra 1.5 hours that is scheduled today and tomorrow cumulatively. With that, we should be done with the core economics topics. So now we'll get to the topics under discussion here. So we looked at this problem called as non-performing assets. Okay, or NPA. If you look at it, this is a problem from one perspective alone. So there are two parties involved in this process. There is one party who's taking a loan and the one party who's giving that loan. So that is the two party, the borrower and the lender. Non-performing asset is this particular issue of being unable to repay purely from the perspective of the lender. So that is one dimension of it. That is one side of it. Similarly, there is another side to it, the side of the borrower. Now, it does not, you cannot always say that the borrower is the one who's at fault for not paying. In this particular transaction, maybe. But what happens to the borrower after that? What are the issues that the borrower is facing? There is another perspective to the same issue from the perspective of the borrowers. That is what we are going to look at next. So, initially, the borrower borrows money, tries to invest in a business, but for some reason, the business has not succeeded. When the economy itself is slow, there is a good likelihood that some businesses or a lot of businesses could fail. When that happens, this borrower is not in a position to repay the loan. Okay, so that is the idea behind the or the situation that the borrower is facing. Okay, so in this situation, what is the trouble that the borrower is facing beyond the fact that they are not able to repay? Now, the borrower has borrowed money, not able to repay. We know that whenever we borrow money, there is always a chance that the bank would ask, if I have to lend you some money, you have to give me some sort of a security, some sort of a guarantee. That, see, for example, if you are borrowing money to build a house, the house itself would be in the hands of the bank till we repay. So that is called as mortgaging of a house. So if you are not able to repay the loan, the bank would come and take over the house. So that is the idea behind that. Similarly, if you own a car, if you buy a car using a loan, and if you are not able to repay the loan, the bank would come and take over the car and they would have ownership over it. That is called as hypothecation. All these are different names for the concept of mortgage itself, okay, or guaranteeing itself. Similarly, you might want to borrow some money for which you will give your land as the mortgage, which they can seize if we fail to repay. For a business person, what is it that they mortgage? A lot of businesses mortgage their business itself to the bank. They say, if I am not able to repay, you can take control over my business and all the assets related to the business. You cannot come and touch my personal assets, but you can take anything related to my business, because it is not me as an individual who's borrowing. It is this business which is borrowing. Me as an entrepreneur who's borrowing. You remember right from the first topic, we have been distinguishing, there is business, there is household. The business person, entrepreneur, is actually from the household, but the business is existing as a separate entity. The business will have its own accounts. The business will directly pay the tax called as corporate profit tax. The business will keep some money with itself called as undistributed profits. All that we saw. So business is an entity in itself which has its own assets. So the business person says, I am borrowing money. When I say me, I am not the household. Me as a business, I'm borrowing money. So when I am not able to repay, you can take over all the assets that this business owns, whatever is required to repay the money to you. So what does the bank do now? When the business fails to repay, the bank goes and seizes the asset, seizes the company of the business person. Now, the business person is now in a bit of trouble. The business person feels, for me to repay the loan, I need ownership over my business. I need to run my business. Only when I run my business, even though I am not making profit now, I can run my business, make a profit and give back the loan. If you take over my business, how will I be able to run it and give back your money? So one, the bank takes over the business. Second, the bank files a case against the business, against the owner of the business, saying that you borrowed money and you're not able to repay. I'm going to take you to court. And once it goes to court, for years and years, for 5 years, for 10 years, they are stuck in the same place. So what happens to a businessman who's not able to repay a loan, who has an NPA? The person is stuck there forever, is not able to do that business, is not able to leave that business and go to something else, because there is always a case pending against the person. So that is what, from their perspective, is called as an exit challenge. In a very, very fancy way, okay, in a very, very fancy way, this exit challenge was also called by the economic survey as the Chakravyuha challenge. Because of the whole idea of, in Mahabharata, we have a Chakravyuha in which no one can even enter. It is too difficult a maze to even enter. One person, Abhimanyu, knows how to enter because he half heard it when he was in the womb of his mother, but did not hear how to, probably I think his mother slept off or something of that sort, did not hear how to get out of it. So that is the challenge that we are talking about. Prior to 1991, India was a maze. India was a Chakravyuha where one could not even enter, a business could not even enter. But post liberalization, okay, post the easing of rules, a business could enter now. But the challenge that they are facing is they are not able to exit. They are not able to, when their business is failing, they are not able to shut down their business and leave. They are stuck in that loop forever. So that is the exit challenge. That is from the perspective of the business. Okay, a couple of people have said last class I told you how I'll discuss how India got into the NPA crisis. Yes, thank you for reminding me. One Sri Lakshmi and the other no name. I will discuss that. I remember that as well. So actually no, I didn't remember that. I asked you to remind me, but that will be the next topic. We'll finish this and I'll get to that. Okay. So there is the exit challenge, non-performing asset exit challenge. This is from the bank's perspective, which is the lender. So this is the lender's perspective. This is the borrower's perspective. Now, when the RBI or we as neutral people are looking at this, what we are seeing is an issue. We are seeing that there is a bank, there is a business. The bank is facing some trouble. Where is it facing its trouble in? The bank is facing its trouble in the balance sheet. What is the balance sheet of a bank? Every organization, even households which are run with proper, in a systematic manner, there will be someone in the household, one of the parents, who will maintain some sort of an account book where they say, how much did we receive in the beginning of the month? How much did we spend during the course of the month? The incoming money, the outgoing money. At the end of the month, it has to tally. We should not have spent more than what we have earned in the month. Why? It would mean that we have dipped into past savings. Money we had saved from the past, maybe we have used that up. It is not correct, which means we have less savings after that. Or we have some money left over, which is also not necessarily good because we have compromised or we have not spent where we should have spent. Maybe we forgot to pay the electricity bill or we forgot to pay some other bill. We expected a certain expenditure that has not happened. We have to understand why that is happening. There has to be a balance with respect to expected income and expected expenditure. There has to be a balance there. All right. So when that balance is missing, we say that the balance sheet, the sheet in which this balancing accounting is done, is what is called as a balance sheet. All businesses maintain a balance sheet. Okay. When this balance sheet is in trouble, that is an issue. That is what we observe. The bank's balance sheet is in trouble. Why? Because the bank took some deposits from the people, gave a loan, balanced out. They are expecting that the money will come back in so that they can give back the deposits. They have to give back the deposits. They cannot say, oh, I haven't received the money yet, I'll give it to you after I receive. No, the bank is bound to give back the deposits. So it will go out, but it is not receiving the money that it is supposed to receive from the people. So there is an imbalance that is created over there. Similarly, from the business's perspective, what is happening? They receive the money from the bank, all right? They spend it on some infrastructure or some activities, fine, balanced. Receipts, expenditures. But they expected some money to come back from there and they had to pay the bank. They are not receiving the money, but they are due to pay. So there is an imbalance here also. So two balance sheets are simultaneously in trouble. This is what we call in the economy as a twin balance sheet syndrome. Now, this was an issue once again mentioned in one of the economic surveys. I think 2016 or 17. There was, I think it was our chief economic advisor, whose name is Arvind Subramaniam, who suggested this concept of twin balance sheet syndrome. That is not important. Arvind Subramaniam is not the important name. Why am I mentioning his name? Because very recently, he even made another declaration saying that, or another claim saying that India is not suffering from twin balance sheet syndrome anymore. India is suffering from four balance sheet syndrome. Four balance sheet syndrome. So that is the current affairs. Now, what is the four balance sheet? He has divided both the sides into further two. Initially, it was banks, and on this side were the infrastructure companies. So they only considered the infrastructure businesses which were to be in this sort of trouble. Most of the NPAs are contributed by infrastructure companies. So banks and infrastructure companies. Now the problem has become bigger. It is, in addition to banks, non-banking financial companies are also in some sort of trouble. They are also in the NPA crisis. Similarly, in addition to infrastructure companies, real estate companies are also in trouble. So 2 balance sheets here, 2 balance sheets here, 4 balance sheet syndrome. Bank, non-banking financial companies, infrastructure companies, and real estate companies. So 4 balance sheet syndrome is the more recent current affairs from a general perspective. All right. Now we'll get to the eagerly awaited topic of how India got into trouble. Everyone wants to know why we are in trouble. See, India's NPA crisis can itself be divided into 2 phases. Okay, one is the phase prior to 2003, and another is the phase post 2008. What is the gap in between here? 2003 to 8 in India is called as the boom phase of Indian economy. Period. This is the 5-year period during which we saw unprecedented levels of growth. Okay. India's GDP grew at levels which we had never seen before. 10% growth, real GDP growth was attained. I have told you what is real GDP while doing the inflation topic. Real GDP growth, inflation adjusted GDP growth of 10% was achieved during those years, during that 2003 to 8 period. So that was unprecedented levels of growth. So what happened was, prior to 2003, we have already seen the various issues in the banking system. A lot of loans given, the government strictly controlling it, a lot of loans which were not getting repaid, there were no proper accounting mechanisms, there were no proper classification mechanisms. All the criticisms that Narasimhan committee had suggested, said we need to overcome those things. They were only gradually becoming, we were trying to overcome that. Plus, India became suddenly a liberalized economy, so loans were available at much cheaper rates. A lot of loans were given without due consideration. Okay, so all those were the issues that were there. I told you about, while learning inflation, I told you about that benchmark prime lending rate, and all those, right? So that is in the context that a lot of loans were given without due consideration. That led to some level of non-performing asset prior to 2003. During this, there was an act introduced called as SARFAESI. I'll tell you about it together along with the other resolution mechanisms. An act was introduced to overcome the NPA crisis in 2002. But I'll talk about it together. After this, I'll talk about it. Okay, I will explain that in greater detail. But what happened was that while India was thinking that, oh, we are in an NPA crisis, we need to overcome it, we saw sudden growth during this period. 2003 to 8 saw unprecedented levels of growth, which meant that the old NPA issue sort of got dwarfed. It did not matter anymore because the size of the economy was expanding so rapidly that the earlier crisis was just swept under the carpet. No one really bothered much about it during this period of growth. Okay. However, what happened was that towards the end of this, not towards the end, why did it end at 2008? In 2008, because during the period of 2007 to 9, there was something called as the global financial crisis. There was a global financial crisis. The entire world went into some sort of a financial crisis. But the fact is that it's not the entire world, it's United States of America which went into a crisis. Every country which was dependent on United States of America, the European countries, even a country like India, whose service sector was predominantly dependent on the American economy, money flow was significantly affected. So when America got affected, it became a world financial crisis or global financial crisis. Okay, during that period, we are not going to go into the depth of what led to that financial crisis. That is not the subject matter of this class. If you are interested, we can discuss that beyond class hours. Okay, or if you want to drop a mail to me, you can. I'll suggest some articles for reading up for you if you are keen on knowing what it is, or you can just simply Google and get to know about it. But the point here is that because of the global financial crisis, Indian economy started slowing down with respect to its growth. Okay, and whenever there is a slowdown, consider this: the banks would give a loan not for 1 year or 2 year. Banks would give, or any other entity which gives a loan, normally for businesses, the loans are normally spread over a longer period of time, 3 years, especially for infrastructure projects. Infrastructure projects don't get over in 1 year or 2 years. You know how much time it takes to build a flyover in our area. 3 years, because of the delays that are there in the government, 5 years, 7 years. Sometimes there are bridges which are being built for 20 years and it is not done. If you are from Chennai, there is a bridge which they are trying to build in Velachery. I don't know for how many years they have been building that particular flyover, not a bridge, a flyover. From the time I remember being in Velachery, I've seen that that flyover is under construction. It is still under construction. That is the pace at which a lot of infrastructure activities happen. Okay, people from Bangalore, you would know how long roads would have been blocked for that metro rail first phase to be completed at least. So there is always the infrastructure generally takes a longer period of time. If there are some delays associated with government clearance and all those, it becomes even more. Okay, so a lot of loans given during this period, especially for infrastructure projects, they were long-term loans. And when the situation got into global crisis happened, the projects became even slower, which means that they were not able to meet their deadline. They were not able to get their products at the raw materials at the expected price. All that resulted in the infrastructure companies predominantly not being able to repay their loan in the correct time to the banks. Okay, now that is what we think. This is not an established fact at this point of time. There was a slowdown, so we expect that these companies would be finding it difficult to pay back. That is what we would expect. But interestingly, in India, 2008 to 2014, close to 6 years, we did not have an NPA crisis. We did not have an NPA crisis. There was no, on the record, there was nothing which suggested that the companies are struggling to repay the loan, nothing of that sort. Now, everyone wondered what happened. How come? Okay. Everyone wondered. The global economy started wondering, how come India is not having an NPA crisis? India is supposed to have, because logic says India should have an NPA crisis. Okay. Economists within India, like Raghuram Rajan, questioned, saying, how is it that India is not having an NPA crisis? We should be having. Right? He was the chief economic advisor. We thought he thought there should be an NPA crisis. Logic suggests that when America has gone through such situations, they have had NPA. Canada has had, Australia has had, Japan has had, China is still having NPA crisis. How come India alone is not having? Meanwhile, there were some other economists who were like, you know what, India is the greatest economy in the world. India is like a never seen before economy. Even in spite of the crisis, there is no NPA. Look at the resolve of India. Look at the governance of India. All the politicians and some economists who chose to believe it, they were like, India is an exceptional economy. We are breaking all barriers. We are breaking all rules. We are making our own economics. All that statement they made. But some people did not believe in all these things. So in 2014, when 2013 or so, when Raghuram Rajan was appointed as the governor of RBI, Raghuram Rajan said, let me try to find out if actually there is no problem in India. So in 2014, the RBI under Raghuram Rajan asked the banks to do something called as an asset quality review. Okay, it is more like an auditing process where the RBI said, I want all you banks to come and submit to me about all the assets that you have in your accounts. Okay, I want you to show me the assets. The assets is the loans that you have given, a report of the various assets that you have given. And when the Reserve Bank of India started observing these assets, the reports of the assets, they found some unique patterns. They found that for certain businesses, the bank is giving loans 2 times. They gave a loan once, and before even the completion of that loan, they have given another loan. Now, this raised a bit of a question, and on further investigation is what they found out. They found out that these organizations, these businesses were actually not able to repay their loan. post 2008, they were not in a position to repay their loan. The norms said if in 3 months, if they don't repay, it will become an NPA. So what the bank manager would do is they'll wait for a month, they'll wait for the second month. When they'll go to the business and ask, will you be able to repay? Business says, I don't think it is a possibility right now, maybe sometime in the future. So the bank manager will say, okay, if that is the case, I'll do something. I'll give you another loan, but this time you don't use the loan for any business activity. Use this loan to repay your first loan. So on record, you don't have an NPA. You are repaying your old loan. And I will write the second loan in such a way that you don't have repayment in the near future. Okay, you'll only have repayment after a period of time. You know about education loan, right? They start giving you loan from the first year of college. It's after you finish your college and one more year time is given. After that is what you have to start repaying. Similarly, they would give a loan for a longer duration, which you have to start repaying after a period of time. Now use this principal amount to repay your old loan. Meanwhile, you can recover your business and you can probably start repaying. Fair idea. A business can do all these strategies, but the problem is it is not the money of the business of the bank itself to do this. It is the public's money with which the bank was doing all these things. RBI said this is clear manipulation. You are hiding the NPAs that are existing in the economy. You are attempting something called as evergreening of loans. Evergreening of loans were done to hide NPAs in the economy. So what is evergreen? What are evergreen forests? Evergreen forests are not forests where the trees never shed their leaves. All trees shed their leaves. Evergreen forests are forests where some trees shed their leaves during a particular month, other trees shed their leaves a few months later. Other trees shed their leaves a few months later, so that at any given point of time, it looks like the forest is full of trees which have leaves. That is what evergreen forests are. Very similarly, evergreening of loans is, it looks like there is no NPA. In reality, that is not the case. When it is about to be an NPA, you give another loan and start repaying it. When that becomes in trouble, you give another loan. So that is the concept of evergreening of loans. Evergreening of loans was done to hide NPAs. As you would probably have heard, the first step in rectifying a problem is to identify that there exists a problem. Accepting that there exists a problem. So this asset quality review led to identification of the NPA problem. Okay, the realization of the NPA problem, the acceptance that yes, indeed, we are not some great glorious exception to the world. We are not coming up with any new economic theories within India. That is not the case. We do have NPA just like everyone expected us to have. Just that we were our Indian banks were very, very smart or manipulative to hide it from the system. Okay. So that is what happened in 2014 asset quality review. The extent of India's NPA started coming out. Okay. We are in 2021 now. Even today, India's NPA problem is not solved. We have tried various different measures to overcome the NPA crisis over the years. We have not been very successful, but we have had reasonable levels of success. So what are the measures taken by the government and the RBI to overcome the NPA crisis is what we are going to look at next. That is the last major part of the topic called as banking. Then we have some peripheral topics as well. But last major topic under this heading is resolution mechanisms to counter NPA problem in India. So that is what we will start looking at after this. Okay. All right, Gobi Jagan has a question. Yes, Gobi, please ask me. So if you have questions, don't say one query, ask it. If it's relevant, I'll answer it then and there, or I'll answer it later. No, raised hand, Jagan, I'll take it at 4:30. Just type it in right now, because then we'll be spending a lot of time taking questions in between. I'll not be taking audio questions right now. I'll do it at the end of the session. 4:30, I'll do that. So if it is compulsorily something that you have to answer on, I have to answer on audio, wait till 4:30. Okay. So coming to mechanisms to resolve NPS. Number one, we will start with the early NPA resolution mechanism, which is relevant even today. So something called as the SARFAESI Act of 2002. SARFAESI Act of 2002. So when I expand the term SARFAESI, each of this stands for something. The name, the length might suggest that it is very difficult, but once I write it, you will realize that it's actually very, very simple. The expansion of this is very, very simple. Now take a look at it. It stands for securitization and reconstruction of financial assets and enforcement of Security Interest Act of 2002. See, I told you it is not very difficult. It's very simple to understand. It is self-explanatory as well, right? Is there something that I need to explain here? No response. Does it mean that you don't understand anything? Still no response. All right. So if you think this is a little complicated, if you actually think this is easy, then I don't need to teach you economics at all. So the key word here, that is what is the differentiating factor. There is a key word here. Once you understand that, it is very simple. The phrase financial assets. So if you understand, it is something about the financial assets. You're trying to securitize the financial assets. So securitization of financial assets, reconstruction of financial assets, enforcement of the security. The securitization that we did, enforcement of that security. That is all that is happening over here. 3 activities. Okay, in this act, 3 activities. Now imagine you are going to a bank to take a loan. The name is what I'm explaining right now. What is this name? Is what I'm explaining right now. You are going to take a loan from a bank. Now think from a bank's perspective. Think from a bank's perspective. Let's say you are the bank now. Someone is coming to you to take a loan. Someone says, I want 10 lakh rupees. You ask, for what do you want? They say, I'm going to build a house. Okay. So we ask a question. What is the guarantee that you will give me back the money? What is the guarantee that you will give me back the money? So he says, I don't know what guarantee to give you. I don't have anything else. So you say, you are going to build it on a land and you are going to build a house. So as a bank, you say, give me ownership of that house till you repay the loan. Once you repay, I won't come and take away the house. Don't worry. I'll not come and claim that the house is mine. If you keep paying the loan properly, if you fail to repay the loan, I will take over both the land and the house. That will belong to me. So that is the understanding. So there you are creating a security. The bank is creating a security for the loan, the money that they are giving. When they are giving 10 lakh rupees or 50 lakh rupees or whatever be the amount for building that house, 50 lakh rupees, let's say. I wonder why would 50 lakh rupees be required. But anyway, 50 lakh rupees, the bank wants some sort of a guarantee that the money would come back. So that is the security that is happening. Securitization. So that 50 lakh rupees which is given as a loan, there is a security for the amount that is given. That is called as securitization. What is the financial asset here? We already discussed what is an asset. The loan that is given is the asset. So financial asset that we are talking about here, that financial asset is the loan. You are securitizing the loan, the 50 lakh rupees. This refers to that 50 lakh rupees. You are securitizing that financial asset. Now let us say they are not in a position to repay. They, for some reason, they are not able to repay the loan. Okay, the bank, let's say you are the bank, you will not automatically go and say, okay, I am going to seize your house. Why do you not do that? Because first of all, the house may be half built. Okay, what can you as a bank do with a half built house? Can you sell it and make money out of it? You can only try to sell it to some construction company or some house real estate company and hope that they build the house, they buy it and they build it, and they will try to pay you the least amount of money. So you may not always be able to make a profit out of seizing a half built house or something of that sort. So they wouldn't necessarily want to go and take that property. Before that, they would want to give you an opportunity. As a bank, you would want to give an opportunity to the person who borrowed the money, where you will say, you know what, the financial asset has some features to it. The loan has some features to it. Every loan has a feature, has few features, three features actually. Has a principal amount, has a duration N, has a rate of interest. P and R, has P, N and R. So you might say, how about I give you some extra time? I can give you some extra time. Can you repay in that extra time? So maybe you can. Or you negotiate, the person who borrowed the money negotiates with the bank and says, I promise to pay you 12% interest. Can we come to an understanding that I'll pay you only 10%? If that is the case, maybe I'll be able to repay. The bank, now you are the bank, you are thinking, if I don't say yes, I might lose the entire money. So at least maybe I can agree to this 10%. So that's a possibility. So you might consider adjusting the rate of interest also. Sometimes even you might give up, don't give me any interest, at least give me the principal amount back. That is good enough. As a last case scenario, where if you feel that even if you take over the house, you may not be able to recover even the principal amount, you tell them, don't pay me anything. Even the principal you repay at least 90% of it, it is enough for me, because I won't be able to make more money than that with the asset. It is a loss that I am suffering as a bank, but there is nothing else that can be done at this point of time. So why don't you give me the 90% of the money or 80% of the money, whatever the bank considers to be acceptable amount of loss with which it can it can continue to exist as a business. So any of these are the structures or the characteristics of a loan. When that structure or whatever the loan is constructed of, when that is altered, that is called as reconstruction. The financial asset is getting reconstructed now in the form of change in duration, change in interest rate, or change in the principal itself. Okay, so that is called as reconstruction of financial assets. There is securitization of financial asset, there is reconstruction of financial asset. When even the reconstruction doesn't work, that is when you do the final measure, which is enforcing the security. That security was the house, I am going to take over the house as a last resort measure. You are leaving me with no other option. As a bank, if I need to survive, I need to take over that property. So I'll enforce the security interest. Security interest is whatever has been securitized. Whatever is given as the security is the security interest. Enforcement of security interest. Now read it again. Don't you find it easy to understand? Forget everything else. Think of the process that in which it is happening. Okay, first loan is going to be given by a bank. Before they give the loan, they'll ask for a security. Securitization of the loan. Loan is nothing but financial asset. Securitization of financial asset. They are not able to repay. We'll give them some extra time. Reconstruction of financial asset. So securitization and reconstruction of financial asset has happened. Even then they are not repaying. Then finally you enforce the security which was taken. Enforcement of security interest. 3-step procedure. Securitization, reconstruction, enforcement. Now, when the SARFAESI Act of 2002 was introduced, there is always a problem from the bank's perspective. The bank is feeling, I take over the building, maybe it is a half-built building. Maybe it is a completely built building. Maybe they have not even started building, they have only given a contract of some sort, so I only have a land there. Okay. Or maybe it's a vehicle that I'm taking over. So the vehicle, I don't know the actual value of the vehicle, I don't know the quality of the vehicle, I don't know the engine quality, I have no idea about this. I don't know at what price I can sell the vehicle that I'm seizing. Or it's a business that I'm seizing. Say, let's say Kingfisher Airlines. I'm seizing Kingfisher Airlines, but I don't know what to do with it. I am not going to run an airlines because that is not my job. I am a bank. I have to do banking activities. So when I seize these assets, this aspect of it, enforcement of security interest, when I enforce the security interest, I don't know what to do or how, I don't know how to monetize the asset that I have seized, the security that I have seized. So what do I do? The act itself says the bank can interact, the bank can transact with another entity called as asset reconstruction company. The SARFAESI Act provided for the setting up of asset reconstruction companies. SARFAESI Act said in India, ARCs could be set up. Prior to this, there was no provision for companies called as ARCs. After SARFAESI Act, the law says ARCs could be set. You as an individual can set up a company called as an asset reconstruction company or an ARC. What is an ARC? ARC is a private company. ARC is a private business. What is their business model? What is it that they do as a business? They take over some assets from the banks. Banks have seized some assets, right? They buy the assets from the banks and they pay money to the banks. Okay, they buy the assets from the banks, they take ownership of this asset, and they'll see if it's possible to recover this asset. Is it possible to run the business or complete building the house and then sell the house? If they can do that, they can do that. They are free to do that and make money out of it. Or if they are not able to do the business, can they break it down into small units and sell it? For example, Kingfisher Airlines. Now, bank doesn't know what to do with Kingfisher Airlines. So the ARC comes and buys Kingfisher Airlines from the bank. So they pay money to the bank. Now the bank is out of the picture. Let's say the Kingfisher Airlines owed the banks 100 crores. So they seize it. So ARC comes, ARC says, I'll pay the 100 crores. ARC pays 100 crores. Now the bank is happy, bank is out of the picture. NPA issue is resolved. NPA issue is resolved because someone has paid on behalf. The owner also doesn't have to worry because the security has been taken and the loan issue, everything is resolved. Now we have the ARC, which owns the Kingfisher Airlines. What can ARC do? ARC can itself apply for the license to run this airlines and run the airlines and make a profit. But the likelihood of them doing that is minimal because if it was possible, someone else would have done it. So what do? They'll see what all do we have with us. Okay, we have 25 airlines with us. We have license to, let's say, some 70, 80 routes to fly there. We have a lot of, the tractors and all those that you will find in airports. We have a lot of such machinery that is available with us. So we have a lot of staff working with us. So all these are the things that we have. Let us try to make some money out of it. They'll try to sell Kingfisher Airlines to some other entity, maybe to Indigo or maybe to Indian Airlines or Air India or someone. Do you want the entire thing? We'll give it to you as it is. Maybe there is no one willing to buy the entire company. So what the ARC will do, okay, if you don't want the entire set, how about you buy a couple of aircrafts from me? So you can buy 2 aircrafts from me, you can buy 4 aircrafts from me, you can buy 5 of my tractors, you can buy 5 of my godowns, you can use my godowns. So break the company down. At the end of it, there is nothing called as Kingfisher Airlines left. And who cares about it? They don't care about it. They are selling the company, they're breaking the company down into small units and selling it at different paths. This is called as liquidation of a company. The company doesn't exist as a company anymore. It is converted into money form. The company breaks down, is liquidated, and it is sold into various other entities. And this way, the ARC can try to make money out of the asset that they have bought from the bank. Okay, so this is the theoretical basis of how the SARFAESI Act would work. The SARFAESI Act a very, very key point here is that the SARFAESI Act gave judicial power to banks. Now, why is this important? Because prior to the introduction of SARFAESI Act 2002, prior to 2002, no bank had the right, legal right, to seize a car or a bike or a house or anything of that sort. Okay, so what would happen? A bank would give a loan, to buy a car. Let's say bank would give a loan to you to buy a car. You are not able to repay. The bank would send someone to take the car. The bank comes, takes the car, and keeps it in their godown somewhere in their yard. And then the person goes, and the person to whom the car belongs goes and files a complaint with the police that my car has been stolen. The police does an investigation and finds out that it is with the bank, and then there is a case which is written. The bank has stolen the car from that person. Now this goes to the court. The bank says, but that person borrowed money, okay, and is not able to repay. Now the judge is asking, but who gave you the right to steal that person's car? So this goes on and on and on, and the bank can never dispose of that car till this issue is resolved, which means the bank is also in trouble because the other person is not repaying the loan. So the banks did not have the right to seize the asset, which is where this act was introduced. This act gave legal power to the banks to, first of all, ask for a securitization. It gave them the legal power to make adjustments in the loan, reconstruction of loans. And it also gave them the power to enforce the security interest, which is to go and seize. Now, after the introduction of the act, bank takes over your car, you go to the police, you file a complaint, police does an investigation, they go to the bank, they ask a question, do you have the securitization? Have you securitized the car? Is the car hypothecated? Car is hypothecated. Is the car hypothecated? The bank will show the RC book copy and say, you know what, it is hypothecated, it is in my name that he has bought. Only after he repays the entire loan will it go into that person's name. So the police says there is no case here, we will not register a case. The police goes to the complainant and says, no, there is no case, the car actually belongs to the bank. End of story. The bank is not in trouble anymore. So that is why we call it as judicial authority or judicial power to the bank. Why? The bank itself can decide and conclude what is the right thing to do here. The power to seize is normally with an adjudicating authority. The bank itself is acting as an adjudicating authority over here, which is good in a lot of cases because it resolves the issue very smoothly from the bank's perspective. But there are a lot of accusations saying that the banks are selectively using it. They are using it against poor farmers whose tractors are taken away, but they are not using it against the rich industrialists and businessmen who continue to roam around without any problem. So that is an accusation that is there. Some people say that this power to reconstruct is what was misused, and that led to the hiding of NPAs. I spoke to you about evergreening, right? Evergreening happened because of the power to reconstruct. These are all some criticisms that are there of the SARFAESI Act. And SARFAESI Act has not been very, very successful in resolving NPAs, primarily because ARCs and banks were never able to come to a conclusion. Let us say the bank has given a loan of 100 crores to Kingfisher Airlines. Kingfisher Airlines is not able to repay, so the bank takes over Kingfisher Airlines. Now, because the Kingfisher Airlines is in trouble, the market value of the company goes down. The market value of the company goes down, which means in the market there is already discussion that, okay, Kingfisher is not going to run, it is going to be a flop, it is going to be a failure. Now an ARC comes to buy, ARC realizes that Kingfisher Airlines doesn't have value anymore. They may not be able to recover 100 crores. They may be able to recover only 60 crores in the market for this company in the present valuation. So they'll offer only 50 crores to the bank, saying that is all that I can get from the market. I cannot give you anything more. Bank says, no, but I gave 100 crores to that person. I cannot sell it to you for 50 crores. And there it never gets sold. And the Kingfisher Airlines is now blocked and it remains in the possession of the bank without ever being transferred to an ARC. And the bank will get nothing out of it ultimately. So which is why the ARCs and the banks were not able to negotiate and come to a conclusion a lot of times, led to the limited success of SARFAESI Act. Don't call it a failure. It is still successful, but the success is limited. There is a limited scope within which it is successful. Okay, so there's someone who's asked a question, but why this act? Already this process only prevails. No, I don't know when you ask this question. Whoever it is, please add your name. Okay, that is what I said. Prior to 2002, such a process did not exist. I'm talking about this act in 2002. Most of us would think this act has always existed because most of us started knowing about the world after 2002. How old were you in 2002? Some of you would have been 6-year-olds, 5-year-olds. Some of you may have been 10-year-olds. Don't know. So for you, the entire world is like, oh, obviously that is how all banks work. But that was not the reality prior to 2002. Hence, it required an act. Look at the year. Long time ago. Some of you may not even have been born at this time. I don't know. If there is someone who says, the college is not challenging enough for me, there is too little to study there, I'll also take up the challenge of preparing for UPSC. 17, 18-year-olds, if you have joined for preparation here, because it's weekend batch, everything is possible. I have seen two extremes. So 30, 32-year-olds coming and joining for the first time, and 18-year-olds joining also I have seen. So it's a possibility that you might be there. In that case, you were born after this act. So that's also a possibility. Moving on. Okay, there's another question. Who were blamed for the NPA crisis in 2014? Is it banks or business? There is no one entity which is responsible for NPA crisis. Both the entities have a role to play, banks as well as business. Banks, because they were not careful with respect to giving out loans, they did not follow due process, is one criticism of the bank. Businesses, because they didn't care enough to take care of and repay the loan. They were very lax with respect to their investments. That could be the situation. Even the government is under criticism because the corporates will criticize the government, saying that you did not give us the ideal condition for running business. It's because you didn't do rules properly, you didn't give clearance properly. You asked me to build a road, you gave me a contract, and when I go to build the road, there is a protest happening there, saying farmland is being taken away. Now, how can I build? I took a loan from there, assuming that you will clear everything for me. But you are making rules, you are changing rules in between. Now I am stuck here forever. So all three entities, it is not just bank or business alone. Sometimes the government or the policy makers, all of them are responsible for the situation. It is not only these two entities alone. A lot of entities are responsible. Okay. Also, the common people. For example, I'll tell you why the common people. I blame the common people. A lot of people who have the ability to repay the loan also do not repay the loan. Why do they not repay the loan? They'll think, okay, ultimately when the election comes, the government will give a waiver. The government will say no need to pay the loan. I personally know friends, not quite friends, I know them, acquaintances. I personally know people who have got into jobs with me. After college, I got into a job. I was working for 4 years. So during that period, they got a job. All they did is they had taken an education loan during their engineering course. They just shifted their house and they moved to a different locality, and they refused to repay the loan. They said the parents said our son did not get a job, will not be able to repay. They took 4 lakhs loan and repaid only 50,000. The bank said, fine, no problem, pay 50,000 and we'll waive off the loan. So that happens. There are people also who are responsible for this entire process. And when you look at them, the people who have actually put in the effort to repay, they'll feel, was I an idiot to repay all the loan? He didn't repay. Now I am having to repay. Why am I repaying? So this sort of a culture. And when the government comes and gives a waiver, it is a further disincentive for other people. The farmer who has repaid the loan will now feel, why did I repay? That person could have also repaid. He didn't repay. I repaid. He is getting a waiver. What am I getting? Okay. So that sort of an attitude that is there. A lot of factors come into the picture when it comes to the blame game behind NPA. Let us not go deeper into that, because that is a whole different discussion. There is a political aspect, there is a social aspect, and all those. We'll just stick to some basic knowledge to begin with. Okay. So that is one resolution mechanism that is there. Then that was in 2002. We'll come to the present. The first present resolution mechanism that you can write about is something that I've already taught you. The first process of resolution is identification of the problem. Asset quality review is also considered as a resolution mechanism, because that is what brought the problem to the, or acknowledged the existence of a problem, identified the problem. So this is the first step in resolving the problem. recognition of the problem. Recognition happened through asset quality review. See, after this in 2015 and 16, there were a couple of measures taken. I'm not going to go into the details of it. In 2015, there was a measure called as strategic debt restructuring. And in 2016, there was another scheme called as Scheme for the Sustainable Structuring of Stressed Assets. Scheme for the Sustainable Structuring of Stressed Assets, SSSSA. That is what is S4A. I am not going into the detail of this because both these schemes were introduced, acknowledged to be not successful, and they were scrapped, which means those schemes are not there anymore. Okay, this is strategic debt restructuring. This is sustainable. Sustainable to whom? Sustainable to the banks. Sustainable structuring of stressed, or this is scheme for the sustainable structuring of stressed assets. That is the 4S. Scheme for the sustainable structuring of stressed assets. Now, if it's not important, why am I giving you the name? In an examination, if you just have to write what are the various measures the government has taken over the years or RBI has taken over the years, you can mention these without going into the detail. Both the scheme, the idea is that some restructuring of the loan, some exemption in PNR, either of those being done, that is both the scheme works very similar to that with minor alterations, but both the schemes did not quite work out. So we are not going to go into the detail and study. We will look at towards the end of 2016 and early 2017, another scheme came into existence, another set of rules were brought into existence. That is what we are going to study about, something called as insolvency and bankruptcy code. Insolvency and bankruptcy code. IBC. I'll explain how IBC works, but before that, let me first tell you what these two words mean. What is insolvency? What is bankruptcy? How are they different from each other? Insolvency is a state of being unable to repay a loan. State of being unable to repay a loan. That is insolvency. Okay, it is only a claim. Insolvency is a claim. It could be a claim by one of two entities. I could claim I am insolvent. Okay, I have taken a loan from a bank, let's say. I could go and claim that I am insolvent. I am not in a position to repay. Please help me out of this situation. Or I may not claim. The bank may come and accuse me of being insolvent. The bank may claim that I am insolvent. So it is only a claim. There are two parties here, the borrower and the lender. Either the borrower self-claims that he or she is insolvent, or the lender accuses that the other person is insolvent. In both the cases, these are directly affected parties. These are in conflict. When they claim, it doesn't automatically become the fact. It doesn't become a declaration. So when this trouble comes, they go to a neutral authority, someone like a judge or someone like an authority, tribunal for the purpose. The tribunal looks into this matter and the tribunal declares a verdict saying that based on the facts that are presented here, I find that this person is indeed insolvent. Confirmation of that insolvency by an authority is called as bankruptcy. So declaration by an authority or confirmation by an authority of what? Of the state of being unable to repay a loan. Confirmation by an authority of the state of being unable to repay a loan is called as bankruptcy. Someone declares you to be bankrupt. You claim you are insolvent. Someone agrees and says, yes, you are insolvent, which means that they are declaring you bankrupt. That is the difference between insolvency and bankruptcy. Two stages. First you claim, then someone validates it. Okay, so that is the idea behind this. Now, what is the benefit behind this entire process? Here, the idea is that previously, you remember, we classified assets into substandard assets, doubtful assets, loss assets, and ultimately it is written off. When I was telling you about written off, I told you very specifically the bank may write off the loan from its account books, but the bank doesn't stop seeking the money from you. The bank may say it is not an NPA anymore. I am removing it from my account books because I'm declaring it as a loss. I am removing it from my account books. But you will continue to owe the bank for lifetime. Till you repay, you will continue to owe because the bank will continue to chase you. Okay, so there is no closure. There is no exit. So that is why we called it as an exit challenge. But what does this declare? When a neutral authority, when a adjudicating authority comes and declares saying that this person is not capable of repaying, this is the sort of penalty that I have for you. And once that penalty is done, and there will be no jail penalty here because it is not a criminal offense, it is only a civil offense. Some sort of a penalty, mostly would be monetary or in terms of losing your business. All the business that you had, you will have to give it, or something else associated, you will have to give it. Once that is done, then even if the bank is not able to recover the entire money in the process, even if the bank is suffering a loss here, because it is a third person, an adjudicating authority who is giving the verdict, this person who claimed insolvency, once declared to be bankrupt, will have no obligation to repay anything more. Even if 10 days later he wins a lottery and becomes a crorepati, he doesn't have to repay that loan, because a court ruling has come saying that the issue is resolved. That is the advantage of bankruptcy. Once you are declared to be bankrupt, you are not expected to repay any loan obligation that you had. Now, among the most famous people who have been declared bankrupt multiple times is the outgoing US President Donald Trump. When he was a businessman, he had been declared bankrupt multiple times. He would take loan, do business, business would fail. Okay, then he'll go and file insolvency and say, I am insolvent. Some authority would declare, okay, fine, you are bankrupt, get out of here. And their credit rating and all those would get affected. So they'll not be able to get a loan from somewhere else. But Trump, being Trump, goes and convinces people and says, I have another brilliant business idea. The previous one didn't work out, but this one will work out. And someone will come and invest. And this time again, he goes and again the business fails. So he'll go and say, I'm insolvent. He'll be declared bankrupt. He once again goes to someone else. You know what? Those people who are interfering in my business, you don't interfere. I'll make it a success. Borrows money again. So this keeps on happening. Okay. So that is with respect to Trump. But the idea is that if you are a businessman, this is something that you die for. You really want it. Why? The freedom. One mistake you have made, you should not be penalized for life for that mistake. And you would have learned from that mistake. Maybe if given another opportunity, you would be able to do better with business. There are so many people who failed in their first business and then did manage a successful business afterwards. Okay. So that second chance is what the Insolvency and Bankruptcy Code intends to provide to the business person. To the bank also, it provides a level of closure. They don't have to forever follow on a loan. They'll get a quick resolution as well. So that is the idea behind Insolvency and Bankruptcy Code. Let us see how it works in practice. Okay. In practice, this is how it works. So there is someone who claims insolvency, either a bank or the borrower, either lender or the borrower who claims insolvency and files a case with an authority. There are two authorities here. For registered companies, there is one authority. For individuals and non-registered companies like limited liability partnership and all those, there is a different entity. For companies, there is something called as National Company Law Tribunal, NCLT, National Company Law Tribunal. Company law is a law. Companies Act, the act through which companies are set up. That act itself says for any issues between companies, we'll set up a tribunal called as NCLT. Over the last 3, 4, 5 years, you have been probably reading the news that Tata Sons is in some sort of a case with Cyrus Mistry, their previous CEO. That is something that you may have seen in the news. So when within the company or among companies, there is some sort of an issue, both will come under the company's law. So that issue will be dealt with by NCLT. Similarly, bank lends money, company borrows money, these two are in trouble. Who's declared as the adjudicating authority here? NCLT is given the power to adjudicate this sort of an issue also. NCLT's only role is not to resolve loan issues. Along with many other disputes, they also take a look at this. So that is National Company Law Tribunal. With respect to individuals and non-registered companies, there is something called as Debt Recovery Tribunal, DRT. Debt Recovery Tribunal. We probably have come across these two terms when I told you about Narasimhan Committee recommendations. He suggested setting up panels like these to resolve the issue. I may have given you the name, not sure. Okay. But because we are focused on the business and the NPA crisis from the business's perspective, we'll take a look at it from NCLT's perspective. The process is similar for DRT also, but NCLT is the bigger concern, so we will look at it from the NCLT's perspective. So the banks or the individual raises the concern with the NCLT. The NCLT gets a time of 14 days to look into the case and to decide whether to take up a case or not. This process is applicable in all judicial systems. Just because you file a case in a court, the court doesn't have to listen to it. The court can examine the merits of the case. It can either accept the case or it can straight away dismiss the case also. The court may say, this is just frivolous case, I will not take it up. It can throw it away. In a proper judicial system, it is possible. Similarly, here also, a 14-day time frame is given, during which the NCLT decides whether to take up the case or to not take up the case. Okay. Once it decides to take up the case, if it decides to take up the case, immediately it appoints a person called as insolvency professional. Also called as resolution professional. So resolution or insolvency professional, RP or IP. This person is alternatively called as RP or IP. Who's this person? See, in India, it is still an evolving area. This entire insolvency is just an evolving area because only in 2016-17, IBC has come into existence. Okay. In some of the Western countries, there are colleges which offer insolvency resolution courses. You could be trained to become an insolvency resolution professional. Right? It is just like something like a chartered accountant or something of that sort. It's an occupation like that. In India currently, people with experience in the industry can apply for license to be classified as insolvency professional, and such people are given the task of looking into this issue. Okay. What do? They play a role very similar to the role played by asset reconstruction company. You know the asset reconstruction company that we saw, ARC in SARFAESI Act? They play a role very similar to that. The main difference is that they do not take ownership over the asset. The bank and the borrower, the business, both will come to the resolution professional. The resolution professional will be in charge of that business for the entire duration of resolution. Which means just like ARC took over that company, this resolution professional will take over that company. It will be the responsibility of the resolution professional to now run the company, and the management of the company is bound to give their entire support to this resolution professional. This resolution professional is given a timeline of 180 days to resolve the issue. What is the best possible resolution? The best possible resolution is to make the company profitable again and to repay the loan to the bank. But that is not a likely scenario, because if it is likely, someone would have done it. The management would have done it. What is a more likely scenario? This resolution professional during the 6 months will try to find some buyer for this company, some outside buyer. For example, recently I saw a news where Quality Walls, you would have probably heard of this company called as Quality Walls, who make dairy products, ice cream and all those. At least in Chennai, I've seen, I don't know about the other states and cities. So there is a company called as Quality Walls, which was in the NPA crisis, which had claimed insolvency. So the resolution professional was trying to find some company which should come and take over the Quality Walls company here, and there was a negotiation between Haldirams. You'd have heard of Haldirams, right? Haldiram snacks and sweets and all those. Haldirams was making an offer to buy Quality Walls. And now if that went ahead, then Quality Walls would come under the ownership of Haldirams. They can probably continue calling it as Quality Walls and run it as a subsidiary, or they can take over the company and run it under the name Haldirams, whatever it is the case. So when Haldiram becomes the owner of that company, now the loan of the company also goes to Haldiram. Haldiram will have to pay to the bank, and the agreement itself would be that you pay the loan first, then you take over the company. Okay, if the company is bought for a higher value than the loan itself, then that extra money would be given to the original owners. But even if it is sold at a lower value, if let's say Haldiram, if the loan value here of Quality Walls is let's say 500 crore, but Haldirams is offering only 350 crores to buy the company. Now what the resolution professional will do is, resolution professional will say, you be on hold, let me try to go and find other buyers in the market. Are there other buyers in the market? Okay, if the resolution professional is not able to find other buyers, and Haldirams might also say, I'll not keep this offer forever. If you want, you sell now. Otherwise, I'll not come and buy from you. So that happens. And finally, if there is no other option, the resolution professional places this option in front of the adjudicating authority and says, this is the best that I could find within the given period of time. Haldirams is making this offer, but it involves a loss of 150 crore. There is only 350 crore which they are willing to pay. I think this is the best solution that is possible here. So NCLT will look into the merit and say, okay, fine, this seems to be the best solution. Sold, done. Now, Quality Walls, the owners, they don't owe anything anymore. There is a loss of 150 crore, but this is the best possible resolution. An adjudicating authority has declared it. The bank might be suffering a loss. The bank might also say, but this is a loss for us. The NCLT says, but considering the current situation, this is the best that you can get. There is a loss, but you will have to suffer it because you took the decision to give the loan. So you will also have to take responsibility for it. So 150 crore loss. If the bank is not happy with the solution, they always can appeal. They can go to National Company Law Appellate Tribunal, and this may go on. But generally, at least the first level of approval, first level of resolution is done within a period of 180 days. If within 180 days, they are not able to sell, and the resolution professional feels with just an extra time of 90 more days, they will be able to, they are on the verge of finding a buyer, but they just need a little more time. Then with the agreement of the creditors, the lenders, a further extension of 90 days may be given. With the approval of the lenders, it could be extended for a further 90 days. So there is 6 months, there is 3 months, total within 9 months, the entire issue will be resolved. And if they are not able to find a resolution even then, the company will be liquidated. Again, the resolution professional will help in that process, where the company is broken down and small parts of the company, the machines will be sold to some company, this will be sold to some company through an auction. Probably in liquidation, the bank will get even less money. Instead of 350 crores, maybe they are getting only 300 crores or 250 crores. It might be a bigger loss for the company, for the bank. But that is done. Whatever be the case, even if there is no seller or buyer for that company, the issue will be resolved in a maximum of 270 days. And the bank is also out of the picture, especially the borrower who was facing an exit challenge, Chakravyuha challenge, is now out of the picture. They don't have to worry about the situation anymore. So that is the Insolvency and Bankruptcy Code. Okay, so that ends our discussion on Insolvency and Bankruptcy Code. I have a few more concepts, but I think we'll take a short break. It's been 1.25 hours. We'll take a short break and then we'll come back and discuss the subsequent topics. Or do we take a break at 3:30? You tell me. 10 minutes later. What is the difference between ARC and NCLT? Okay, 3:30 is when we'll take a break. One person has responded. I'll not say who the name is. then all of you will turn against him or her. Don't smile, you will get caught. And don't hide your smile, you will get caught. Okay, anyway, what is the difference between ARC and NCLT? ARC is a private company which is going to take over and take over the asset from a bank. It is a private company. They will buy the asset from the bank. That is what is an ARC. NCLT does none of this. NCLT is just like a judge. NCLT is just like a court with a judge. They are only taking decisions. Your ideal question should have been, what is the difference between ARC and insolvency professional? Because NCLT and ARC are nowhere close to each other. This is an adjudicating authority. It's like a judge and a court. ARC is like a company which buys an asset. Your question is, what is the difference between IP and an ARC? So IP and ARC, the major difference is ARC pays money to buy the asset. Insolvency professional is only appointed to the role of controlling that asset to find a new buyer. So it is only a temporary position, the running of the company and all those. It is like a salary job. They'll be given a salary for that particular service that they provide. But ARC, they are a company set up for the purpose of buying the asset from the banks. That is the difference between them. All right. Okay, so if that is the case, we'll move on. The next topic that we have is, what is the number that I gave here? Okay, I did not give a number. Good. You can put a number if you want. So in 2018, the IBC has been reasonably successful since its inception in 2016-17. It has been reasonably successful, but the problem that IBC is facing is that a problem of too many cases in front of the NCLT or DRT. That's always the case. Even in the normal judicial system, there's a lot of pendency, a lot of cases. So far too many cases coming here. So the government appointed a committee called as Sunil Mehta Committee to look into this issue and suggest other mechanisms to resolve the NPA crisis, to deal with the NPA crisis, to reduce the load on the IBC. So Sunil Mehta Committee came up with a 5-pronged resolution approach. Okay. A 5-step resolution approach. Number one, so before I get to the 5-pronged resolution approach, first they classified assets into 3 categories. They classified assets into small-sized assets, medium-sized assets, and large assets. So in the wider context is what this classification works. What are small-sized assets? Small-sized assets are assets which are less than 50 crores. Assets whose value is less than 50 crores. Medium-sized assets is where the value is between 50 crore and 500 crores. And large-sized assets is where the value is greater than 500 crores. Small assets, mid-sized assets, and large assets. Okay. So these 3, why am I classifying it into these 3? They said we'll have different resolution mechanisms for these 3 different types of loans. For small assets, they said we'll have a SME-led resolution approach. See, SME here stands for subject matter expert, a committee which is an expert in that particular area. So we can also call this as the steering committee. steering committee is a committee. You know what a steering does in a vehicle. A steering guides the vehicle in the right direction. So a steering committee is also something which does that. An expert committee which can guide the bank in the right direction. So a bank will appoint a steering committee internally. That committee, instead of one person, instead of one bank manager or one particular independent, sorry, one particular authority within the bank deciding, a committee which should have representation from multiple places, so the chances of bias or any undue favors is not there anymore. This committee will look into an issue to resolve the 50 crore. This committee will have the ultimate authority to resolve the issue. No need to go to a DRT, no need to go to an NCLT, no compulsion to go to all these things. Okay, so that is called as SME-led resolution approach. The second one is called as, again called by the name, called as bank-led resolution approach. This is for mid-sized assets. Now, what is the difference between SME resolution approach, SME-led resolution approach, and bank-led resolution approach? Because the first one also I said is bank-led. The bank itself will appoint a steering committee. How is this different? Because it is normally observed that for small loans, the loans are given by one bank. One bank will give a loan. If you want a loan, you'll go to one bank and take a loan. But in mid-sized assets, in medium assets, beyond 50 crore, say 100 or 300 crores and such loans, starting from the mid-sized assets, what is generally observed is that the loans are not given by one bank alone. What will a business do? A business will go and make a proposal to a bank saying that I have this business plan, I require 300 crores, can you give a loan? The bank feels 300 crores is too much of an exposure for me, I cannot give you an entire loan. Maybe I'll check with some other bank. So this bank, along with a few other banks, come together to give 300 crores as a loan. One bank, the bank which took the decision, may be giving 100 crores out of 300 crores. The other four banks may together be giving, let us say, the remaining 200 crores. But they give it as a consortium. This group of banks giving a loan is called as consortium of banks giving a loan. In the Vijay Mallya case, multiple banks were involved in the process of giving loans. Many banks came together to give a loan to Vijay Mallya. So that happens mostly in the medium or large assets, but specifically in the medium assets, there is a consortium of banks. So when there is a consortium, it is not one steering committee appointed by one bank which can resolve the issue. When a resolution is suggested, all the banks have to be in concurrence with that to resolve the issue. But therein lay the problem. The problem here is that which bank would suggest the resolution? Obviously, the logic says whichever bank has given the maximum loan, they would be the one giving the resolution. But for that approach, for that resolution to be successful, all the other banks also have to agree to it. So maybe a bank A, let us consider this scenario, 100 crore is the value of the loan, let's say, of which 50 crore is given by this bank called as A. Then there is a bank called as B, which is given a loan of 20 crore. Another bank called as C, which has given a loan of, let's say, 15 crore. That's 85. D, which has given a loan of 10 crore. And E, which has given a loan of 5 crore. These 5 banks together have given a loan of 100 crores. Okay, 100 crores loan is given. Now, A is feeling that there is a lot at stake. 50 crore rupees is at stake. It's a huge amount of money. E is feeling it's only 5 crore. It's not as much of a big money for me. It is only smaller of my concerns. 10 times more risk A has taken. E has taken a lesser risk. So A gives a resolution where A says, I don't care about the interest. I want to minimize my loss. I don't care about the interest. Even if I don't get the interest, it's okay. So A might give a resolution plan where they are saying we'll give up on the interest. We'll just get the principal amount. At least that much will be back. But E doesn't have such worries. E says it's only 5 crore. If I'm getting, I need the interest as well as the principal. E alone can block the plan that is agreed by everyone else, because E is also a partner there. So this is why Sunil Mehta committee said these things happen. To prevent this, we need to have an inter-creditor agreement. Which means among the lenders, there should be some agreement that is done. Among the lenders, there should be an agreement. Okay, what is the agreement that we are talking about here? Among the lenders, they should come to a conclusion that there are certain rules that are going to be followed when it comes to giving loans as a consortium. So the rules are like this. Okay, number one, the bank with the highest exposure. What is meant by exposure? This 100 crore is how much of the bank's money is exposed to the business. That is why it is exposure. How much of the money is exposed? How much of the money is at risk? How much of the money is given? 100 crores is the total exposure of all the banks put together. Whichever bank among the five has the highest exposure, in this case A has the highest exposure of 50 crores. Bank with the highest exposure will give the resolution plan. Okay, the second rule, agreement, the second step in the agreement is that if it gets 66% approval. So when I say 66% approval, don't think that 66% of the banks have to approve. Okay, 66% of the bank would mean what? 6.66 out of 10 banks, which means out of 5, 3.33, which means 4 banks will have to agree. That is not the case. It is not the number of banks. It is the out of the total exposure value, banks which have given exposure up to 66.66%, which means out of 100 crore, the banks which have together given 66 crore as loan, if those banks agree, then they can go ahead with the resolution. So A and B can together come up with the A gives a resolution plan, B agrees, that is the final plan. A gives a solution, B doesn't agree, C agrees. It is not enough. It's only 65%. It requires a concurrence from one more bank. So cumulatively, if 66 crore worth of banks with exposure of 66% have given their approval, then that plan is final. The others cannot invalidate this plan, which means the power that E earlier had in disrupting the resolution doesn't exist anymore. Majority, and not just a normal majority, not a simple majority, a special majority has approved to the plan, which means they'll go ahead with that. But this is not a ad hoc or a case-to-case basis agreement. It is not an agreement which you get into before giving a particular loan. The agreement was made available in the economy. In the banking system, any bank which agreed could sign this agreement. Once they sign this agreement, this law is applicable for all kinds of consortium loans that are given. This agreement is applicable for any future consortium loans that they give. It is not just a case by case basis. So this intercreditor agreement is a very important agreement in the Indian banking system as a whole. So once an agreement is opened, whichever bank has come and signed, let's say 20 banks have signed, 5 banks have not signed, which means for those 20 banks, if they get into any sort of a consortium loan, they have to abide by these rules. If one of those banks makes a consortium with some of the other banks which have not signed, then for those banks, this is not applicable. Okay, it is not a case by case scenario. It is a general agreement which they sign, whether to be a part of the intercreditor agreement or to not be a part of that. So that is the intercreditor agreement, which is a part of the bank-led resolution. In bank-led resolution, there is a consortium. That consortium, through the intercreditor agreement, follows the bank-led resolution approach to resolve mid-sized loans. So the ICA is a part of the bank-led resolution. For larger assets, for big assets, the problem with the big assets is that the large assets is that the bank does not have the expertise to deal with this. The bank does not have the expertise to deal with such large assets. It doesn't know what to do with it. So in such cases, the bank can take the assistance of an asset management company. Asset management company is very, very similar to an asset reconstruction company or an insolvency professional. The only difference is that instead of a court appointing an insolvency professional, the lender and the borrower together come to an agreement. They go to an asset management company and they say, please help us resolve this issue. It is the same as an insolvency professional, but instead of an NCLT appointing it, it will be these two entities together going and consulting an asset management company. So that company will help in resolving the issue. All these three are applicable only when there is no dispute between the lender and the borrower, if they are in good cordial terms. If there is a dispute, there is a requirement for an adjudicating authority. So obviously they'll have to go to an IBC. But without dispute, there is no compulsion to go to the IBC. There should be no law which says that compulsorily they have to go to IBC. There are other options available. For example, it is like mediation. You know, right? When two people fight, it is not always that it has to go to a court. There are also other mediation mechanisms available in local villages and all those things. There is some entity with some judicial power who's saying, okay, let us not go to the police and the court. Just like a modern organized version of a panchayat system, the old panchayat that we know of, where the rules are more in line with how the acceptable rules are. So such systems exist in India. To some extent, Gram Nyayalaya and all those things that you learn about in polity. So mediation and other dispute resolution mechanisms. So similar to that, if they can themselves come to an agreement, then that is good enough. Then it will reduce the load on NCLTs. That is the idea there. Okay. So this is 3 out of the 5. Okay. Then there is 4 and 5. Okay. 4th, obviously, is where if you are not able to come to a resolution whatsoever, you go to the IBC. IBC-led resolution. That is when you are not able to come to any sort of a conclusion. That is the 4th approach, which is already in existence. And finally, it gave a very unique solution to the problem. It said, no, you have not yet learned financial markets. I have not yet taught financial markets to you. But when I taught, did I teach public finance for you? Or was that done by ma'am? Public finance, especially the direct taxes. Did I give you some idea about what is a security? Okay, I'm not sure. So it's okay. It doesn't matter. I'll just give you a brief overview right now. So a company is to be started. Okay, a company has been started. Let's say I start a company and it is running successfully. I started the company with, let's say, 10 lakh rupees. With 10 lakh rupees, I started a company. I've been running successfully. The company has been successful, but I want to expand the company even more. I want to open a new branch. I require, let's say, 5 lakh rupees more or 10 lakh rupees more. I already have started a company. I'm running it for 10 lakhs. I require 10 lakh rupees more to start a company. I can borrow from a bank. It is not always easy to get a loan from a bank. Bank just doesn't like that, approve it. Maybe some of my old loan is pending, so the bank is hesitating to give a loan. Or I am feeling that if I take a loan, my interest obligation will be too high. I may not be able to repay. So what will I do? I'll start looking for investors. I'll say, can someone else come and invest in my business? Some entity who's interested in the business, can I find a partner? But the problem here is that if I put in initially 10 lakhs and now someone else is coming and putting 10 lakhs, I put all the initial effort. Someone will come now and become 50% owner of the company. I am giving up half my ownership to that investor. Now I am feeling that I don't want to give up my ownership to anyone else. I want to have complete management control to myself. So what can I do? Instead of the problem comes only when I get the money from 1 person or 2 persons or 3 persons. What if I get the 10 lakhs from 1,000 people? Now 1,000 people will have very small share. My 50% of the share is divided among 1,000 people. What can they do? Can they come and say, I want to be a part of your managing director and all this? No, they cannot come and say. So I get this 10 lakh rupees which I require for my company. 50% of the ownership of my company, I am selling it, but I'm selling it not to 1 or 2 people. I'm selling it to 1,000 people. Now where will I find 1,000 people? I'll find these 1,000 people by going to something called as a share market, a stock market, where I'll sell the shares of the company, very small units of share, 10 lakh rupees, I'll divide it into 1,000 and I'll share it, I'll sell it over there and they'll buy the share. And the only expectation for them is if this company makes a profit, I'll share their share with them. So 50% of the profit, I'll share it with those 1,000 people. The remaining 50%, I'll keep it with myself. This is the idea behind why companies issue shares in the market. This is why shares exist in the market. Okay. Very similarly, the entire problem. So the Sunil Mehta committee says the problem with resolving this issue is that you are trying to sell a company which is failing to some other entity. That is what the insolvency professional is doing. That is what the ARC is doing. That is what the AMC tries to do. Everywhere you are trying to sell the asset to someone else. But it is because you're trying to sell the whole asset that no one is willing to come. What if you break this asset into small units, not like liquidation? You break the company into different shares and you sell it. There might be a lot of people who believe in the success of this company in the future. They know currently it is not performing well, but in the future it may be able to perform well. So instead of one company, if you break it down into 1,000 shares and make it available on a share market, on a platform, maybe people will come and invest in this company. You will get more money than what you are getting currently. That is a possibility. Okay, so for that, they suggested setting up a specific share market just for this purpose, an asset trading platform. An asset trading platform led resolution. Okay, so here the Sunil Mehta committee suggested that just like we have the Bombay Stock Exchange and the National Stock Exchange and all the stock exchanges where good performing companies shares are traded, we'll create a separate trading platform, a stock exchange where only shares of poorly performing companies in NPA, we will trade only those companies shares. So anyone who comes to the share market is very well aware that they are investing in a poor company, poorly performing company. So they are not expecting immediate returns. They are investing with the expectation that in the future they may be able to get some returns out of this. So if we do that, there is a possibility that we might get more people to invest in these companies and to buy these companies. So that is another solution that was suggested. So it's a 5-pronged approach of the Sunil Mehta committee. Okay, so we have two more or actually one more major resolution approach called as the Indradhanush scheme. So we will discuss about that and a couple of more terms which are in the pipeline. It's in the discussion, but it is not a reality yet, called as bad banks and PARA, Public Asset Rehabilitation Agency. We will take a look at it after the break. 5 minutes, we'll take a break. Then we'll come back and discuss Indradhanush and those two schemes. because in crowdfunding, sorry, I think the display is a little off. Okay. Crowdfunding is different from asset trading platform in the sense that in an asset trading platform, you break down the company into shares, units of shares, and then you get people to give the money. The idea behind it is the same, but in crowdfunding, there is no actual share allocation that is happening, and there is not always an expectation of profit from crowdfunding. Crowdfunding is mostly done for social purposes. For example, some people may get fund from a wide variety of people to take a socially relevant movie, to make a socially relevant movie, documentary or something of that sort, or for some social cause, they could get crowd to fund. So crowdfunding for business activities is not very common, but it is nowadays. So to start up, to have a new startup, there might be some crowdfunding which is happening. With a business idea, they'll go to many people and they'll say, or they may post in the internet saying, we are starting this particular business, you may contribute to the business, you can get it. You may not get a share, you may not get anything. All you are getting is that you will know that you have contributed to the rise of that business, but you will not get it. You are just giving your money without any profit expectation. That is not how share markets work. Share markets work where you give money, you get a receipt for that money, a proof for that money in the form of a share, and then later you will get a share of the profit when they make a profit. I don't think in crowdfunding the name of even the person contributing is known, so they may not get any returns for that. That is to answer about crowdfunding. Second one, Goldman Sachs that come in Chetan Bhagat's novel, is it an ARC? I don't know. I have not read that novel. A long time back, I stopped reading Chetan Bhagat's novels after the initial 2-3 things. I have my own reasons. But anyway, I don't know about that particular novel. But Goldman Sachs, is it an ARC? I just checked when I saw the question and I found that it may have an ARC, but that is not their primary job. They are an investment company, about which we learn in the external sector class, where they take people's money and they invest in some company, or they may themselves go and invest in some company. So they are more like an investment company who would invest in shares and stocks rather than being an asset reconstruction company itself. But they may have a subsidiary which does asset reconstruction. I am not sure. So because I don't know, some companies are so huge that they might have branches. So I don't know. And in that specific novel, I'm not sure. And I don't think I will take the effort to go through and let you know. So just based on the context, I would want you to read that and try to understand if you are keen. Okay, there is someone. Okay, so we have Sri Lakshmi, who was working in Goldman. It is an investment banking firm. She was working there apparently till last October. They don't have an ARC. Okay, that is a clarity from Sri Lakshmi. So we have someone here who worked in Goldman Sachs. Sri Lakshmi, were you also a part of that novel, One Indian Girl? Were you the one Indian girl about which the novel was? Okay. Okay, so not her. She's not the heroine of that story. Anyway, so that is that. And then Sri Lakshmi herself has another question about about the ARC. Sri Lakshmi, I don't quite understand your question. I understood you said PQ, where you are assuming that those two P and Q have not signed up to this agreement. That's what you are saying, right? Then it is not applicable for them. But I think it requires a little bit of discussion where you ask me your question, I answer. How would we do that at 4:30 so that you can ask me your question and I can give you a clarity on that? We can have an audio discussion. And I think there was also someone in the beginning who wanted to get that point. I think it was Prem, was it? Yeah, no, Gopi. So Gopi also have to take up during the break. So both of you, I'll take your questions during the break. I'll move on now to the next scheme. Next measure that is there, called as the Indra Dhanush scheme. See, in the Indian economy, there is also one more, in the Indian governance, there is also one more scheme called as the Indra Dhanush scheme, which is a vaccination scheme. So vaccination towards a lot of childhood vaccination. So that is another Indra Dhanush scheme. We are not talking about that. We are talking with respect to the banking system. Point to note is that it is a scheme which is launched by the government of India. The banks are regulated by the Reserve Bank of India, but this is given by the government of India. It is applicable only to public sector banks. It is applicable only to public sector banks. So the whole idea behind Indra Dhanush scheme is how to improve the health of the public sector banks. It's not only NPA resolution, but the idea is how to improve the health of the public sector banks. That is the idea behind Indradhanush scheme. Right? So how does it work? So there are, so you probably know what is an Indradhanush. Indradhanush means rainbow. Rainbow has the 7 colors that you know, Vibgyor and all those. So there are 7 steps to the resolution process because the name is Indradhanush. And you know how fancily Indian government names a lot of their schemes. So there's a lot of force fitting of expansions also. So what are the 7 steps? A, B, C, D, E, F, G. These are the 7 steps. A stands for, see, one of the major criticisms of government owned enterprises is that they are not very efficient because whoever is appointed to the upper management, whoever is appointed to the decision making authority as chairman and all those, they are people who have done favors with the government or who have special backing of the government, which means that it is not always, there is a claim or an accusation that it is not always people with a good reputation and people with capability who are appointed, but instead people who would support the government and do things for the government who are appointed. That is a claim that is there. Okay, so the Indradhanush scheme says that we should not have such claims anymore. We have to make the appointments more transparent, more creditable. So appointments have to be made more transparent, more based on credit, more based on the value. So how to make it more based on value? By introducing a neutral authority to do this. Okay, by introducing a neutral authority to do this. Who is this neutral authority? There is an entity created called as Bank Boards Bureau. Okay, so there is a something called as Bank Boards Bureau, which is nothing but as the name itself says, the boards of banks. So there are many 14 around public sector banks in India currently. So those public sector banks, all of those public sector banks, they'll send a representative. One of their top management person would come. Okay, they would all together form one board called as the Bank Board, Bank Boards Bureau. They will be headed by one person appointed by the government of India. So that is what is called as a Bank Boards Bureau. So when all the heads of the public sector banks come together, the intention is that all of them will work together towards the improvement of the banking sector, public sector banks, at least towards improvement of the public sector banks. So they would, based on, they are the best placed people to know who is good for a job. So whenever there is a vacancy in the top management of the banks, this Bank Boards Bureau will look at the applications and will shortlist 1 or 2 people and say, these are the best possibilities. You can choose one of these people and appoint in the vacancy. The government can choose from this list and appoint. That will remove all questions of non-transparency and people being appointed without having the necessary qualifications and all those. However, the point is that the recommendations are not binding. The government may look at it and say, I don't want any of this, and can appoint some other random person also. But at least in theory, Bank Boards Bureau will help in making the appointments more transparent. Then you have, so those are 2 issues facing the public sector banks. So that's the resolution towards that. Another issue facing the public sector banks is that because they have a huge amount of NPA, and the more their NPA, the more risky is the money that is put in their bank. To counter that risk, the banks are supposed to keep a lot of money as a reserve. To counter the risk of a potential loss, some money has to be kept as reserve, about which we'll learn a little later in the topic. So some money has to be kept as reserve, right? So which means that when more money is kept as reserve, less money is available with the bank to do its banking activities, to expand, to set up new branches and all those, which means banks require more money. Where can they get more money from? They can either get more money from the share market or directly from some other entity who wants to invest. Who would want to invest in a public sector bank? A private is not allowed to invest in a public sector bank because it's government owned. So ultimately the money has to come from the government. The owner of the banks will have to give them more money, if not from the share market. So that is what we call as, normally we call it by the name recapitalization of banks, more capital being infused into the banking system. But because if they call it recapitalization, you cannot fit it into A, B, C, D, E, F, G, because the recapitalization starts with R, right? So they are calling it as capitalization of banks. See, normally capitalization is when you do for the first time. When you raise some money for the first time, you call it as capitalization. When you subsequently do it, it is called recapitalization. But here, for force fitting into the scheme definition, they call it as capitalization. So they said along with capitalization, one more aspect which is important is what will free up more capital is that if you reduce the NPAs that are there, if you reduce the bad loans that are there, the reserves that are to be kept will also be lesser, which means more money will free up for the banks to expand. So de-stress the banking system, de-stress the public sector banks. De-stress means reduce the stressed assets. Stressed assets means bad loans, NPA, assets which are on the verge of NPA, assets which were previously NPA but now is not an NPA but in future may once again become an NPA. All those together is called as stressed assets. Stressed asset is a wider bracket than NPA. NPA is strict classification. 3 months, beyond 3 months is what is NPA. But which are on the verge of, which were NPA but not, all those will come together under the heading stressed assets. De-stress the public sector banks. Now the expansions are going to get a little more interesting now, so that this resolves one set of problem, the first two, the next two resolves another set of problem, the next three will resolve another set of problem. One major issue a lot of banks feel that they have, a lot of public sector banks feel that they have, is that they don't have the power to take any major decisions. The moment they go and try to recover some money from the people, the government steps in and says, no, that is my vote bank, don't go there. Go somewhere else, go do something else, don't recover the money from them, I'll lose vote, or whatever it is. They will not explicitly say that, but yeah, that is the understanding. So the banks claim that they don't have enough power. So E is not, I mean, power doesn't start with E, so you add an E in front of it and you say empower. Since power doesn't start with P, add an E in front of it. Similarly, okay, similarly, we have all heard this famous dialogue, right? With great power comes great responsibility. With great power comes great responsibility. Once again, R is not there. So they say because we don't R, it has to start with F. So very brilliantly, they said with great power comes great accountability. Now we wonder how is accountability starting with F. So we try to put an F in front of it. It won't read well. Don't try to read that together with an F in front of it. Not a. So what they do is they said we'll create a framework of accountability. So we will create a framework of accountability. So that is what is F. In reality, it is actually A with an F in front of it. So great power, with it came responsibility, which is to be read as accountability, but a framework of it. And then ultimately, in addition to all these, to prevent the banks from going back. So this will all help the bank get back into good shape. But to maintain the bank in good shape over a long period of time, what is required is proper governance structure. So improve the governance in the banking system. So it is due to the lack of governance that the issue that happened with Punjab National Bank happened, where an employee of the bank itself granted a loan to Nirav Modi, but outside of the banking system. Granted a loan with even the RBI not knowing that such a loan has been granted, such a guarantee has been given by them. So improve the governance. So that will resolve a lot of issues in the banking system. This is Indradhanush scheme. Okay. So this is applicable only to public sector banks in India, because government owned banks. So these are all the existing schemes in the Indian economy to resolve the NPA crisis and to improve the banking system as a whole. There are a couple of schemes which have been in the discussion for a long period now, 4, 5, 6 years now, but they have not been implemented. The first of those is what we call as bad banks or bad bank, creation of a bad bank. So this idea was mooted by the Reserve Bank of India, where they said, we'll create one bank whose only purpose is to resolve NPAs. One bank which will buy the NPAs from all other banks in the system and free up those banks so that they can go and create more NPAs. Don't write that. So that they can grow and contribute to the growth of the nation, while this one bad bank will take up all those bad loans and try to resolve it, try to find solution to it. In a way, very similar to an asset reconstruction company, but they'll function as a bank. The rules of the bank will apply. They'll be under the Reserve Bank of India. That was the idea behind a bad bank. Bad bank because all their assets are bad. All right. But it did not come into reality because a very important question which everyone forgot when they gave this idea was that where will the bad bank get the money to buy all these bad assets? So that became a major problem. When that became a problem, obviously, who has unlimited supply of money in the country? Don't say Ambani or Adani. It is the government of India which has unlimited supply of money in the country. So government said, we will probably consider. So someone suggested, government didn't say it, someone suggested maybe the government should take up these bad loans and set up an organization to resolve it. So something called as PARA, Expansionist Public Asset Rehabilitation Agency. Public Asset Rehabilitation Agency. The only word that is different here is the word public, which means it is government owned. Other than that, it is nothing but asset reconstruction company by a different name. That's all. An asset reconstruction company owned by the government is what is called as a public asset rehabilitation agency. Just to give it a different name so that people don't realize that it is the same concept as earlier. It looks like some new theory which was never thought of before. So public asset rehabilitation agency. It is in suggestion, works very similar to an ARC, works very similar to a bad bank. The only difference is government owns it. Government owned company whose only role is to buy all the bad assets and try to resolve it. While the banks are free to make India shine again. Okay. Moving on. So that ends our discussion on the various resolution mechanisms. Okay. So a couple of questions that we need to address. Number one, with respect to NPA in India, in the Indian banking system, we ask a question, who has maximum NPA in India? Is it the public sector banks or is it the private banks? Even without a lot of thought, you would probably be able to answer that it is the public sector banks which have the maximum NPAs in India. So you can even easily sit and criticize saying that public sector banks are inefficient, they are not good with their governance, they are not transparent. That is the reason why, and they have an understanding with a lot of business houses. That's why they are not trying to recover the money. They don't have accountability because it is not their money, it's not their company. Even if it fails, the government is always there. All these criticisms could be there, and all these are valid as well. But we need to understand the other side of public sector banks as well. Even today, if we are trying to open a bank account, if we are thinking of opening a bank account, a very high percentage of the population will first think, let us open an account with the public sector bank, not with the private bank. What if the private bank fails? What if the private bank shuts down? What is the guarantee for the money? I trust that the government will always take care. If it is a government bank, if the bank fails, the government will come and take care of that situation. The government will pay back the money for me. I am not afraid of a public sector bank failing. I am afraid of a private bank failing. It's a possibility. So most 80% of the deposits, 80 to 85% of the deposits that go into the banking system in India go into the public sector banks. Deposits. When 80% of the deposits go into the banking system, then obviously they are the ones who will have the capacity to give loans. So 80% of the loans given by the banking system are also from the public sector banks. When 80% of the loans are given by public sector banks, there is a very high likelihood that the percentage of loans which are defaulting, you see, you are trying something only 2 times, someone else is trying it 10 times, the likelihood of failure for that person is going to be higher because they are trying it a higher number of times. You are only trying 2 times, so you may not fail even once. They are trying it 10 times, they may fail 2 or 3 times. If you tried 10 times, you might also fail 2 or 3 times. Similarly, public sector banks, because they are the ones giving maximum loans, they also tend to have a higher NPA percentage than private sector banks. In addition to that, if the public sector banks were not there, a lot of people who are accessing loans now, poor segment of the population, farmers, MSMEs and all those, they would probably not get loans, not get sufficient amount of loans, because private sector is always thinking of how not to give loans to these people, because the likelihood of getting back the loan is low, the interest rate may be low. Whereas public sector banks, because their primary objective is not how to make profit, they are saying, okay, fine, they require money, we will give. If not us, who will give? Okay, so that is the ideology. So that is also another side of it. Without public sector banks giving such loans, how will they ever get money? So that is also another reason why they have a very high NPA. So when we are criticizing, we can criticize public sector banks for all their failings, which we have discussed so far. But we also have to take into consideration the service that is provided by public sector banks, which cannot be met by private sector banks. Even today, you step out of the metros, you go outside, maybe 8 out of 10 banks that you see will be public sector banks. You go to villages, if you find one private bank, that itself is a big thing. If it is there, it will be there because there is a constraint by RBI that every 4th branch that is started has to be in a rural area. So that is the reason why a private entity may have a branch in rural areas. Otherwise, they may not even start in rural areas. So that is the understanding of the concept behind public sector banks and why they have so much of risk. Okay, so that ends our major topics of discussion in banking. Now we'll go to the peripheral areas, other extra areas that is there. So first we'll talk about international banking norms. While talking about that, we'll first talk about one particular body called as Bank for International Settlements. BIS. It is a bank based out of a place called as Basel in Switzerland. This Bank for International Settlement is like a bank in which all the central banks of various countries like Reserve Bank of India, Federal Bank of USA and other banks, they are all members of this Bank for International Settlements. Okay, it is not that they are the regulating authority of international banks, but they just are of central banks of the countries. They just facilitate the transactions between these international banks. How to bring about an understanding between the various central banks, between the Federal Bank and the Reserve Bank of India, how to facilitate the understanding. They themselves may not give loans. Nowadays, they do give some support loans, but that is not their primary objective. Just like how Reserve Bank of India is not primarily a bank, they are a regulating entity. Similarly, Bank for International Settlements is not primarily a bank. They are a facilitating entity. They facilitate smooth transactions of among the central banks across the world. That is what is Bank for International Settlements. Okay. So now Bank for International Settlements is there. We are not going to go any deeper into it and study. Inside it, there is a committee called as Basel Committee on Banking Supervision. In addition to the facilitation of international banking, they also say for a bank to be working in a healthy manner. So BCBS. For banks in a country to be working healthily, the Basel Committee on Banking Supervision has given a set of guidelines saying that if a bank in your locality is following these in your country is following these set of rules, then those banks are in good condition, are in good health. That is the idea behind the Basel Committee on Banking Supervision. They give certain norms which are collectively called as Basel norms. So there are three variations of this. So Basel norms 1, Basel 2 and Basel 3. Basel 1, Basel 2, Basel 3. Basel 1 was first released in 1988, Basel 2 in 1998 and Basel 3 in 2008 in the backdrop of the global financial crisis. Okay. These were when the norms were released. Just because they release the norms, it doesn't mean that countries across the world will start immediately following it. For example, India is still following Basel 2. Although Basel 3 was released in 2008, the norms are so strict that RBI has still not implemented it. Indian banks are not yet in a position to implement Basel 3. Okay, we have been trying to over the last 2-3 years, but our NPA crisis has made it in such a way that we have not been able to. And now with the COVID pandemic, we were supposed to in 2018, then push to 2019, then push to 2020. Now it looks like maybe 2022 is the earliest that we can think of doing it. We don't know the extent of NPA currently in the economy because of all the COVID situation and the suspension of NPA. Currently, the classification of NPA has been suspended. I told you in 3 months it has to be classified as NPA, right? But they gave a moratorium saying that you need not repay your loans, which means that the classification of assets into NPA has been suspended for the time being. So we don't know the extent of NPAs in the banking system currently in India. Okay, so those are Basel norms. Now again, we are not even going to go into the depth of all Basel norms. Specifically, one particular aspect of Basel norms is what we are going to discuss, which is common to Basel 1, 2 as well as 3, something called as capital adequacy ratio, shortened as CAR. Capital adequacy ratio, shortened as CAR. So the name itself suggests, do you have adequate capital? Why would we require adequate capital? To deal with the potential stress in the banking system, to deal with potential NPAs in the banking system. Do we have adequate capital? That is the question here. So capital adequacy ratio is equal to, so the idea is that if you have a certain value of risky assets in your banking system, a certain proportion of that you need to have as reserve, as capital, reserve capital. That is the idea there. That is the idea behind capital adequacy ratio. So the Basel norms will say a bank should have a minimum capital adequacy ratio. Let's assume, I'm not giving you the actual number. Let's assume the capital adequacy ratio target is given as 10%, which means if your risk weighted assets, if your bank has a total risk weighted assets of a certain value, then 10% of the value of the risk weighted assets has to be maintained as capital. Has to be maintained as capital. So capital adequacy ratio means for the risk that is there in your banking system, do you have adequate capital? But going by the definition, this capital adequacy ratio is also called by another name, capital to risk weighted assets ratio. CRAR, capital to risk weighted assets ratio. CRAR and CAR both are one and the same. These are two different ways of referring to the same concept. Capital adequacy ratio or capital to risk weighted assets ratio both mean the same. Right? So how does this work? Okay, how does this work? First of all, we need to understand what is risk weighted assets. How can assets be weighted for risk? And the second one is, what about capital? Okay. Now, we'll first start with risk weighted assets. Start with risk weighted assets. So let's assume, let's first talk about assets. What are the assets of a bank? The assets of a bank are the loans that it gives. Let us consider few types of loans alone. Let us consider agricultural loan. Okay. Let's consider education loan. Let's consider a business loan, or wait, not a business loan. Let's consider a, let's not consider, I just want to bring in different levels of risk. Let's consider a business loan. Let's consider a housing loan. And let us consider a government loan. Okay. These are four kinds of assets which a bank has. Let us say the value of these assets. Let's say agricultural loan is rupees 1000 for a bank. Let's say it is rupees 1000. Business loan is rupees 1000. Housing loan is rupees 1000. And government loan is rupees 1000. Now let's get clear. Agricultural loan given to farmers for the purpose of agriculture. Business loan given to business people for the purpose of business. Loan given to people to build houses. Loan given to the government in the form of government securities, T-bills. That is what is government loan. Okay. Now let us say this is the loan that is given. Now we have to look at a question. What is the risk associated with these loans? For example, for the loan that you have given to the government, is there any risk? For a bank, there is absolutely no risk because it knows it will get the entire money and the interest back without any doubt. That is the level of trust that we have, which means there is 0% risk associated here. Okay, let us say there is a housing loan. Okay, housing loan, there is a possibility that some money would be lost if they don't pay the money. But if it is a house which has been built because the land is there, because the house is there, even if the loan is not repaid, the bank can seize the property and get the money out of it. Okay, so which means that although there is some risk, the risk is minimal. Even if there is a loss, the loss could be minimal, which means that they'll say there is, let's say, a 20% risk associated with it. Okay. With respect to business, let us say it is even more risk because it is the business which is at stake here. So let us say there is 50% risk. Okay. And for the sake of example alone, not the reality, for the sake of example alone, let's assume agriculture being monsoon dependent, there is a lot of variability there. So all those, and plus in agricultural, in the case of agricultural loan, the banks have been banned from seizing agricultural land. Agricultural land cannot be used as security because that is the source of livelihood for them. Because of all these reasons, let us say there is an 80% risk associated with this. Okay, let's assume this is the scenario. Now we ask, what is the risk weighted asset? What amount of the asset is risky in nature? The total assets of the bank is equal to rupees 4,000. But if you look at risky assets, out of the 1,000 rupees, 800 rupees is at risk. Out of the 1,000 rupees given as loan, 800 rupees, which is 80% of it, is at risk. 200 rupees they'll definitely get back. 800 rupees is at risk. Business loan, out of 1,000, 500 rupees is at risk. Okay. Housing loan, out of 1,000, 200 rupees is at risk. 800 rupees they'll find a way to recover. Government loan, there is nothing at risk. Zero risk. None of the money is at risk. So we'll say total 1,500 rupees is the risk weighted assets. Out of the 4,000 rupees, which is the asset of the bank, 1,500 rupees is risky in nature. There is a possibility that it may not come. There is no guarantee that this will not come. We are not declaring that this money will not come. A lot of this money will come back. We are saying maximum worst case scenario, this much amount of money we may lose. But we cannot account for the entire worst case scenario and keep the entire money in reserve. We cannot say we might lose 1,500 and we'll keep 1,500 as reserve. That is not possible, because then the bank will not be able to do any business, which is why they say if 1,500 rupees is at risk, if 1,500 rupees is at risk, you have to keep 10% of that as reserve. What is 10% of 1,500? 150 rupees we'll keep as reserve. So the banks have to maintain 150 rupees as reserve. This is what is calculated. This is a given for a bank. A bank, based on the loans it has given, has a certain risk-weighted assets. The RBI will tell how to risk-weight assets, what is the risk associated with each assets and all those. The RBI will tell. Based on that, they calculate risk-weighted assets. And then based on the risk-weighted assets and based on the capital adequacy ratio, which is given by Basel. But Basel, just because it says Basel norm, because it says it is not applicable to banks, because banks are not controlled by, banks in India are not controlled by BIS. Banks in India are controlled by RBI. So the Basel will dictate what is the ideal CAR. But if the RBI agrees and says, okay, we are going to consider that and we are going to impose Basel III, and if Basel III says 10%, then it becomes the responsibility of the banks to maintain 10% as capital. If the RBI says, no, we are not following Basel III, we are following Basel II, and in Basel II, the target is only 8%, then only 8% needs to be maintained. Then only 90 rupees needs to be maintained. It's not 90, sorry, 120 rupees needs to be maintained. If it's 8%. Okay, that is how it will vary. Basel norms, they dictate what is the ideal reserve, but they are not automatically applicable to the banking system in India. For it to be applicable, the RBI has to say you have to follow these things. See, the BIS does not have any authority over RBI. RBI is completely independent. Don't have any confusion about it. Similarly, the BIS has no control directly over the banking system in India. RBI is the one which decides all these things. But the idea is given by your Basel norms. Okay, so this 150 is the capital that is required to meet this. And the higher your risk-weighted assets, the higher will be your capital requirement as a reserve, which means that the lesser will be the amount of money that is available with you for usage. Now notice this. If the NPAs are high, the denominator, risk-weighted assets, would be high, correct? When the risk-weighted assets are high, more capital needs to be kept idle, which means more capital needs to be infused. This is the reason why, in addition to infusing more capital, you also need to de-stress the banks, reduce the risk in the banking system, reduce the risky assets in the banking system. That is the idea behind Indradhanush scheme. Okay, so this is the concept of risk-weighted assets. Now, I'm not going to go into unnecessary depth here. I'll just give you a general idea of what is this so-called capital. What is the capital? The capital itself is divided into tier 1 capital and tier 2 capital. Tier 1 means upper quality capital and lesser quality, higher quality capital and lesser quality capital. This is higher quality capital, this is lesser quality capital. What do you mean by higher quality and lesser quality? See, the rules in Basel norms, capital adequacy ratio say 80% of the numerator has to be from tier 1, only 20% can be from tier 2. And why are we calling tier 2 to be lesser quality capital? Because tier 2 capital is not easily accessible. Tier 1 capital is easily accessible capital. If the bank immediately needs to repay, it can take out of tier 1 and pay. But taking out of tier 2 is not as easy. If they take money out of tier 2, the bank itself may have to shut down. So when the bank shuts down, and finally they are saying, where all did we keep some money? You would have hidden some money here, there, all that you take it and you give it. That is when you can access tier 2, which is why we call that as lower quality, because it is not easily accessible. Okay. So this is what your capital will be. What is tier 1? What is tier 2? I'll just introduce the concepts to you. Tier 1 consists of equity capital and disclosed reserves. Now, what is equity capital? Equity means the ownership money of the company. That is what equity means. Equity means ownership money of the company. So when the company was started, for the company to run, there is a certain amount of capital which is invested. That capital could be considered as equity capital. Similarly, the company generates some money from the share market also, which is again in the ownership money of the company. That is also equity capital. So there are two classifications. Equity capital could be paid up capital and share capital. Paid up capital is money generated from the original owners, the actual decision makers of the company. Paid up capital is the capital that is invested by the original owners or the decision makers of the company. Share capital is the money generated from the share market, who are also owners, but they don't have decision making authority. They only have profit sharing role. So that is equity capital. Equity capital is ownership capital, okay, in which paid up capital is the money which is given by the decision making entities, the major owners of the company. That is paid up capital. The ones who initially invest money saying that I am going to run the company, they don't go to the share market and get the ownership. They are the ones who start the company or who later join as partners in the company. Share capital is the money that is generated by the company from the share market. Both these people get ownership, but only the paid up capital have controlling authority. No, Sri Lakshmi, it is not like preference shares and equity shares. Equity shares itself means you are going to the share market. So that's a terminology with respect to the share market. We are not talking about share market. Paid up capital. See, equity is a general term we are using, not in the context of shares alone. The ones, okay, let us say I gave the example of I started a business with 10 lakh rupees, right? I started a business with 10 lakh rupees. I am getting 10 lakh rupees from the share market. The money that I initially put in, that is the paid up capital. The money that I get from the share market is the share capital. Now, let us say I did not go to the share market at all. I put in 10 lakh rupees and later to expand the business, I get a friend of mine to come and invest 10 lakh rupees in my business. Then both the 10 lakhs will come under paid up capital. There is no share capital because I didn't go to the share market. But these two together, share capital and paid up capital together, is what is called as equity capital. When we are talking about share markets, that's in a different context. Their equity share refers to in the share market what happens. We will not go into that at this point of time. We will stick to this understanding. Then we have concept of disclosed reserves, which is nothing but there are certain reserves which are mandated by law, which the bank declares we are keeping these reserves and they keep it. Example, CRR, SLR. This should account for 80% of the numerator. Now coming to tier 2 capital. Tier 2 capital, number one, any undisclosed reserves that are maintained. See, why are undisclosed reserves maintained? Bank may feel of its own judgment, it may feel that there is a certain slightly higher risk in our banking system. So RBI asks us to maintain certain reserve. In addition to that, we will maintain some reserve of our own. But they may not declare it outside, because if they declare, it is an acceptance of possible higher risk. They don't want to risk all those things. They say we will keep a reserve. We need not tell anyone. We will have in our account books, no problem, but we won't declare it out to the public. It is a company strategy, so they don't need to reveal it. Undisclosed reserves. Similarly, something called as general loss reserves. General loss reserves. They might have some reserve saying in case of some accidental fire or accidental loss or something like that, we'll get some money from insurance, but insurance won't cover 100%. So to account for that, we'll keep some amount of money called as general loss reserves. Plus, there is an interesting concept here, something called as subordinate reserves. Subordinate debt reserves. You remember in inflation chapter towards the end, I told you about prime lenders, prime lending rate. Certain customers are called as prime customers because they are the most important customers. Then the opposite of that is subordinate customers. Subordinate is they are not very important. They are the least important type of customers because they barely take any loans. They give very small amounts of deposits. So those kind of depositors are called as, or customers are called as subordinate customers. So when a bank is about to shut down and money has to be repaid, whom will the bank pay first to? The bank will obviously prefer to pay to the prime customers because they are the ones who contributed. But that would mean the subordinate customers are ignored. To prevent that, rules mandate that certain amount of money has to be kept aside specifically to give back to the subordinate debt holders. So that is what is called as subordinate debt reserves or subordinate reserves. So all these are small levels of capital which are not commonly used, which are not commonly discussed. It is there in some corner. It is not easily usable. That is why it is a lower quality capital. Only 20%. Let us say in the case of 150, okay, in the case of 150, 80% of that would be 120 rupees. Okay, and 20% of that would be 30 rupees. Correct? I told you 150 has to be the numerator, right? In the earlier page. So 120 rupees has to be in the form of tier 1 and 50 rupees in the form of tier 2. Let us say you add all these reserves of a particular bank, they have 50 rupees. Even if they have 50 rupees, they cannot take the entire 50 rupees. They can only take 30 rupees as tier 2 capital. The remaining 120 has to be in the form of tier 1. There are internal constraints as well like that. Okay. So that is the concept of capital adequacy ratio. So this formula itself you can rewrite as capital adequacy ratio is equal to tier 1 capital plus tier 2 capital divided by risk weighted assets. Where this is 80%, this is 20%. Today, since the class is till 8 o'clock, can I take the class for another 10 minutes and then give you a break so that the second session doesn't become too long? I hope that's okay, because otherwise second session alone may become really long. Okay, I'll try to finish this chapter. Supposed to finish a long time back, but I'll try to finish this chapter and then we'll take a break. All right. So now expanding on the capital adequacy ratio concept. Okay. So if the now coming to the Indian banking system, we'll ask a question. How do Indian banks meet the capital adequacy ratio? There are two types of banks in Indian banks: public sector banks and private banks. Okay, we'll not worry about the foreign banks. It is their concern. They'll very small share of it. But public sector banks and private banks, how do they meet the capital adequacy ratio? We'll first talk about the private banks. Private banks have been reasonably successful in meeting their capital adequacy ratio targets. It is the public sector banks who have struggled to meet capital adequacy ratio, which is why the government is having to do recapitalization or writing off of assets or something of that sort. The government is continuously having to do. So let's look at how they are being successful. Why is it that private banks are successful in meeting the target? Does it indicate really good health of the private sector banks? We will see. Okay, private sector banks have a few options, or any bank has two options with respect to meeting capital adequacy ratio. You can meet capital adequacy ratio either by increasing the numerator or by decreasing the denominator. Either way, you can meet a capital adequacy ratio target. Let us say the target is 10% and the current value is 8%. You can increase the 8 to 10% either by decreasing the denominator or by increasing the numerator. Okay. Private sector banks, let us look at the numerator. So these are the various items in the numerator. This is ruled out because this is, I told you, least important. So they cannot target this. They can only target tier 1 capital. CRR SLR is also declared by the Reserve Bank of India, so they cannot increase that. If they increase that, that will go into undisclosed reserves. So that doesn't work. The only option they have is either to increase the paid up capital or to increase the share capital. If a bank is not able to meet its capital adequacy ratio, it means that the bank is not necessarily in good health. If they are not in good health, why would any investor come and invest further money? So their ability to raise paid up capital is limited. Their ability to raise paid up capital is limited because they are not a very successful bank. Why would anyone come and buy? When no one is willing to buy here, in the share market also they'll face a similar situation. Why would any investor invest in shares of a company, of a bank which is not performing well? So they may not be able to get money here also, which means that for a private bank which is not performing well, their ability to increase their numerator is not high. They cannot increase their numerator significantly, which means they are forced to now reduce the denominator, which means that they will stop giving out loans altogether, or to a large extent. Instead, they may say, instead of giving loans to the people, I'll give loan to the government, I'll give loan to some safe entities. So all that is what these banks will do. So just because private banks are meeting their capital adequacy ratio, it may indicate the good health of a bank, but it is not necessarily good for the Indian economy, because people are not able to access loans from these banks. You go to a private bank, you may not be able to get a loan because they are afraid to give loans, risky loans, because they have to meet these targets. So when private sector banks, you find that they're meeting their capital adequacy ratio, it is not necessarily good for the economy, because they are not taking risks. They are risk averse. Now, public sector banks cannot afford to decrease the denominator. Now, I'm not saying that they cannot reduce the risk or bad loans, but they cannot just stop giving risky loans. They cannot stop giving loans to farmers. They cannot stop giving loans to MSMEs. Government implements most of their schemes through these public sector banks, right? So they do not have the option of reducing the risk-weighted assets significantly. So which leaves them with only two options, either paid up capital or share capital. And once again, if a public sector bank is not doing well, you're not going to get a share of the profit, because the bank is not making a profit. People will not invest in shares. That is ruled out, which means that the one and only option available is to get more paid up capital. Getting this more paid up capital is nothing but recapitalization of public sector banks, which is what we have been talking about in Indradhanush scheme as well. And in the news also, we have been seeing recapitalization of banks. That is how banks are able to meet the capital adequacy ratio targets, public sector banks. Okay, that is analysis of the Indian banking system as well, Indian banking system and capital adequacy ratio. A few more topics to discuss. Number one, there is something in the economy, in the system, banking system, called as prompt corrective action. Now, I'm not going in any particular order. I'm just giving you random terms and explaining it to you, because all the topics are over. Just like capital adequacy ratios about international banking, then within the Indian banking system, there are certain terms that we come across. I'm going to, in no particular order, introduce those terms to you. So there is something called as PCA, or a prompt corrective action, which is imposed by the Reserve Bank of India on certain banks from time to time. What is prompt corrective action? In Narasimhan Committee recommendations number 2, we came across a usage called as narrow banking. Narrow banking. At that time, I had told you there is a concept called as PCA, about which we'll learn in the end. So what is narrow banking? Where the Reserve Bank of India steps in and tells a bank, you know what, you are in an unhealthy position. I am not going to allow you to give any type of loan. You have to be very careful about the kind of loan that you give. I am going to monitor the kind of loan that you are giving. Your scope is going to be very, very restricted. The kind of banking activities that you are allowed to do will be very, very restricted. That is what is called as narrow banking or prompt corrective action. Because you are not doing it well on your own, I am taking some corrective measures. That is prompt corrective action. Okay. Now, what is inside this prompt corrective action? What are the points inside this prompt corrective action? So, on what basis does RBI implement this? Number one, they look at the non-performing assets. Okay. They look at the quality of the assets. They look at the non-performing assets. The bank should not exceed the target percentage. The RBI mandates a certain target percentage, saying not more than 5% or not more than 8% of your assets should be in the form of NPA. If it's more than that, you are unhealthy. You have to maintain your NPA ratio, percentage of loans as NPA, below that particular value. So should not exceed the target percentage. Second, capital adequacy ratio, adequacy of capital is the second heading, should not fall below target percentage. So the RBI says capital adequacy ratio is 12%, let's say. Let's say RBI says target capital adequacy ratio is 12%. The banks should not have their capital below 12%. It has to be 12% or more. So if it falls below 12%, it means the bank is unhealthy. The bank is at risk. Number 3, profitability. So this is called as return on assets should be positive, which means the return on assets means that the assets are the loans that are overall loans of the banking system. The returns on that means the interest earning, which means overall the bank should not be in a loss scenario. The return on assets should be positive. The bank should be facing or having profit every year, even if it is minimal. It should be in a profitable. It should be working in a profitable setup. So that is what. If any of these three, not all of these three, if any of these three is not met, the RBI may choose to impose prompt corrective action. The RBI may choose to impose prompt corrective action. Next one we have is something called as banking ombudsman. So what is this concept of ombudsman? Ombudsman is any entity who's acting as a sort of a judge or a neutral regulator. It is equivalent of the consumer forum that we have with respect to normal stores. You go to a store, you buy a shirt, you come back home, you find that there is a damage in the shirt which you had not observed earlier. You go back to the store, you go to the store manager and say there is a damage here. If the store manager replaces it, good, no problem. If the store manager says, I don't know who you are, there is no proof that you bought from here, you show the receipt, says, I don't know, there is no option of changing it, it is your fault. You say it is manufacturing fault, they don't listen. You have an option of going to the consumer forum. You can take the store to the consumer forum and you can get your issue resolved. Okay, so if they resolve your issue, you don't have to go to the consumer forum. If they don't resolve, then you can go to the consumer forum and you can get your issue resolved. Similarly, if there are issues with respect to the banking system, what are the sort of issues? You go to a bank, the bank is supposed to be working from, let's say, 8 a.m. to 8 p.m. That's what they advertise. But you go at 9 o'clock, they have still not opened. They open at irregular times, or they close down the bank at 6:30 and go when they said that they'll work till 8 p.m. So that is an issue. You go to an ATM, you will never find money in that particular bank. You have your own account. The bank is preventing you from accessing your account, saying we cannot give you your money. Whenever you try, it says no balance, but you have balance in your account. Okay? Or they have unfairly deducted some money from your account for no reason that you're aware. They have deducted money from your account. So under any of these circumstances, or they have behaved very rudely with you, in any of these circumstances, you can get in touch first with the bank manager. Whenever you have an issue, your first line is, so a bank customer, if they have an issue, you can go to a bank manager. If the bank manager provides a resolution to you and you're happy with it, no problem, end of story. But if the bank manager's resolution to you is not satisfactory to you, you can directly go to this person called as banking ombudsman. Ombudsman is like the neutral entity here. This banking ombudsman is someone who's appointed by the Reserve Bank of India. There are about 20, I think there are 20 banking ombudsmen all over India, which means that you cannot physically go and access the banking ombudsman. You just write an email to them and they will take up the issue along with the complaint number and all those. You have to write an email. So they'll trace the complaint number, they'll look at what the issue is, they'll try to resolve the issue for you free of cost. free of cost. They'll try to resolve the issue for you. So that is the concept of banking ombudsman. Now, this was introduced in 1998, banking ombudsman. Of late, there has been a drastic increase in the number of cases which go to banking ombudsman, which meant overloading of banking ombudsman, for which last year, the RBI introduced another scheme, not last year, not 2020, 2019, the RBI introduced another scheme called as internal ombudsman. The RBI mandated all banks to appoint an ombudsman internally. The bank itself would appoint an ombudsman, which cannot be a bank employee because it has to be neutral. The bank will appoint a neutral entity as an adjudicating authority here, but the customer does not have access to internal ombudsman. The customer does not file a complaint with the internal ombudsman. The customer raises an issue with the bank manager. The bank manager now does not directly provide resolution to the customer. The bank manager provides a resolution which will go to the internal ombudsman. The internal ombudsman will view it. If the internal ombudsman is not happy with it, will correct it to whatever is required, and then it will come to the customer. If the customer is not happy with this also, the customer has no connection with the internal ombudsman. The customer cannot directly go and meet the internal ombudsman. There is no such possibility. It just improves the resolution provided by the bank manager. If the customer is not happy, the customer still can go to the banking ombudsman that is appointed by the RBI. Now you might ask a question, if this internal ombudsman is appointed by the bank, won't they always favor the bank? To prevent that from happening, an internal ombudsman, although he or she is appointed by the bank, can only be removed by the Reserve Bank of India. So they can work without fear of removal of office. They are appointed by the bank, they can be removed only by the Reserve Bank of India. So that is the concept of banking ombudsman and internal ombudsman. Banking ombudsman is applicable to all types of banks in India, but they are applicable only to banks. There are other ombudsmen for all the loan related issues of non-banking financial companies. There is a separate NBFC ombudsman. For all issues related to digital payments and all those, so there is a digital payments ombudsman. So these are separate, under different laws they have been appointed. Banking ombudsman is applicable only to the banking sector. Okay. Coming to the last heading that we have, what is NBFC? What is a non-banking financial company? First of all, a non-banking financial company is a company, which means that they are set up under the Companies Act. They are not set up under the Banking Regulations Act. They are not set up under the Banking Regulations Act. Banks are set up under the Banking Regulations Act. Companies are set up under the Companies Act. They are companies which are set up under the Companies Act, but they predominantly do financial activities. What are financial activities? Financial activities could be giving loans, taking deposits. It could be investing in shares. It could be being active in the share market. It could be chit fund companies. Any of these could be financial companies. Okay. So how can you classify a company to be a financial company if 50% or more of their assets are in the form of financial assets? Financial assets could be cash. Financial assets could be insurance. Financial assets could be shares. If 50% or more of their assets are in the form of financial assets, then such companies are called as non-banking financial companies. Examples are mutual fund companies, your investment banking companies, then you have your chit fund companies, Nidhi companies. All these are examples of non-banking financial companies, because they are not involved in production of any goods. They are only providing services where money itself is the backing. You give money to LIC, insurance company, or any health insurance company. They take money from you. What are they doing with that money? Are they producing something? Are they making any product? No. They are making payment to people when there is a health related issue or life related issue. That is all that is happening, which means what will they do with the money? They will use the money to give a loan to someone else or some other activity like that, which is a banking type activity. So which is a financial activity, that is, but they are not a bank. That is why they are called a non-banking financial company. Non-banking financial company, the entire topic about that is like an ocean. There is a lot to learn about it. We will not be able to do it in class. We don't want to do it in class either. But if you are really keen on understanding what is an NBFC, some questions that you may have about NBFC, to understand the organizational structure, who regulates the NBFC. Some NBFCs are regulated by RBI. Some NBFCs are regulated by SEBI, Securities and Exchange Board of India. Some NBFCs are regulated by state government, like chit fund companies. Some NBFCs are regulated by Ministry of Corporate Affairs, like Nidhi companies. Right? So to understand all these things, there is a source for you. Go to Google and type NBFC RBI FAQ. Reserve Bank of India has given a list of about 80 questions, 80 frequently asked questions on NBFCs. This will provide you a link. The first link that you will find with the RBI, official RBI website, that will give you the entire list of questions. Please do not read the entire list of questions and their answers. You will lose your mind. Just pick and choose the initial few questions and then scroll through whatever information you find to be relevant for you, whatever you can remember in the long term, read only that. Scroll down to the end. Towards the end, you will find a couple of charts which will give you the organizational structure. Just read only these. Not anything more than that is required. Okay, that is with respect to the banking chapter. Okay, so we have completed the discussion on the banking chapter. We will move on to the external sector next. So we will do that after a break, 5 o'clock. Can we come back at 5:20 or do you want to come back at 5:30? The class will go till 8. There's no change in that. Your call, 5:20 or 5:30? Waiting for a response. Smartly, people on video are giving me a blank face. Okay, 5:30 is the general answer. All right, fine. Then 5:30 it is. We'll come back at 5:30. People who have further questions, who want to stay back and ask me questions, can stay back. The others can disconnect and leave and come back at 5:30. Okay. Gobi had a question. Sri Lakshmi had a question. Anyone else has a question can ask me. Meanwhile, in the chat box, there are a couple of questions that came in. Okay. Can you go back to the previous slide for profitability definition? Yes, I can, Magesh. So those who want to talk, those who want to ask questions can raise your hand. Or register it online through CMS portal. Okay, I think that's about Ombudsman, I think. Thank you for that, Rini. Yes, Sri Lakshmi has raised her hand. Yes, Sri Lakshmi, go on.
So the question is regarding that you said that intercreditor agreement, right? So
yeah.
The phrase that you used is it's not case by case. So that's where the confusion is, because suppose in the first case we have five banks A, B, C, D, E, and you said whichever is the highest exposed bank, that will take the decisions.
Correct.
Suppose in the second case also it's just the same 5 banks only, but what if the contribution is different? What if there is maybe C or D, which is the highest exposed bank? In that case,
what is the two condition that you have written in your notes of intercreditor agreement?
It should be the highest exposed bank, and then 66% of the exposure. We should get the 66% of the exposure.
Correct. If C is the highest entity with the highest exposure, then C will be the one which will be dictating the plan.
So in that case, it's actually case by case, right? Because there will be very less cases. Yeah.
Go on.
So there'll be very less cases where it is the same banks that is contributing to it, and in the same order of contribution. So that's like very rare scenarios, right?
Okay. I think the issue here is that I was not very clear probably about what I meant by case basis. What I meant there is that this concept of inter-creditor agreement is a very generic agreement where the agreement only says this much. Whoever has the highest exposure, they will give the plan. And for the plan to come into effect, it requires agreement from banks with 66% exposure. That agreement is not case to case basis. That agreement, see, it is not like I am going to give a consortium loan now, so I am going to get into an agreement now. So it is not that bank A can choose to be a part of the agreement in one deal and not part of the agreement in another deal. That is not possible. As a bank, if you agree to that agreement once, that agreement is applicable for all the kind of loans that you give. Either you agree to it and be a part of that intercreditor agreement, or you are not a part of the intercreditor agreement. That is what I meant is common across the banking sector. It is not case by case basis. That is what I meant by that. You cannot choose to be a part of the intercreditor agreement in one particular deal where you are the majority contributor, and in another deal where you are a minority contributor, you choose to be out of the ICA. That is not allowed. That is what I meant by that.
So in that case, if a bank choose not to be part of it, I mean, he doesn't. That
can never
bank
be a
doesn't have
part
a
of it.
choice only, right? Then in any of the cases, it's like he's out of it. The
Correct.
bank's out of it.
So if the bank wants to be a part of it, it has to sign, and it always has to be a part of it.
Thank you.
So if a bank doesn't sign, what can happen is that that bank may be isolated by the other banks. No one may want to get into a consortium with them because they are like a non cooperative bank. Or maybe a few banks which have not signed at all, they alone will form a consortium and start giving loans. That's a possibility. This agreement is actually beneficial to everyone, so everyone will agree. Mostly they'll agree, because somewhere or the other they would be a major contributor. Okay.
Yeah.
All right. Gobi, are you there? Gobi Jagan. If you're there, please raise your hand if you have a question. No, bad bank has not come into force yet, Karan. It is just a concept that is spoken about, but it is not implemented. So I'm not getting any response from Gobi Jagan. Maybe he has gone for a break. Probably I'll take it up once the next session starts. So I'll disconnect and leave then. The others can also disconnect and leave if you want to. If you don't want, if you want to save your internet, and you can re-log in and join again. Thank you so much. We'll see you again at 5:30. I'll not be able to read your messages that you sent to the host. I'm just waiting to get it. That's why I'm just sitting here. I don't know if the host is still there. I'm trying to get it. Once that is done, I'll take up questions if you have any. Yet to get it. Just 1 second. Okay, guys, am I visible, audible? Can you respond? All right. So we have one question on the video. Okay. So one person is on video, and then we are waiting still for a couple of more people. All right. So we have Rini also waiting for Jawahar if he is coming in, or anyone else who might be coming in. All right. So any questions from the previous topic? Any leftover questions? Is Gobi here? You wanted to ask a question, but then you disappeared, I think. Or do you not have a question? Shivapriya is raising her hand.
Good evening, sir. Sir, I have a doubt regarding this NBFC, sir. In today's Hindu, we had an article about it regarding some pyramidal structure RBI has promoted one. proposal. I couldn't get into get that
Supreet,
article.
can you forward that article? Forward that article to me. I'll
Yes,
have to
sir.
read through it. I'll get back to you. You have my email ID, right?
Yes, sir. I have, sir. I'll mail, sir.
Drop
Thank
an
you.
email to me with that particular link to that article. Don't send a half a photo or something. Send the entire link to the article. Or if you are going to send a photograph of the entire article where every part of it is readable. Because it is only in the context that I can explain it to you.
Okay, sir.
All right.
Yes, sir. Thank you.
If
Sir.
you have specific doubts with respect to that article, just tell me what the doubt is. If you just want a general understanding of that article, let me know. So clarify what you want out of that article also while you drop a mail to me.
Yes, sir. I couldn't get. Yeah, entire article is something strange for me, so I'll mail it, sir.
All right. Fine.
Thank you.
If it is relevant, I'll explain it in detail to you. If it's not relevant, I'll give you an overview and then I'll end it there. Okay.
Yes, sir. And I also want to know the weightage of this NBFC, sir, in UPSC, whether it is very important to go through this or.
Are you talking about the FAQ that I told you or the article that you're referring to?
No, sir. Whatever you taught regarding NBFC, whether we will get more questions on this or.
The point is you don't really get a lot of questions about bank or NBFC or per se. The organization, you may not get a lot of questions, but about the sector itself, you might get certain questions about the regulation of the sector, about the issues plaguing the sector. Especially in the mains examination, you might get questions about what is the role played by non-banking financial companies in the financial sector of India. That could be a possible question. What role is it there? How to improve the governance of NBFCs? All these are current events. So those sort of questions may be there. I cannot classify it into a weightage because all these are current affairs based questions. If they are in the current affairs, they are asked. They are not conventional areas. They are evolving areas. NBFCs are gaining relevance as we go by. Every year it is gaining relevance because of the role that they are playing in the economy. So it is a good thing to have a general idea about what is the role that NBFC has. Read up a few articles about what is NBFC, what is their contribution from a mains perspective. Or as part of general economics, the classes for which will start pretty soon for you guys after the core is over. In that particular topic also, you can ask sir to explain the role in agriculture or industry or in those areas, what is the role that it plays. Okay, so in that sense it might be important, but prelims wise I don't see direct questions from that, except the organizational structure, maybe what type of NBFC is regulated by whom. All those sort of questions may come in. That is why I asked you to just take a glance through that FAQs.
Yes, sir. Yes, sir. Thank you, sir.
Okay, yeah, welcome. All right then. So we'll continue the class with the regular 3 people on video. No one else coming forward gutsily to give me wrong answers on the video. We'll start. So external sector, there are 2 major headings that we are going to learn in external sector and then an extra peripheral area. So one is balance of payments. Exchange rate determination. Followed by this, we have some peripheral areas which we'll put under the heading terms related to external sector. Okay, let me get a clarity from you. Already the class, we are going to end it only at 8. Just let me know, there are only about 20 odd people in this class, right? Is it okay if I extend it by, let's say, 15 minutes or so? Let me know. Think if it's not, if you're not comfortable with it, let me know, no problem. So you can text in and I'll go with the majority. I'll not, one person says no, I'll not stop myself, because if you have some work beyond that time, you can disconnect. You can always watch the video. I believe the videos are getting shared with you. Is that right? If you happen to miss the class due to some reason, you can choose to step out of the class, disconnect, and you can watch the video part later. So that is the part, because the first part of the session went a little slower than what I anticipated. That is the reason why I'm asking. So it might go till about 15 minutes extra. Just let me know. Okay, no problem. I can continue. Is the okay with me? Okay. Thank you so much. Thank you for your enthusiasm. Thank you so much for that. So we'll start with balance of payments. Which is shortened as BOP. Thank you, Sri Lakshmi, Anu, nameless person, Gunal, Archana, and Vamshi. Thank you for your responses, and Rini and Jawahar as well. So before we get to what exactly is balance of payments, we need to understand what is it that we are going to study about in external sector. What is meant by external sector? It is something that we studied a little bit about right in the first chapter, right at the beginning, when we learned about that circular flow of income concept. If you remember, we had learned about business, we had learned about household, the interactions between them. And because the household is getting to save a few some money in the banking system, and because government is collecting some tax from the household, as a result of all these, the household is not able to spend all the money that they have earned through their production activity on the produced goods. So that's an issue that we said, which means that all the goods that are produced by the business, they are not able to sell it to the domestic customers, which is necessitating an interaction with the rest of the world in the form of exports. And when you export automatically, the foreign country will also say, why should we only accept your goods? You should also accept our goods. So they would probably want to import. In addition to it, the factors of production themselves may move outside the country. The factors of production themselves may move outside the country. They may go work outside. So here the production happens in India and the product is sold. There the production itself may happen outside. You may go and work abroad, and from there you might send your money back into India. There might be some foreign factors of production who are coming to India and producing in India. They might send their income abroad. There might be remittances happening, payments happening. Along with it, entrepreneurs may come to India. Not just workers, entrepreneurs may come to India. They may set up their business in India. We call it by the name foreign direct investment. They may India. So that is a possibility that is there. In addition, when the banking system in India is not enough or not providing enough loans, we may access loans from outside India, external loans. All these are possibilities. So external sector refers to India's interaction with the rest of the world. Outside India, whatever interaction we have is what we call as the external sector. The outside world is the external sector. And in that context, a record of all the transactions, a record of all the money transactions of India with the rest of the world is what is called as balance of payments. You can note it down. The money transactions, all the money transactions of Indians, not just Indians, of India with the rest of the world, not Indian government, of even private individuals, of businesses in India, of households in India, okay, of banks in India, of everyone in India. India on one side, the rest of the world on another side. So balance of payments is a record of all monetary transactions of India with the rest of the world. That is what is balance of payments. Okay. Now, whenever we talk about this concept called as balance, or whenever we are talking about balance, the moment when we say balance, we are trying to create an account. Okay, we are trying to find out, is there any leftover? Is there some shortfall? Which means balance of payments in concept is very similar to the budget. In the budget also, we were looking at balance. The money that is coming in, the money that is spent out. If there is an imbalance, that is what led to fiscal deficit, or specifically revenue deficit. Those sort of concepts is where imbalance in the accounting. That was the deficit that we spoke about there. Very similarly, when we talk about balance of payments also, budget was a record of all transactions, monetary transactions between government and everyone else. That was budget. Balance of payments is a record of all monetary transactions between India and the rest of the world, which is also recorded very similarly to how a budget is recorded, and it is classified into two. So how is it classified? First of all, it is classified the exact same classification that you saw in budget. we will see this as well. The basis of the classification, the reasoning behind the classification. In budget, we classified it as saying all the expenditures and the receipts of the government towards the present requirements of the country to maintain the country where it is, current requirements, those were put under the revenue account, and all the future looking revenue receipts and expenditures towards the development of the country in the future, that was put under the capital account. That is how we classified that. Very similarly, here also we are going to say all the current transactions of Indians, okay, all the transactions towards the current requirements, all the imports and exports for the current requirements, all those would be put under the heading called as current account. There it was called as revenue account, here we'll call it as current account. However, the second account has the exact same name as the budget. We are going to call it as capital account, which deals with all the transactions with the rest of the world towards the future development of the country. In fact, the capital account is very easy to look at. I'll give you the terms inside it right at the right to begin with. So inside the capital account, when we say capital, we are referring to investments for the future. Towards the future, we'll automatically classify it as an investment. Any expenditure that we make, any receipt that we make, which is future looking, is considered as an investment. When you pay a school fees towards your education, it's future looking expenditure, so that's an investment. So any such thing is called as an investment. The moment it is future looking, it is investment. So we'll call it, the examples inside it are foreign direct investment account, foreign direct investment account. Okay, then you have something else called as foreign portfolio investment account. Then we have something called as loans account. Now here you have the name investment, here you have the name investment, here you do not have the name investment, but you know the golden rule behind borrowing: never ever borrow for consumption purposes. Borrowing should always be for investment purposes or capital building purposes. So loan is also a part of the capital account. It is also for the purpose of investment. Have no doubt about that. So that is the capital account. We will go deeper into what is FDI, what is FPI, what is the loan account. We will do that analysis. We will do that. Okay. But let me introduce you to the current account also. We will learn the entire current account first, and then we'll go into the capital account, and then we'll do the analysis, just like how we did in the budget. We learned about the revenue account, we learned about the capital account, and then we brought it together and learned about the various deficits that are there. So we'll do that here as well. So with respect to current account, we are going to classify it into number one, something called as the goods account. Okay. When there is a goods account, there has to be a services account as well, but we are not going to simply call it as a services account. We are going to club a few things which are similar in nature. One attribute of services which is different from goods is that goods are visible. Transaction of goods or movement of goods are physically visible, whereas movement of services are not physically visible. I might be sitting here and I might be taking class. Out of the 20 odd people, 25 people that are there, one or two of you may be attending the class from outside India. If you are doing that, it is a trade of service. There is an export of service happening there. If you as a participant are sitting there, which means that, right, the same activity I am doing here, I'm standing here and teaching. Depending on where you are located, it could be an export of service or it could be a domestic service that is being rendered. That goods cannot happen like that. So the export or import of service tend to be invisible in nature. They are not visible. Similarly, there are other aspects where there is no physical movement of commodities happening. So we'll put them all together under one bracket and call them as the invisibles account. Inside the invisibles account, we have number one, services account, where specifically we are saying services is one of the invisibles. Then we have something called as the unilateral transfers account. And we also have something called as the income account. Services account, unilateral transfers account, and income account. We'll go one by one. We'll start with the goods account. Okay, we'll start with the goods account. Goods account deals with the import and export of all physical commodities. That is what goods account is about. Okay, just one point to add before I go further. I should have added this before I started the goods account. But when we are doing the transactions here, when we are recording all the transactions, balance of payments, what is important to us is not whether a commodity is coming in or going out. What is important is not whether a service is coming in or going out. What is important to us is the money coming in or going out. At every point here, we are concerned with the flow of money, direction of flow of money. So whenever we have inflow of money, we'll consider it to be a positive. Whenever we have an outflow of money, we'll consider it to be a negative. So positive does not necessarily mean gain. Negative does not necessarily mean loss. Positive does not necessarily mean good. Negative does not necessarily mean bad. Positive only indicates the direction of flow of money. Money is coming into India, it will be referred as plus, because we will add all the inflow of money. Money is leaving India, we will consider as minus. Whenever we do balancing, that is how we do, right? Receipts minus expenditures. So this is like receipt, this is like expenditure. That is what the accounting is, inflow and outflow. All inflow, whichever account we are referring to, will be referred to as plus. All outflow will be referred to as minus. Keep this in mind. Now coming to the goods account, in the goods account, we have two things. We have exports and we have imports. In the goods account, we have exports and imports. Okay. Now exports are when goods are produced in India but are transported outside India to be sold outside. Imports are when goods are produced outside India and they are transported into India to be sold in India. So that is export and import. That I hope that definition is clear. Okay. Now, whenever we do exports, what we do is we sell our commodities outside India, we produce it, we sell our commodities outside India, and we end up getting some money for it. There is an inflow happening. And remember that the entire balance of payment is about our transactions with the rest of the world. And whenever we are selling our commodities in an international market, we cannot expect them to pay us in rupees. So the likelihood is that they are going to pay us in foreign currency, maybe dollars, maybe euro. We'll assume for the sake of uniformity and ease that it is dollars that we are going to get. So we will get dollars. An Indian exporter will earn dollars. And Indian exporter will earn dollars. That is what we are referring to as inflow over here. Similarly, an Indian is going to the international market to buy, let's say, oil from there. When they have to buy oil from there, they have to make a payment to get oil. So that payment is going to be outflow. But they cannot pay Indian rupee, because what will the other party do with Indian rupee? So they have to go to a bank, pay Indian rupee, convert it into American dollars, and using those dollars, they have to go and buy commodities from the international market. Okay, so what they do is with the foreign currency is flowing out of India whenever you are importing stuff. So that is outflow. Okay, whenever you see, there is a reason why I did not call it just as goods, I called it as an account. Whenever you call it as account, with exports, I didn't say exports account or imports account. I just said exports and imports. There is a reason why I called it as a goods account. Account, whenever you say, there is a two-way flow. There is out and one coming in. There is some sort of a net process happening. So there is this minus that. So there is going to be inflow minus outflow. So goods account, we are going to arrive at a balance called as goods account balance is equal to X minus M, where X indicates the value of exports, not the quantity of exports, but the value of exports. X indicates the value of exports, M indicates the value of imports. Okay, goods account balance. Now, this goods account is also referred to as merchandise trade account. Merchandise means goods. Merchandise trade account, or simply as trade account. So remember this very carefully, notice this very carefully. When we refer to trade, we are actually referring to only goods. We are not referring to services. We are referring to only goods. We are not referring to services. So there is trade account, which means goods account balance can also be called as trade balance. Trade balance is equal to X minus M. Okay. In India's case, what do you think? Which is higher, exports or imports? Okay, in India's case, is exports higher? Exports is option 1, imports is option 2. Option 1 is higher or option 2 is higher? People on video can show me. Okay, 2 is higher. Couple of people have said yes. Everyone who's answering: Magesh, Shivapriya, Sri Lakshmi, Archana, Vamshi, Harini, all of you are saying that it's imports which is higher, which is correct. Don't be misled by the current news reports which may come in the context of COVID. In the context of COVID, there has been a drastic reduction in the imports into India because economic activities are not happening, oil imports are less, everything is less. So there is a possibility that in this particular year alone, overall, imports may even be lesser than exports. But that is not the general trend. Don't go by that. Okay? The general trend is that our imports is greater than the exports, which means that our trade balance will be a negative value. Our M is greater than the X, which means it is likely to be a negative value. Okay, just like we learned in budget, when you have a negative value, you can either say trade balance is negative, or you can say, you can remove the minus there and you can call it as trade deficit. You can also call it as India has a trade deficit. You can call it as trade deficit. But when we are doing accounting, we are not going to call it as deficit. We are going to call it as balance to maintain uniformity. We are going to call it as trade balance, and we are going to say goods account is negative. Goods account has a negative balance. There are a few points where I want you to do some extra research and learn. Okay, these are extra research that I want you to do and learn. One, when the economic survey is released, maybe 10-15 days from now, when the economic survey is released, I want you to I don't want you to go through the entire economic survey. I don't think it is worth the investment. If you are not an economics optional student, don't go through the entire economic survey. One, you may not understand 80% of what you read or 70% of what you read. It is not relevant. If at all you find a question, maybe there is one question out of 100 which is going to come from there. That particular question, the answer to it, you can get by regularly reading the newspaper itself. You will be able to find that answer. Have an understanding of what the economic survey talks about by getting some compilation or getting some watching some class video of the economic survey, but don't put the effort to read the entire thing, is what I feel. It's up to you. If you feel that you should read, you can. If it gives you confidence, go ahead and read. But some people may lose confidence by reading it because the language is a little on the tougher side. The terminology is used. You may have to keep referring to the internet every paragraph or two to understand. But the economic survey has a lot of uses. If there is one particular chapter or topic about which there is a lot of discussion in the news, you can just download that chapter alone from the internet and you can read that. That chapter, about say 20 pages or so, you can download and read. But more useful for us is there are two volumes to economic survey, volume 1 and volume 2. Volume 1 has all the content with respect to the things that the chief economic advisor wants to say. What is the economy going to be like? What is the banking system going to be like? Very, very theoretical in nature. Volume 2 contains a lot of statistics, lot of data information. So that is relevant for us. There are different headings there: national income, then there is banking, sorry, not there is banking, there is money supply that is there is public finance that is there, the same headings that we follow. Similarly, there is external sector also. Just download the external sector chapter, look at the tables that are mentioned there. A few things to learn is, number one, what is India's composition of trade like? What is composition of trade? What is India's trade composed of? What are the major export items? What are the major import items? What are the commodities that we are importing? It is good to have an idea. You don't have to memorize it, but just get a general idea. You don't have to know what is the exact value, but try to learn if India is in the first position with respect to that commodity or not. What are the goods in which we are leading exporters? What are the goods in which we are leading importers? So that will give you an idea. Then second one I want you to learn is, what is the direction of trade, which means which are the countries with which we are having maximum trade, specifically for exports and imports. Who are our major export partners? Who are our major import partners? Top 5, top 5. Here top 5, here top 5. Then third, what is the volume of trade between with which country do we have maximum volume of trade? What do you mean by volume of trade? See, when we spoke about composition of trade and direction of trade, we always do X minus M. After reducing the imports, with which country are we having maximum exports and those sort of. But when you talk about volume of trade, we are asking which, India is doing trade with another country. Now take a look at India's exports plus the other country's exports, which will give an idea of what is the total value of trade between these two countries. India is exporting worth this much, that country is exporting worth that much. So this is the total value. India's value of trade is this much. Say, let's say China's value of trade is this much, which means normally we do X minus M. In this case, we'll do X plus M, because M is nothing but exports from their side. So that will give us an idea of what is the total volume of trade between two countries. Okay, so that also, there is no X and M separately here because it is X plus M. Top 5 countries, obviously top will be China. So take a look at what are the top 5 countries with which we have maximum trade, volume of trade. Okay, this will give you a general idea, a better idea about how India's external sector is panning out. It may not directly come in the examination, but it will help you with a lot of elimination in exams. If you get questions with respect to top exports, which of the following countries is the major exporter of rice, something like that, a question comes, these sort of information may help you eliminate certain answers. If you are really direct question also, with which of the following countries does India have the maximum volume of trade? That is also a possible question. If you are lucky enough and if you have read that, it will be a direct question for you. So do that. That is with respect to the goods account. We'll move on to the invisibles account. So in invisibles account, the first heading that we have is services account. So when you talk about the services account, the major question is not about whether it is export or import and all those things. It is not very easy to trace exports and imports because there is no physical transfer of goods and services. The simple issue here UPSC may target you with is whether you understand what is export of service and what is import of service. We'll take a couple of examples. We'll take a look at a couple of examples to understand whether you understand the prospect of or concept of export and import of services. Okay, I'll give you an example. I'll ask you questions. You answer the questions. Based on that, we'll see. Okay, let us say one of you, or let's say you have decided to go abroad for higher studies. You are now taking a decision that you are going to go to, let's say, USA to study. Okay, You apply for a loan here, you get the money sanctioned from here from a bank, because without the loan approval, without your source of funding, the college will not grant you the admission. So you show the source of money, you go there, you take the loan from here, you go to USA, you study there. It ends there. We are talking about education as a service. Now, is this export of service or is this import of service? A student from India is going abroad and studying. Is this export of service? Is this import of service? Okay, I have 1, 2, 3, 4, 5 people giving me an answer. 6. Okay, I didn't add one more option. Is it neither export nor import? That's the third option now. Now think, if because I gave you the third option, do you want to change, or just think about it? Lakshmi seems very confident. She says no change in answer. Okay. Okay, 9 people have answered, 10 people. Everyone seems very confident that it is import. I like your confidence and confidence space. You are correct. It is import of service. There is no doubt about it. Okay. But I'll tell you what, if I had okay, wait, there is one answer. Okay, so it is import. Even that answer is import. I was expecting some. That is Archana. Archana has given an explanation as well. Okay. So in some classes, in a larger class, I would have got some different answers as well. You seem to be 26 people with a lot of intelligence, 25, 26 people with a lot of intelligence. So you are not getting it wrong. You are not able to control your laughter. I can understand that. But anyway, the idea, some classes, sometimes what they, some students, what they say is that it is at this point, it is neither import nor export. It depends on where that student ends up working. Okay, they say it is not import yet. If the student stays back in USA, then it could be import. If the student comes back to India, it's some logic. They'll say, I have never managed to understand what their logic is, but I understand why they are giving that answer. The problem is that they think those who think that way, depends on where they work, they are mixing up two different services. Okay, here we are talking about one definitive service called as education. An Indian student goes from India to USA to study. It is clearly a case of import, because I told you the Indian student is getting the money from India, going abroad and studying. I told you right from the beginning, always look at the direction of flow of money to understand whether it is import or export. If the money is flowing outside India, it is import of service. Okay, whether if the money is coming into India, it is export of service. It is as simple as that. This is applicable even to goods, but with goods we can easily say, okay, goods sent outside is export, money will come in. Okay, if money is flowing from India to abroad, it is import of service. Now imagine an Indian person, an Indian citizen is going to USA, but the person has relatives in USA. Okay, and those relatives are the ones who are paying the fees. Now tell me, is this import of service or export of service? An Indian is going to USA to study, but it is the relatives who are in USA, who have earned the money in USA, who are paying the fees. Is this import of service or is this export of service? Okay, so one person has given me an answer saying it's export, but most of the people have been wise enough. Okay, 2 more people have said export, but most of the people have given me the right answer. Let me see what Sri Lakshmi has said. She hasn't finished her quota of wrong answers for today, so I'm expecting more. So it is neither imports nor exports. It is neither imports nor exports. Why do we say so? Because it's purely a domestic transaction. American or in America, money has been earned, has been paid for a service which is provided in America. How is this either export or import from India's perspective? There is no money moving out of India. There is no money coming into India. Now, this is where some people may say, what if that person gets the education there and comes back into India? So what? What is the guarantee that if he comes back to India, he'll get a job here? right? If he works here and earns money, the money earned is purely for the job that is done. So don't mix all those things. Restrict it to that particular service that we are talking about. For that service, there is a monetary payment that is happening. Is that happening from India? If it's going outside India, it is import. If it's leaving India, it's import. If it's coming into India, it's export. Now take another example. I'm taking a class from here. One of you might be attending from, let's say, Bahrain or someplace, because that is where we normally get some students from. I've had other batches where I was randomly giving an example and one person texted saying I'm attending from Bahrain. So I was very surprised, but it is there. So there are some students who attend from outside India. Okay, is that export of service? Are we exporting service or are we importing service? Okay, don't do that, Sri Lakshmi. You are the entertainment of the class. Don't stop answering. Okay, anyway, so that is clearly an example of export, because for the service that is being provided from here to there, money is being paid into India. So money is coming into India. When we receive money, when there is inflow of money, it is export. We are earning for that. So that is an example of export. Okay. Now take an example where a German citizen is coming to India. See, you know that as a tourist, there are different kinds of visas. There are visas which are issued for tourism. There are visas which are issued for work, for business purposes. You cannot work and earn money on a tourist visa. It cannot be done. So there are certain visas in which you cannot earn. You cannot do productive work and earn money. It is restricted. Okay. So if someone comes in a tourist visa to India, the assumption is that the person will not be earning any money in India, because it is illegal to work in India and earn money. Assume that someone comes on a tourist visa to India, which means that they will have to bring money into India. They cannot earn money in India. Okay, they come here, they stay here for 6 months, they go from the south of India to the north of India, west to east, spend everywhere. They spend all the money that they have on tourism activities and they go back. Is this export or import? Do I need to wait for answer? It's very clear, right? We are receiving money from abroad into India. It is clearly an export of service. So import and export of service is done. So in India, you tell me whether import and export, whether service is positive or negative, whether export is greater or import is greater. So export is 1, import is 2. Which is greater? Services. Services, export is greater or import is greater? Export is 1. Yes, export is greater, correct. Thank you for your answers. Correct, export is greater. We have always heard that India is a service sector led economy. Service sector is a primary exports. There is IT services that we do, there is banking services that we do, hospital services, tourism services, a lot of services which we export, for which we earn money. So this is a positive account, where inflow is greater than outflow. X minus M is X is greater than M. Number 2, we have unilateral transfers account. Unilateral transfers account. Now, what is unilateral transfers account? There is a specific word here, unilateral. Why is the word unilateral added? Because normally, when you receive money, when we receive money from abroad, it is for having given something. We have either sent or sold our goods abroad, or we are selling our service abroad, for which we are receiving a payment. Or if we are making a payment, we make payment for which we'll receive a good or we'll receive a service. So that is why it is done normally. Okay. In this case, we are receiving money, but we don't have to give anything in return. No good, no service, nothing. Or we are paying money, but we are not getting anything in return for it. When I say we, I'm not talking about you or me. Someone from India, not necessarily Indian, someone from India is making a payment and is not getting anything in return. Someone from outside India, it could be an Indian, it could be a foreigner, we don't know. Someone from outside India is sending us money and is not expecting anything in return. There are a few examples like remittances of Indians working abroad, grants received from international organizations, Grants could be given to the government, grants could be given to charitable organizations, any sort of grants could be there. Okay. Similarly, there is outflow also. This is inflow. Okay, we'll cumulatively call it by the name R for remittances. Okay, all these are money remitted into India. Similarly, there could be foreigners working in India who might be sending money back to their country, payments. Similarly, let's say Nepal is suddenly suffering from some sort of a calamity, or Bangladesh is suffering from some flood or something of that sort. India tends to step in and say, let us help you out, let us give you some money, not as a loan, you use it for your developmental purposes, you don't need to give it back to me, just a goodwill gesture from our part. So those are grants given. So these we'll put under the heading of payments cumulatively. So R and P. R is inflow, P is outflow. Remittance is inflow, payments are outflow. So this will be R minus P. In India's case, remittances generally tend to be greater than the payments, because a lot of Indians are working outside. Nowadays we don't receive a lot of grants as such from international organizations as such, because we are in the developing or slightly higher level. So those sort of grants are restricted to really low developed countries. So loans is what we mostly get, which won't get reflected over here. But a lot of NGOs in India receive funding from abroad. Missionaries and all those get funding from abroad. All those will come in remittances. So this is also a positive account, in the sense that the inflow of remittances is greater than the outflow of payments. So that is with respect to the unilateral transfers account. It is called as unilateral because money flows only in one direction, or money anyway flows only in one direction, but there is only a one-way transaction happening. Money transaction, but only money transactions happening, and that too only in one direction. The third one is what we call as the income account. So in order to understand the income account, we need to understand the capital account as well. It is a link with the capital account. In the capital account, we have three types. I told you three types of accounts inside the capital account. We have the FDI account, we have the FPI account, and we have the loan account. All of these are accounts. Okay. In FDI account, we have inflow of FDI, where we receive FDI. We have outflow of FDI, where Indian companies go outside and do FDI, which is also there. Tata has a plant in UK. Adani has work in, let's say, Maldives, Sri Lanka. There is in Australia. So we do a lot of FDI outside India also. In India also, there is a lot of FDI which comes in. There is inflow of FDI, outflow of FDI. Similarly, inflow of FPI, outflow of FPI. FPI is nothing but investment which comes into the share market, into the shares. Okay. And similarly, loans also, India receives loans, India also gives loans. India gives loans to weaker countries like Sri Lanka or Bangladesh or Nepal or surrounding countries, Vietnam, those countries we tend to give a loan to. We also receive loans from, let's say, World Bank or IMF, or from USA and UK and all those, or Japan especially, we tend to receive loans as well. So that is how it is done, inflow and outflow of loans as well. Now the interesting part here is that in the FDI is done with the objective of profit. FPI is done with the objective of a division of the profit, which is called as dividend. And loans is done given with the interest, with the expectation of interest. Okay, these aspects are a link from those, but they are different. You remember in the budget also we studied, your loan given comes into the capital account, but the interest earned comes into the revenue account. Remember, those are different flow of money transactions. So here FDI into India is in the capital account, but the profit earned which flows outside India, FDI comes into India, profit leaves India. So profit leaves India is outflow of profit. So here we have profit, we have dividend, and we have interest. So when we receive FDI, we pay profit. When we receive FPI, we pay dividend. When we receive loan, we pay interest. The opposite also holds true. So when you do that, profit paid, profit received minus profit paid, dividend received minus dividend paid, interest received minus interest paid, ultimately that is what the income account is all about. Okay. So income account You tell me, do we receive more FDI or do we do more FDI? We tend to receive more FDI because we are the country which requires a lot more investment. There might be a few entities from India which goes outside and does FDI, but predominantly we are a receiver of FDI, predominantly we are a receiver of FPI, and predominantly we are a receiver of loans, which means that outflow of profit is greater, outflow of dividend is greater, outflow of interest is greater, which means that the income account itself becomes a negative account, where outflow is greater. Outflow of income is greater than inflow of income. Now, don't get confused saying that income itself means coming in. Income, coming in. So don't get confused with that. Income here refers to just the money generated out of investment. That is what income refers. Income refers to profit. Either it is money coming into us or money coming into them. They'll say it is income for us. So that is why it is called as income account. Income account is a negative account in India because these tend to be coming into India more than going outside of India. So services is positive, unilateral transfers is positive, and income account is negative. But overall, these positives significantly outweigh this negative, which means that the invisibles account is overall in positive. So invisibles account is overall in positive, or balance of invisibles, just like we said balance of trade or balance of goods account. Similarly, balance of invisibles or invisibles balance is a positive. Goods balance or trade balance is a negative. Now, obviously, the next question is, what is the current account balance? The current account balance, whether it is positive or negative, depends on whether this negative is greater or this positive is greater. In the case of India, this negative is greater. So we have, you can either say India has a current account balance of negative, or simply we can say India has a current account deficit. This is what you may see in the newspaper headings as CAD has grown by this many percentage. CAD has shrunk by this many percentage. So that is current account deficit. Now, you will not find a lot of articles about capital account surplus or deficit. That is also CAD, CAS. But you will not find that in usage. The reason is because this money is actually our money. That money is not necessarily our money. That is just temporarily coming in. It may go out at any time. But this money is actually our earning. Okay. If we have a surplus here, it is India's money to keep. If we have a deficit here, look at the problem. India is having to buy worth 100 rupees. India has to pay 100 rupees, but India is receiving only 80 rupees by its exports, which means we do not have enough money to pay for our imports, to pay for our current needs. That is what a deficit here means. Current account deficit by all means is a bad position to be in. Just like we said in revenue account, we should not be in deficit. Revenue deficit, the ideal value is 0. Okay, ideally revenue balance should be positive. We should have a revenue surplus, but at least revenue deficit should be 0, we say. Very similarly, current account deficit is a bad scenario. It means that for our current requirements, we don't have enough money to meet our expenditure requirements. Remember that India is in current account deficit, but current account deficit is a bad scenario. But we cannot alter this significantly. One fine day, we cannot say we are going to export more. We cannot say we are going to import less. It is just not possible. For a long time, we tried doing that. Till 1991, we have said we are going to import as less as possible. We are going to restrict our imports. We are only going to import only the essential things, which meant what? People were deprived of the most latest commodities. TVs were available one in a village. Telephones you apply today, you will get after 10 years. Motorbikes, you pay the advance today, you might get after 20 years. You may not even be alive, but that is when you will get. Okay, that is how it was in the 90s also. Even after liberalization, that is how it was. So imagine how it would have been prior to that. Okay, so that was the case. When we tried restricting the imports, we realized that that is not possible. So what we do is, because we are in the negative here, the government is doing a lot of efforts to get that through here. especially in the form of foreign direct investment, which tends to stay for a period of time, which means that this money will not leave India immediately. It comes, it stays in India for a period of time. During that time, we can use the money for our current account requirements. So that leads us to the capital account. Now, let us go into the capital account. Before I proceed, if you have any questions with respect to the current account, feel free to ask me. If not, I'll move on to the capital account. Correct, Archana. I just saw your message. Sorry about that. All right. So no answers there, no questions there. I assume you are clear then. Then moving on to the capital account. Inside capital account, first we have foreign direct investment account. So this is a bit of a time consuming topic. With FDI, I have to go into a little bit of detail and explain it in detail. And then I have to go to FPI. You're not familiar with all these things, so it will require, you have not heard of FDI, FPI as much as you have heard about exports and imports and remittances and all those. So it might take up a little bit of time to explain these. So it is not that we are going to in the next 10 minutes finish the capital account also. It will take a little bit of time. We'll go one by one. Okay. So foreign direct investment. First of all, what is foreign direct investment? Okay. Foreign direct investment is any sort of investment which comes into the country to start a business. Okay. It could be to start a new business, or it could be to expand an existing business. Okay. See, rather than understanding FDI through definition, it's better if we can understand FDI through examples. Okay. So what do I mean by to start a new business? Such a business does not exist. They are going to start it afresh. Okay. That is what to start a new business means. So let's say Hyundai wants to come to India and start a car manufacturing unit. They come here, they set up a plant, they create a brand called as Hyundai, or they come with the prior brand which they have from their country, and they create a brand called as Hyundai. They set up a plant, they launch their car, they make it available. That is called as foreign direct investment, where you are here to start a new business. But sometimes the government says, I will not allow you to do business on your own. You need to compulsorily partner with an Indian. Okay. For example, Suzuki comes to India, they want to do business. They say, government says you have to partner with someone. So Suzuki says, who will come? Okay, Maruti, come with me. Maruti, Suzuki. So they have a partnership, but they are starting a new business. That is still a new business. And it was not new to India at that point of time where we had to do this. We have Kinetic, Honda, Kawasaki, Bajaj, Maruti, Suzuki. So many examples were there. Okay, where there was a partnership between a foreign entrant, a foreign investor, and an Indian investor. It worked for both people's advantage, because the foreigners were not quite familiar with the Indian way of working. So Indians, Indian partner, Indian company being a partner helped. Similarly, Indian company did not have the technological expertise of the foreign company, so that also helped. Eventually, it helped Bajaj split from Kawasaki, and now Bajaj is an entity of its own. Okay, Bajaj gained that expertise over the years, so that also it helped. Okay, so that is an example of to start a new business. Now, to expand an existing business, what do we mean by that? Either let's say Hyundai already has a plant in India, and the profits that they earn is also reasonable. Okay, now the parent company, wherever their home country is, I think Korea, I'm not very sure. So they believe that they want to set up another plant. Let's say the initial plant is in Pune. They want to set up a plant in Bangalore or Chennai, or maybe Bangalore and Chennai. So they need more investment. So they bring in more money from there. That is to expand an existing business, not to start a new business, to expand an existing business. Okay. Or Pune itself, they have a plant and they say we have a lot of vacant area. We can build another industry over here, another machine, and we can expand this business itself a little more. We can hire a few more people rather than setting up a new plant entirely somewhere else. Just expand this a little bit. That is also FDI. Interesting part is, let's say Hyundai does business and earns a profit of let's say 20 crore in a particular year. Okay, and we normally say profit earned is sent as payment. By default in accounting, that will be treated as payments. A factor income sent abroad. If they choose to reinvest that money in India, reinvesting would mean expanding the business. That is also treated as FDI. The money that they earned in India, we treat it as it rightfully belongs to the home country. That they choose to reinvest in India, that is also considered as FDI. It will be recorded as money went out and came back as FDI. That is how it will be recorded. All these are examples of foreign direct investment in existing business. But this is not all. There are other types of investments in existing business as well. Jio has been running very successfully. Ambani has been running Jio. The Reliance Industries have been running Jio. And now Jio requires even more investment because they have borrowed a lot of money. That is too much debt on one head. They say, okay, I want investors from outside. So Google comes in or Facebook comes in and says, let me invest 6% of your value or 7% of your value, a certain amount of money. Let me invest it. It is investment in an existing business. That is also FDI. Okay, Flipkart struggling with the existing business model. Walmart comes in and says, let me give you the money to do the business. That is investing in an existing business. All these are examples of foreign direct investment. Okay. Now, there is a general perception that if you are investing directly in a business, you will have management control over that business. It is not necessary. If you are investing only 5%, then you are not going to have significant management control. If you are investing money from abroad, but you are investing only worth 5%, then you are not going to have significant management control. But you are investing directly with the business. You are going to the business owners. You are either giving directly money to them. Remember paid up capital that I told you about in banking? You are directly giving money to the owners, or you are yourself doing business. It will lead to employment creation. It will lead to expansion of business. It will lead to expansion of business. That is the first thing. Okay, it's extra money that comes in. Now, there is another concept. I'll also introduce the concept of foreign portfolio investment so that you can contrast and learn it right away. So that is the second one. I'll explain FPI after finishing FDI, but I'll just introduce the concept to you. Foreign portfolio investment it refers to investment in the shares of a company, which means foreign investment which comes into the share market. Foreign investment which comes into the share market is what is called as foreign portfolio investment. It is also investment which is into a company, but the company may not directly receive it. What do I mean by the company may not directly receive it? The company may have issued some shares in the market and some domestic investors may have bought it. Now, in the secondary market, what is secondary market? We'll learn tomorrow. But in the market, in the share market, with the original people who gave the money, they gave the money to the company. Now, a foreigner may come and buy the share from them. That money is not going to come into the hands of the company at all. That money will go to the owner of that particular share. That is how that money will go. But investment from abroad into the share market is what is called as foreign portfolio investment. That does not lead to expansion of business because the money is not directly coming into the hands of the business. It is not coming into the hands of the business. They are investing in the shares of the company. Those shares itself are not owned by the company anymore because they have already sold it in the market and someone else is owning it. Let us say Tata is selling a share. You bought the share. Now you have given the money to Tata. Tata received, let's say, 1,000 rupees. You have a share worth 1,000 rupees. Now Tata is out of the picture. you have the share worth 10 rupees, 100,000 rupees, and you want to immediately sell it. Some foreigner comes and buys the share from you for 2,000 rupees. You think Tata is going to get the money? You think you are going to say, hey, Tata, I got 1,000 rupees extra. Here is your share. No, it is your money. Okay, you owned the share of Tata. You sold it to someone else. You are going to get the money. Tata is not going to see a single penny out of that. So it is not money which is coming into the business. It is money which is invested in buying shares of that company. In some cases, money may come to the business when the company itself is selling the share, a foreigner comes and buys, then it may come into the company. Other than that, it is not likely to. So there is some part of foreign portfolio investment where money may come into the company itself, but other than that, no. Okay, and there is another interesting aspect with respect to foreign portfolio investment. If let's say a company, let's say some investor over a long period of time buys few shares now, then a few shares sometime later, then a few shares sometime later, over a long period of time, if an investor ends up buying more than 10% of the shares of a company, of the same company, then that person will have management control over this company, because one entity is having more than 10% share of that company. Then that will be treated as a foreign direct investment, even if it happened from the share market. If the ownership of shares of a particular company is greater than 10%, it will be automatically treated as foreign direct investment, because money is direct. There is ownership control that person is getting now. That person has a rightful claim and say, I want to be a part of the board of directors because I have more than 10%. More than 10% of the value of the company is contributed by me. So that's an exceptional case. It doesn't normally happen. The Securities and Exchange Board and everyone and the company itself is very careful to ensure that no one has more than 10%, because they want to prevent any extra people, unintended people, from having management control. As a rarity, it may happen. So I told you about as a special case. So foreign portfolio investment is investment in the shares of a company that comes into the share market. More details, why portfolio, what is FII, all those I'll tell you when I get there. Now let's get back to foreign direct investment. I just wanted to compare and contrast. What is the difference between the two? If it's not clear, if you want to ask some questions right now, feel free to. So Sri Lakshmi, I think I have answered your question. You asked me about primary market. I have answered that, right? If wherever they buy it from, if it is less than 10%, it is FPI. Even if it's directly from the primary market. That is why I said a small percentage of it may come to the company, even then it is FPI. No doubt about it. Okay, so Archana had asked the question. I think I had, without noticing that, answered that. Any other questions as to the difference between these two? Okay, I don't see any questions, so I'll proceed. If you guys have, just send it across. Whenever I see, I'll answer. Getting back to foreign direct investment itself. So we look at what are the ways in which foreign direct investment comes into India. What are certain limitations with respect to foreign direct investment? I told you, right? The government sometimes say you have to compulsorily partner with an Indian firm. What are the rules behind it? Then we look at the merits of foreign direct investment, demerits of foreign direct investment, and finally, what are the measures taken by the government of India to promote foreign direct investment? That much we'll be learning about foreign direct investment, and then we'll get to foreign portfolio investment. Okay. Now, first, routes. Routes of FDI. There are two routes of FDI in India. Two major routes of FDI in India. Number one is what we call as the automatic route, and the second is what is currently called as the government approval route. Previously, it was called as FIPB route. FIPB stood for Foreign Investment Promotion Board. Foreign Investment Promotion Board. Right? So Foreign Investment Promotion Board route. Okay. So now what is the difference between these two, automatic route and government approval route? There are certain, see, the businesses in India are divided into various sectors: automobile sector, pharmaceuticals, textiles, infrastructure, roadways, railways, insurance, banking. These are the various sectors into which the Indian economy is divided. Okay, business activities, the economy itself is divided into all these sectors. Okay, so once this division is done, the government says there are certain sectors where I want a lot of foreign direct investment. Two reasons why the government wants a lot of foreign direct investment. One, maybe there is no Indian player at all. There is no Indian who's ready to invest in that area. So we require the foreigners to come and invest there because Indians don't have the skill, Indians don't find it profitable, whatever could be the reason. So that could be one. The other is, we are saying that there are a lot of Indians are exceptionally good at doing it. If you want, you can come and compete with them. I don't have any problem with it. Okay, you can be an equal player to them. If in either of these circumstances, the government may say, I am okay with the foreigner coming and I will treat the foreigner on par with an Indian firm. That is what is meant by automatic route, where there is no special permission required just because they are a foreign firm. Automatic route is a foreign investor will be treated on par with a domestic investor. That is what is automatic route. They will still have to take all the approvals that a domestic firm has to take. Environmental approvals or Companies Act, to register with the Companies Act, they'll have to do all those things. But they don't require special permission just because they are a foreign investor. Typically, the difference comes in, see, for an Indian, it is very simple. Indian has to go and invest, buy certain, maybe lease a land, hire a few people, whatever it is that is required for initial investment. But for a foreign investor, they are bringing in foreign money. Foreign money, where will they convert from? They'll have to go to the bank to convert, or with the customs authorities, and they have to convert. When they are going to convert, they'll be asked a question: why do you require this money? So if they can show that, see, I already have registered with the Companies Act, I am going to do this particular business. This business is under the automatic route. Okay, if you can show that, then they don't require any extra permission to convert their money from foreign currency to Indian currency. It is freely convertible, which means that they will easily get Indian currency and they'll be treated on par with an Indian producer, Indian manufacturer, or Indian business person. That is what is automatic route. Then there are some sectors where the government feels, I will allow you to do business, but before that, I want to scrutinize who you are. I want to scrutinize what are the terms and conditions with which you are coming in. There are certain investments where I want you to buy things, certain things domestically. You cannot buy your raw materials from abroad. For example, Apple has still not invested in India. Now they have, but they did not invest in India for a long time because India had a rule saying that you have to acquire a certain percentage at least of your content, of your inputs, raw materials from within India, from domestic suppliers. Apple said, no, we cannot compromise on quality. We will only get it from our trusted suppliers outside India. That is the reason why for a long period of time, we did not give them the approval to come and set up over here. Now that the issue has been resolved through some discussion, they are coming and discussing, they are going to set up a plant in India. So all this is an example of government approval route, where the government monitors the terms and conditions with which they are coming, and if it is agreeable to the government, then they will give an approval. This is done in certain sectors where it might harm Indian interests to freely allow them to come and invest. So now the next question, why was it called as the FIPB route? Post 1991, when liberalization was done, when privatization was done, and Indian economy became globalized. Okay, the situation was very similar to this. Imagine that you one day decide to go on a trip to China. Okay, you are going on a trip to China. You are visiting China. You go land there, you have absolutely no clue of the language. You have absolutely no clue of the culture of the people. You don't know. Once you step out of the airport, you don't know what direction to go in. You don't know how to get into a taxi. You don't know the color of the taxi there. You don't know whether it is a private car or a taxi. That is the cluelessness with which you are entering the country. Okay, there you will keenly look around. Is there someone with an Indian face over here? Is there someone who can help me out? That is where one voice you see that suddenly is speaking in Hindi to you. Let's assume that you know Hindi. Okay, and you look around to see an Indian face, you see that it is a Chinese man who's speaking Hindi. You're surprised, how is that happening? He'll say, local guide, I'll take you around. So he is taking you around. So that local guide will help you around in understanding the place, in understanding the culture, to tell you where to go. All those are the facilities that the local guide is offering you. Okay, so in 1991, post 1991, when foreigners came to India for investment, they felt like this person, you who landed in China with no idea about left or right or the language that is spoken, the culture of the people here, the ministry, the government, absolutely no clue. They required a local guide, and this Foreign Investment Promotion Board acted as the local guide for them. They were the single point of contact. So the investor would come. Where is FIPB come? FIPB, you do whatever is required. I don't know what to do. You do all those and you help me out. You go to the concerned ministries, you get the approval. You do all these help for me. That was Foreign Investment Promotion Board. Okay. But let's say today you are going to, I know that going to China is still a very far-fetched thing for you. But let's say you are going to USA. Okay, let's just assume you are going to USA. It is not as unfamiliar to you as it would be to go to China, because you have seen US movies. Probably if you have seen sufficient US movies, you may even know the airport in New York more than the person who is there, because you have seen it in so many movies. You know what their customs are, you know what they ask, you know how they speak, you know where they drive, you know what is the color of the taxi, because you have so much exposure to the country now. Plus, because when you know that you are going to go, you will simply Google in the internet, you will Google and you will find out things to notice when you are going to USA for the first time, where to go, what to do, what to be careful of, everything. You know, you have information overload. There you go, there is an American who's speaking in Tamil to you and who's asking, enna venu ungalku? Then you say, nothing, go away, I know what to do. So that is the situation. Now that person is an extra for you. That American who's trying to act like a local guide is an extra for you. You don't want that person anymore. So FIPB became a bit of an extra. Why? Because the foreign investors now clearly know what India is like. Every policy update that the government is giving, it is readily available on the internet, the ministry's website, everything is easily available. So the foreign investors do not want the FIPB anymore. The FIPB is only delaying the process. The FIPB ended up being delaying the process. See, this process is applicable in every context. Middleman was introduced so that a farmer could produce something and sell the commodity at a faraway place. It is a very noble thing. It is a very necessary thing, that very middleman is acting as a hindrance now, right? Preventing the farmer from getting the desired price. Very similarly, FIPB is that middleman. Middleman was supposed to help. Middleman has become a hindrance. When the government felt that, in 2019, they even abolished the body. When they abolished the body, that route is not FIPB route anymore. It became government approval route. So caps in FDI. What are the restrictions, or what are the upper limits in FDI? There might be some areas where the government says, I am not going to put any restriction on how much you can invest. If the business is worth 10 crore, you can bring the entire 10 crore. If the business is worth 100 crore, you can bring the entire 100 crore. So 100% FDI may be allowed. But there might be some areas where the government feels, I don't want you to come and invest entirely. Why? Because there are other firms in India. Indians are themselves capable. When you come and set up, you might overpower them. You might be too good, and my domestic industries may suffer as a result of it. But I still will allow you to come in on the condition that you bring in only 50% of the money. The remaining 50% compulsorily you will have to partner with an Indian firm. Suzuki comes, partners with Maruti. Kawasaki comes, partners with Bajaj. Okay, so that's sort of a deal. So that one, the Indian firm doesn't lose out. Second, the Indian firm gains technology through this. Third, for the foreigner also, there is a partner who can help with the domestic whatever issue that is there. But if you have 50-50, the problem is that whenever there is a decision making power struggle or some decision making conflict, then who will win? The majority is 51, right? Simple majority is 51. Who will win? So for that, they never say 50%. They might say we'll allow 51% or we'll allow 49%. 51 when we are okay with foreigner having a majority, 49 when we want Indian to have the majority. Okay, or you will have an extreme scenario where the government says no FDI is allowed. Certain sectors where no FDI is allowed. That is also a possibility. In fact, these are not the only percentages. There are percentages like where 76% is allowed, or 74%, or 26%, 24%. You will never find 25, 75 and all those, because 75 is 3/4. Sometimes majority required is more than 3/4 or less than 3/4, or whatever be the case. Sometimes it is 65% is allowed, but not 66. So all those numbers may come into the picture. Just remember, as an example, 1, 2, 3, and 4. There are other variations with respect to the cap as well. These are the caps. Now, point to note here is that cap and route are two different things. Just because a particular sector is automatic route, let us say automobile is automatic route, automobile sector, anyone can come and set up, does not automatically mean that they can come and bring in 100% of the money. It might be automatic route with only 51% allowed. Remaining 49 is not allowed at all. There is no option. They have to compulsorily partner. But that 51%, there is no special requirement. If they have a partner in India, they can come and invest. Okay. Or it might be 100% allowed, but government approval route. Any of these combinations may be a possibility. There are some sectors in which, let us say, 76% is allowed, of which only 51% is allowed as automatic route. The remaining 25% is government approval route. Those sort of combinations are also there. Okay, we'll not get into all those. Those are not very relevant. But if you are really keen on learning what these sectors are and what percentage, which sector, what percentage, or if you simply want to know what are the sectors in which it is automatic route 100% or government approval route 100%, only that you want to learn. And you also want to learn what is not allowed at all. If you want to know that, go to a website called as investindia.gov.in. This website will give you that entire information. investindia.gov.in. What are the merits and demerits of foreign direct investment? The first merit that we can directly talk about is the more the FDI, the more it will help us with the current account deficit scenario. Helps in meeting current account deficit. Helps in meeting current account deficit. Number 2, contributes to GDP. Contributes to GDP. Why? GDP is defined as total value of all final goods and services produced in an economy. Even if it's a foreigner, if they are producing in India, it contributes to GDP. Contributes to GDP or contributes to growth of the economy. The moment they are producing in India, it results in increasing employment. It could increases employment and hence income of the people. In addition, we can talk about introduction of new technologies, introduction of advanced technologies. We can talk about optimization of resources. Why are they able to do something so profitably? Because there is very limited wastage of resources. They know what is the right limit of resources to use to get the output. So optimization of resources. Then you can add more points. Increases competition. Okay, you can write that as well. So increased competition is good because increased competition leads to drop in prices. Increases competition. No, that is not the end of it. You can add more points if you can think of points. Now coming to demerits. Demerits is an interesting aspect. Everything that we have given as a merit, we can counter it. Every single thing that we have given as a merit, we can counter it. For example, we said it helps in meeting current account deficit, right? I could also write could lead to widening current account deficit. How so? Think logically. More and more FDI. In the present, you're talking about, okay, with that extra money, we are able to buy the imports. Whatever we are falling short of, we are able to get it. But as more and more FDI comes in, more and more profit goes out, income account becomes more and more negative. So there is a possibility that it could lead to widening current account deficit. Still, why do we do it? Why does the government encourage it? Because the government says, if the government can direct this FDI into such areas where it could lead to either export promotion or import substitution, where we ask the foreign investor, you produce, but whatever you produce, you export. It will increase our export earnings. Or you produce whatever we were otherwise importing, you produce domestically. We say make in India, right? We say make in India so that we don't have to import it, which means our import bill will go down. So if through FDI, we are able to reduce the goods account deficit, even if the income account deficit increases, the goods account deficit decreases by a greater extent, then our current account deficit will narrow. Okay, so this is a possible negative, but the government, through its caps, through its approval route, ensures that tries to ensure that FDI goes into only those areas which will help us improve our current account situation. Number 2, contributes to GDP, no doubt about it at all. But we say it increases employment. Okay, it could increase employment, but if the investment comes in areas where there is a lot of growth happening without sufficient jobs being created, whereas there is an excess of technology, it is resulting in jobless growth. If a lot of the investment comes in the service sector, it may not result in a proportionate creation of jobs. So could lead to jobless growth. What does jobless growth do? It could result in widening inequality. It could result in widening inequality. So introduction of advanced technology also could lead to loss of existing jobs as well. Introduction of advanced technology could lead to loss of existing jobs as well. Plus, if they are so advanced in their work, we say it increases competition. It could also lead to destruction of, could destroy domestic industries, could destroy domestic industries. It could destroy domestic industries. That's a possibility. We say optimization of resources, right? We say optimization of resources, but understand this: if an Indian firm is using the resources, ultimately they know this is the country that they have to live in, so they will have a limit to how much they will use the resources. They'll say beyond this, if we use, our country itself will suffer. We won't have anywhere else to go. But for a foreign investor, they have many other places to go. They have their home country to go back to, which means they might not be very considerate with respect to utilizing resources. They might exploit the resources because they know they are not here for a very long time. They are only here for the medium term. They may leave after a while, after exploiting all our resources. Could exploit our resources. Number 5, we always have security related issues. What do we mean by security related threats, issues? So we might have situations where a lot of our personal information, India related information, banking related information are in the hands of foreign companies, be it WhatsApp, be it Amazon, be it Flipkart, which is now predominantly foreign owned. Whatever be the case, a lot of our data may actually be stored in servers outside India, may actually be in their control. That leads to data security or security related threats. Too much of Indian information in their hands. That's a possibility. This is why, to counter this, the RBI last year brought in something called as data localization. If you are saving data of Indians, it has to be done within the physical territory of India. The servers have to be located in India. So those sort of constraints we brought in to counter that. Okay. It could also bring in sovereignty threats. You're already hearing about this, right? That I'm not saying it is true, but it has always been a matter of concern that the corporates are having a very close connection with the politicians. A lot of decisions that the politicians take are in accordance with what the corporates want. This is called as crony capitalism. Okay, this is what is termed as crony capitalism, CRONY, crony capitalism. So it has always been, historically been there from the beginning of time in independent India. Even now, there are claims of that. Now imagine, at least these capitalists are Indian capitalists. Ultimately, there is some India related benefit that they are likely to have. But imagine if a foreign company is having that sort of a say in India, if they contribute so much to the GDP that they become a very important player, then there might be a foreign company which is dictating the policies in India. That is a possible threat. So everywhere the government takes one measure or the other, be it with respect to limitation in terms of caps or routes, the government tries to counter all these criticisms and possible demerits. There are more demerits that you can talk about. That is all there, but the government tries to counter it. So ultimately, it just goes to show that in spite of the demerits, possible demerits there, the merits significantly outweigh the demerits, which is proven by the fact that the government has taken a lot of measures to promote foreign direct investment. So some of the measures to promote FDI in India. So first we can talk about policy related policy measures. First, what we'll talk about is the new economic policy of 1991, which is nothing but the LPG, liberalization, privatization and globalization. Okay. Along with it was the introduction of a particular act called as the Foreign Exchange Management Act in place of Foreign Exchange Regulation Act. You can also write this as FERA was amended to FEMA. Foreign Exchange Regulation Act was a very strict act with respect to handling of foreign currency. If there was any mismatch, any wrong done with respect to handling of foreign currency, it was treated as a criminal offense and the people were jailed. Okay, it was later made into a milder law. It was made into a civilian offense where the law itself was liberalized a little bit. FEMA is the liberal law. They amended the FERA to FEMA. Foreign Exchange Regulation Act was amended to become Foreign Exchange Management Act. So that is another policy measure that was taken by the government of India. Okay. Then with respect to alterations with respect to routes, alterations in caps, alterations in routes, certain government approval route have been made as automatic route. Certain sectors where FDA was not allowed have been allowed now, maybe 25%, maybe 50%, wherever it was 50, it was become 75 and so on and so forth. Alterations in caps and routes, those are measures. Make in India is a major measure. Make in India is a policy of the government. Ease of improvement in ease of doing business. Ease of doing business rankings, improvement in ease of doing business rankings. These are some policy related measures. Organizational measures. We can first talk about setting up of FIPB. In policy related measures, we can also say as a sixth one, we can say abolishing FIPB. That is a policy measure. That is a policy measure. But organization wise, 1990s, they set up FIPB. 2018, they abolished FIPB. Both measures were done to promote FDI. At that time, to promote FDI, this time to make FDI easier. So setting up FIPB, Foreign Investment Promotion Board, then India Invest Company. I just gave you a website, right, in the previous couple of slides ago, indiainvest.gov.in, that to set up as a government-owned company. What is the role of that company? To go outside India, to go to international investment forums and to promote India as an investment destination. Very recently, I think one international organization, UN or World Bank or someone even gave a recognition to India Invest as having done exceptional job in promoting India as an investment destination. So India Invest Company, that is a very successful organizational change that was done. Then setting up of special economic zones where liberalized laws, labor laws are very liberal, all those changes are there, but with the condition that whatever is produced there can only be exported. In SEC, if you produce something, that can only be exported. It cannot be sold domestically because there are a lot of tax relaxations, labor law relaxations, all those that are given. So SEC. So all these are organization related related measures. Then we can talk about international measures where India has become a part of World Trade Organization. India became a member of World Trade Organization right when it was launched, thus boosting trade and investment. India agreeing to something called as trade-related investment measures. Trade-related investment measures. TRIMS, trade-related investment measures. That's an agreement that India has signed which facilitates more and more investment. Intellectual property right protection that is provided by the government. To some extent, it is still a point of criticism in India that India doesn't protect the IPR sufficiently, but intellectual property rights protection. If a foreign company comes to India with new technology and it can be easily stolen and used by others without any consequences, then what was the point of them putting so much of effort in creating that? So IPR protection that is provided. So all these are some examples of international measures that have been taken as well. So these are some measures that have been taken. There are more measures. As you read up more about foreign direct investment or editorials that come in that context, you will be able to learn more about it as well. Now we'll move on to foreign portfolio investment. Foreign portfolio investment. See, why is it called as portfolio? The only word that you will be unfamiliar with is here is the word portfolio. Portfolio means a group of certain or a grouping. Just think of it as a grouping. Okay, I'll give you an example in a completely different context for the word portfolio. In India, the government consists of many ministries, right? There is finance ministry, railways ministry, highways ministry, trade ministry, agriculture ministry, labor ministry. All these ministries are there. Each ministry is considered as a portfolio. Finance is a portfolio, railways is a portfolio. These are portfolios, certain groupings. With respect to investment, a group of instruments in which investment is done, that is called as a portfolio. With respect to investments, there is generally a golden rule that is said: don't put all your eggs in one basket, because if your basket drops, all the eggs may drop. That's the literal side of it. In terms of intention, what they mean is, don't invest all your money in one type of share. If that company fails, you lose all your money. Diversify your investment. Okay, put some kind of investment in this sort of a company, some other investment in a different kind of company, some other investment in a different kind of company, in different sectors. Do all those so that you can minimize loss if there is a lot of loss, or even if one company faces a loss, you can still get a gain from other companies gaining. Okay, so you are minimizing the risk in the investment. So generally, investment in the share market happens in a variety of groups or a variety of portfolio. So that is why this sort of an investment is called as foreign portfolio investment. When we do it domestically also, it is called as portfolio investment. Investment in the share market is called as portfolio investment. When foreigners do it, it is called as foreign portfolio investment. Okay, in this context, there is another name which you may have come across, something called as foreign institutional investment, FII. It is something that you may have come across if you have read these topics in the past. Okay, foreign institutional investment. What is foreign institutional investment? I'll tell you that. Okay, so this is how investment works. Foreign investment into India works. Investor comes to India, there is this market which we will call by the name National Stock Exchange or Bombay Stock Exchange. These are a couple of major stock exchanges that are there. Secondary market. What is secondary market? We learn in tomorrow's class. They want to invest in this. Foreign investor wants to invest in this. Okay, invest in the shares in these markets. But foreign investor is not directly allowed to. They have to go to SEBI, Securities and Exchange Board of India. Securities and Exchange Board of India. They have to go to SEBI, get their approval, and only then they could invest. Okay. If you are an Indian who's trying to invest, you don't need to go and get approval from SEBI, but you will still need to register with SEBI, and they will give you something called as a demat account, a dematerialized account, a demat account. Only with a demat account you can invest in the share market. So you still need to register with SEBI before you can invest. For them also, they need to register, get the approval of SEBI, and before they invest. In India, you as an individual, if you want to invest, you can directly go and invest in the share market. But if you are not familiar with the share market, you don't know how the share market works, you don't want to know how the share market works, you just want to invest your money, there are some organizations or institutions who are saying, don't go through the pain of all those, we will help you out with those things. Okay, those institutions are called as investment institutions. Okay, like one of our participants, Sri Lakshmi, said she worked in an institution like that, an investment institution. That was an investment bank, but in general, institutions which purely do the function of investment. It takes people's money, and tells people, see, we are going to invest your money in these stocks because they are performing well. Trust in us, it will fetch you good returns. So based on your trust in them, you allow them to do that, and they'll invest on your behalf. And if you get some money, they'll take a commission and they'll give you your earnings. Okay, this is how investment works. Either you can directly invest or you can invest through an institution. Till about 2015, although Indians could invest in any way, individuals or institutions, but from abroad, from foreign, SEBI did not allow individuals to come and directly invest, because it would have been too difficult to manage those individuals. So many individuals coming and registering and all those, it would have been slightly difficult to manage. And SEBI said, we don't know the quality of those individuals. What is the intention behind their investment? Who are they? Where are they from? We wouldn't know all those things. So we want investment from abroad only from institutions. So if a foreigner wanted to invest in India, the foreigner had to go to an investment institution situated outside India, give the money and said, please invest on my behalf in this particular share. The institution had to come to SEBI, reveal the details of the investor, and then go and invest in that share. And then the share would be issued in the name of that person, which the institution will take back to that country and give it to that person. So till 2015, only institutional investment was allowed from foreign, which is why it was called as foreign institutional investment. But in 2015, there was a change which was made due to international pressure and the changes in the international setup. And the Indian government, or the SEBI, made a change saying that even individuals can now come and invest in the share market. Again, the same process. Go get approval from SEBI and come and invest. Since now individuals could also invest, you cannot call it as FIA anymore. So they looked at a more generic name and they called it as foreign portfolio investment. It is a more generic name, that is all. Okay, but not all individuals can invest. Only certain high net worth individuals, who have a very high value of money, or individuals who are from countries which are not blacklisted by FATF, Financial Action Task Force. Only those investors who are not blacklisted by FATF were allowed to invest in the Indian share market. From countries, individuals are not blacklisted. If an individual is from a country which is blacklisted, FATF blacklists countries. Recently, you would have seen that Pakistan is in the grey list of FATF. Pakistan is trying its best to come out of the grey list. India is trying its best to push and convey to the world that Pakistan deserves to be in the blacklist. All this is going on. That is FATF, Financial Action Task Force, a body which monitors the government's efforts towards countering money laundering and terror financing. A body which monitors the government's efforts towards countering money laundering and terror financing. If they blacklist a country, then from that country, we will not allow individuals to come and invest. Okay, that is the idea. In addition to this, non-resident Indians are also allowed to come and invest in, and that will also be called as foreign portfolio investment. Why so? Because they are investing foreign money. They are investing money earned outside India into India. That is again called as foreign portfolio investment. Okay, so that is all about foreign portfolio investment. I've given you an introduction of what is foreign portfolio investment. But there are some issues with foreign portfolio investment. Foreign portfolio investment is very volatile in nature. It is more volatile than domestic investment in the share market. Why so? Because in the chapter called as money, we looked at 3 reasons why money supply increases. Why 3 reasons based on which money supply is determined. Printing of currency is based on 3 factors: quantity of goods to be produced, the extent to which inflation is required, Q and P. Then we said there is a third factor. Whenever there is an excessive inflow of foreign currency, we print Indian rupee. So if there is an excessive inflow of foreign currency through FPI, we will print Indian currency and there will be excess money supply in the country. Okay, and then suddenly they decide to leave India, there will be excess of foreign currency and we'll have to give them their currency back, which means even more currency comes into the picture, which will mean that it could lead to excessive inflation. So it could lead to some instability. Unlike FDI, FDI is where the investor is directly invested in the company. they want the company, they want the welfare of the company. They will not one fine day shut down the company and go. There are rules and regulations. The employees cannot be fired just like that. Those rules and regulations are there. With FPI, there is no such rules. They will be able to sell their shares in a very short duration and go to other areas. We have also come across another term called as hot money. In this context, we have come across a term called as hot money in this context. FPI is hot money. Why? It quickly comes to India, it may quickly leave, it may go to another country, it may stay there for a short time, it may leave. Hot money is money which moves from one area to another or one hand to another in very short duration. We studied this concept of hot money in the chapter called as money again. Right at the beginning, different types of money. We learned this concept of hot money. So that is an issue with respect to foreign portfolio investment. Okay. Now there is another concept with respect to foreign portfolio investment which I have to tell you about. Something called as participatory notes, shortened as P notes. Now what are P notes? P notes are investment in the share market where the identity of the investor is not known. Investment in the share market from abroad where the identity of the investor is not known. So it is a tool for anonymous investment from abroad. It's a tool for anonymous investment in the Indian share market from abroad. Now, who issues a P note? P notes are issued by these institutions, foreign institutions which invest in India. They issue P notes. Okay. See, I told you earlier itself, when an institution is taking money from a foreigner, it will come to India, it will reveal to SEBI the identity of the person who gave the money. This person gave me the money, I'm investing on behalf of that person. They'll invest the money in the share market. The share will be issued in the name of the person who gave the money. They'll go back and give the share to that person. So that person becomes a shareholder in this company, has a share in that particular company. This is how it works. Now, how does P note work? An investor wants to invest in India, individual wants to invest in India in a particular company, but doesn't want to reveal his or her identity. Gives the money to the company, gives the money to the institution and says, you know what, I don't want the share to be issued in my name, get the share issued in your name. So the share will be issued in the name of the company. And then the company, see, there are rules which say that the company cannot directly invest in the share market. That will be like individual investing. So the SEBI says you can only take others' money and invest. You cannot invest your own money. So SEBI says, why is it that you are investing in your name? So the institution says, I have issued a participatory note to that person. You are participating in that process. On behalf of you, I am buying it in my name. So the institution issues a participatory note. I have taken money from you. This is proof of that. P note is issued. SEBI, they come to India. They tell SEBI, I have issued a P note over there. I am going to get a share issued in my name on behalf of that person. This is how P notes work. Now, SEBI for a long time did not want P notes in the Indian economy. Why? Because that could be a foreigner who wants to incite terrorism into India. So they might be investing money in a company which they probably own through someone else. And then that is a way of bringing money into India. And then once the company receives the money, they may use money for various purposes. They are not earning money domestically. They are getting money from abroad into their shares. It is a possibility. Okay. Or maybe there is money laundering happening. I'll discuss about money laundering in a bit, but maybe there is money laundering happening where the black money which was taken outside India is now brought into India, and some sort of money is given back to India in that sense. So they wanted to prevent all those. They said, I want to know who exactly is giving the money. When the SEBI tried to do that, a huge percentage of the FPI would have stopped coming to India because a lot of FPI comes in the form of P notes. So SEBI ultimately said, okay, we have to accept P notes. And so P notes are there, but P notes bring with it their own risk. The risk is that it leads to anonymity with respect to investment. We don't know where the money is coming from. That is the issue with respect to P notes. Okay. So that completes the discussion on foreign portfolio investment as well. before we go further into loans and learn, there are some peripheral areas with respect to FDI and FPI which I want to tell you about. Then put it in a box and write it. Then I'll get to the loans part. Okay, there are certain negatives of FDI and FPI. There are certain misuse of FDI and FPI norms which could happen. I'll talk about it right now. So to begin with, okay, there is a lot of tax avoidance that happens. I've introduced the term tax avoidance. Just hold on. Has ma'am taught you? I started with public finance, I remember. Has ma'am taught you something about money laundering, your double taxation avoidance agreement? Something called as, let's say, treaty shopping, round tripping. Are you sure? The people on video seem very sure. Okay, no, it is not. Okay. So in that case, I'll go ahead and explain this to you. So tax avoidance. Okay, there is. I'll first introduce a particular tax law. There is something called as double taxation avoidance agreement. Okay, when foreign direct investors come to India, they are expecting some profit out of India. They are expecting that they'll get a little more profit than they could get domestically, which is why they are coming to India and they are investing. Okay. But we have already seen in public finance chapter that be it an Indian firm or a foreign firm, if they are earning money from India, they have to pay a tax on it, corporate profit tax. So they earn their profit and they pay a tax. And once they take their money back to their home country, they are asked a question, where did you earn? Say India. Did you pay tax? Yes. But have you paid tax here in their home country? They say no tax is paid. Then if again a tax is collected, as is done in a lot of countries, if a tax is collected there also, it reduces their profit even further. So they might feel that what is the point of going all the way to India if we are paying so much in the form of taxation? It is like paying two taxes on the same money for the same purposes, two times paying tax. So this discourages the FDI that comes into India. So in order to encourage FDI, India goes ahead and signs double taxation avoidance agreement with a lot of countries. India currently has a double taxation avoidance agreement with about 70 to 80 countries in the world. 70 to 80 countries in the world. So what is double taxation avoidance agreement? India says, I will collect only one or two taxes. I used to collect 4 types of taxes. I'll only collect 1 or 2 taxes. I'll allow your home country to collect the other 2 kind of taxes. So we split the kind of taxation that we collect. Or India is saying, I used to collect 30% corporate tax from you. I'm only going to collect 20% from now. The remaining 10 you can pay over there. Okay, so that's sort of an agreement. That is double taxation avoidance agreement. So far, so good. No problem with this. Okay, but what do some investing companies do? They look for certain kinds of countries called as tax havens. Okay, so they look for countries called as tax havens. See, this concept of tax haven is a very subjective thing. Okay. Tax haven refers to a country where the tax laws are very opaque and relaxed, which means either the tax laws are not there at all, not significant at all, tax rates are very, very low, or even if there are taxation laws, it is so opaque that it can be easily manipulated and you will never be able to find out what is happening with respect to the tax laws. Take Switzerland, for example. There is a lot of opaqueness. They'll not give us any information about their customers or in the banking system who that is there. That is what is called as an opaque structure. Imagine another country where there is no taxation. The government says we are not collecting taxes. Whatever revenue we want, let's say something like Mauritius or somewhere, whatever money we want, we are getting it from tourism. We don't need to collect tax. If they feel that way, then maybe they won't collect tax. Such countries are colloquially referred to as tax havens. It is not an official classification. Some countries, Switzerland is called as tax haven by some people don't agree. Singapore is called as tax haven by some people don't agree. These are claims. These are informal nomenclature. It is not an official classification. All right. So there are such countries. Now, why are we talking about such countries? India happens to have double taxation avoidance agreement with some such countries like Mauritius, for example. India has a double taxation avoidance with Mauritius, which we signed in 1970s. During the period of Indira Gandhi, we signed a double taxation avoidance agreement with them, which continues to this day. They also happen to be a country which is commonly accused of being a tax haven, which means the tax rules are very low, the government's monitoring is very low, there are a lot of no taxes paid and no one is checking. But India doesn't have the jurisdiction to go there and check. They have to check, but they are not checking. All these are the issues that are there. Now, what does an investor do? An investor is now searching for a country which has double taxation avoidance agreement with India and is also a tax haven. The process of searching for a country which is both a tax haven and has the agreement with India or the treaty with India is what is called as treaty shopping. The process by which an investor, a foreign direct investor, is looking for a country where the tax laws are very relaxed, which is it is a tax haven, plus it also has a double taxation avoidance agreement with India. So the investor will directly go take the money to that country, and from there it will show that it is investing in India. So if India looks at it, India finds that the investment is coming from Mauritius. They come and invest in India, they earn profit. Let's say they earn profit, they pay, normally they would have had to pay 30% tax, but because there is a double taxation avoidance with Mauritius, they only have to pay, let's say, 20%, which means the 10% tax they'll be paying in Mauritius. They go to Mauritius, they don't have to pay the tax, which means they are paying only 20% tax. Is this cheating? In the sense, is this violation of a law? It is not a violation of a law. It is not a violation of any law, because the law itself says they have to pay only 20% tax in India. They are well within the law. But India is feeling that if we had not signed that double taxation avoidance agreement, if this investor had actually come from their original country with which we don't have an agreement, then they would have had to pay 30%. We are losing out on 10%. Potential tax that we could have collected, we are losing out because of manipulation of tax laws. It is tax avoidance strategy. It is unethical, not illegal. Similarly, there are other sort of measures which are taken by some foreign companies in order to not pay taxes in India. Something called as base erosion and profit shifting. This is again not a tax avoidance, not a tax evasion, but a tax avoidance. Now, what is base erosion and profit shifting? BEPS. I'll give an example. Let us say a foreign company comes to India and does production. Okay. Let us say if it were to get all the raw materials from India, the cost of production would be 80 crore. The cost of production would be 80 crore. And it sells and its revenue is rupees 100 crore, which means it is making a profit of 20 crore. It is making a profit of 20 crore. On the 20 crore, it will have to pay a tax. It will have to pay a tax. So that is the profit. Now, what they sometimes do, some companies do, is that they will not buy the raw materials from India. They will not buy the raw materials from India. They'll say, we have a prior agreement that we'll buy the raw material from our partner company in some other country. Okay. They'll buy the raw material from their partner country in some other country, or partner company in some other country. Okay. But this time what they do, for procuring the same raw material, it is not costing them 80 crore now. With that company, it is costing them 100 crore. It is costing them 100 crore. That company is giving a bill saying we need 100 crore for all the raw materials. So they make the payment of 100 crore. Ultimately, when the revenue is 100 crore, when the production value cost is 100 crore, the profit becomes zero. They are not paying any tax over here. Okay. Now you might think they are not paying tax. Okay. The base of the tax is getting eroded. Tax base is the 20 crore. It is getting eroded to another country. You see the tax base erosion. Base is getting eroded to another country. Now you might wonder, what is the point? They are avoiding tax here, but ultimately that other company will have to pay tax there, right? So that is where the other trick comes in. Through treaty shopping, they would have set up the partner company in Mauritius, which means that the tax that they are supposed to pay there, they don't have to pay. So the entire 20 crore, which is their profit, they have successfully shifted it there without paying a single penny as taxation. Earlier, what they were doing, they were reducing the amount of tax that they paid. Now they are not even paying the tax because they are shifting their entire profit to the other country. Profit shifting, base erosion and profit shifting. They are shifting their profit to the other country, which happens to be a tax haven country. Right? Okay. Now, it doesn't end here. There is one more thing that happens in the exploitation, in base erosion and profit shifting itself. Okay. What happens is, instead of procuring some raw materials from a foreign country, if the Indian government says that, no, you cannot procure raw materials from a foreign country, you have to get it from Indian company itself. Okay. So 80 crore is what the cost of production is. Now, what they'll do is that they'll say, we have some accounting services which we require. We need to do our accounting internally. We need to do our accounting, or we need some IT services or something of that sort. We need some training program which can only be delivered by our partner company, which is located in Mauritius, very, very conveniently. So that Mauritius is now providing not any goods. It is not providing any goods. It is providing services. Okay. Services, as I already told you, are invisibles. So the government actually cannot go and verify whether the service was delivered or not, whether the Mauritius company is providing the accounting services or are they doing it domestically itself. We don't know. But they'll claim that the Mauritius company is providing the services, and they will transfer another 20 crore to that company, saying for accounting services, for IT services, for training services, whatever it is, 20 crore you take. So 100 as an expense that is added. Now, if you actually go there and see, in Mauritius, if you go and see, there is no such company at all. On paper, such a company is registered, because Mauritius government will otherwise get in trouble for enabling this sort of cheating. On paper, it is registered. That is all that they can show. Mauritius government, if you ask a question, they'll say, see, this is the record, this is the document. In the document, on paper, the company exists. But if you actually physically go and check such an address, such a building, nothing will exist there. Such a company is what we call as a shell company. A company which exists only on paper. In reality, such a company doesn't exist. That is what is a shell company. This is what a lot of Indian celebrities and other people are accused of doing. Okay? Not just Indian. The Pakistan Prime Minister, ex-Prime Minister who lost his position, who had to resign, Nawaz Sharif, was also accused of the same thing, where they invest a lot of their money in these companies. They say we have a company there which is running there, which is functioning there, they transfer it, but in reality there is no such company. So they are transferring their money into those companies in the name of shell companies. Okay. Now that is a shell company. So all that we have seen so far are tax avoidance. Now we also have tax evasion that is happening. Tax evasion happens within India. Okay, tax evasion happens within India. We have already seen in a previous in public finance that tax evasion is where you are violating a law, you are hiding the money that you have generated from the government, and you are not paying tax. This results in black money creation. Tax evasion is illegal. You are hiding your income from the government. This leads to black money creation. Black money is the entire money which you are hiding from the government, not just the tax that you have not paid. Let's say 50 lakhs you are hiding from the government, on which your tax you are supposed to pay was 5 lakhs. The entire 50 lakhs becomes black money, which means you cannot put that black money in a bank account anymore in India. You cannot do that. Okay. But if it is a black money and if it cannot be put in a bank, you cannot use it for a lot of purposes, especially currently in India, where there are restrictions saying any transaction above 2 lakhs cannot be in the form of cash. It has to be in the form of bank transfer. All those restrictions are there, which means handling black money is a challenge, which means money needs to be converted to white money. In other words, dirty money needs to be cleaned. The process of cleaning dirty money, the process of cleaning clothes, dirty clothes, cleaning it is laundering. With respect to money, when that happens, it is money laundering. I'll give you a general idea of how money laundering could happen. If you are very smart, you will know that you cannot learn money laundering from this class and go implement it in life, because you will get caught. That is the level of expertise that I have. Don't try this at home. That is all. That is the disclaimer with which I am going to teach you this. Okay. How to launder black money. That is the heading. Okay. So I'll explain it with the example of what is shown in this movie called as Shivaji, Rajinikanth movie. So after all of Shivaji's money is actually taken away by the government in this way or the other, in the form of giving corruption, ultimately Rajini or the Shivaji gets the black money of the villain, and Shivaji has to find a way to launder it, get it as white money. So what does Shivaji do? Shivaji goes to some agent and hands over this money. What that agent does is, so there is a handover to an agent. Okay, the agent finds some way or the other to transfer this money to a foreign country. Now, what is this some way or the other? I'll explain that also. The course will be very comprehensive, don't worry. So what does that agent do? The agent will have a lot of shell companies. Okay, why do I say a lot of shell companies? Because if the value of the company is greater than, we have already learned when we learned GST, that you need to register for taxation only if the value of your company is greater than 40 lakhs. You need to pay come under the taxation laws only if the value of your company is great. So a lot of small value companies are registered, which need not pay tax, which need not show their accounts to anyone. So these small companies, they will transfer money to the foreign country saying that I acquired this service from them, I acquired this service from them, mostly services, because services are not traceable. I acquired this services and money gets transferred. And because these are small companies, there is no question of where did you get your income from. All these are small value transactions. Many such small value transactions, money reaches the foreign country. Now, from foreign country, what happens? Again, there is a manipulation of tax laws here. In India, there are rules which say that if there is a contribution that comes into, let's say, Shivaji Educational Trust, Shivaji Medical Trust, or Shivaji Social Work Trust, something of that is what happens in the movie. So money keeps coming into all these NGOs and trusts and all those. When contributions come from abroad into these trusts, there is no need to pay taxes. And legally, the money has come back into the system as white money into various trusts, NGOs. This is the reason why over the last couple of years, the government has been doing a heavy crackdown on these some NGOs, saying that they are receiving funding from abroad, it is money laundering, or they are involving in anti-national activities within India. So that happens, and the money has been now converted into white money, legal money, which is exactly what happens in the movie as well. And that money can be used freely now for building schools and colleges and all those things. Okay, so that is the black money to white money process. This process is also sometimes referred to as round tripping. Why? Because money starts from India, goes all the way abroad and comes back to India. This is what is also known as Hawala. See, Hawala per se is nothing negative. In the olden days, there used to be a system where if you are traveling on a road and the road is very not a very safe road, the olden days of traveling on roads are not very safe. You cannot carry your entire wealth there. So you will deposit your money to some agent over here. They'll give you some a slip which says, I have this money with you. You go there. This agent's partner will be there in that other location. And once you show the slip, they'll give you the money. Not the same money, they'll give you some other money. Okay, there is no physical transport happening, but on paper there is a record happening. So that was Hawala system. In India, that used to be called as the Hundi system. Okay. But when it started being used for these negative purposes, Hawala also acquired a negative connotation. Right? Now moving on. So that ends our discussion on all the peripheral areas. We'll once again get back to the capital account. We were talking about the next one, which is the loan account. We have looked at the foreign direct investment account. We have looked at the foreign portfolio investment account. We went into elaborate details about what is good, bad, and all those about that. Then we have come to the loan account. Loan account, primarily three things that we are going to talk about. Government borrowing, external commercial borrowing, and bank deposits from abroad. These are the three types of loans that are there. We have already studied about government borrowing in public finance, so I am not going to go into further details about that. External borrowing from foreign institutions, your historical rate of exchange, and all those, we have already learned about that. Okay. In public finance, we have come across that. What is external commercial borrowing? There, the government borrows from abroad. External commercial borrowing is a scenario where Indian private companies borrow from abroad. Okay, Indian private companies borrow from abroad. Now you might wonder, why would an Indian company, private company, borrow from abroad when there are so many Indian banks? It need not be an Indian company. Maybe someone wants to do FDI in India, a foreigner, they might borrow from their foreign bank and bring that money into India. So it is a company situated in India which owes money outside. Or maybe they have a branch there. Maybe an Indian company itself has a branch there and they have borrowed some money and that obligation comes to India. Any of these is a possibility. This is called as ECB, external commercial borrowing, obligations of Indian corporates to the foreign banks. When I say Indian corporates situated in India, based out of India. It is not Indian in nationality, but Indian in location. Okay. And bank deposits from abroad also I have taught you previously. I told you about NRI deposits. There is non-resident external account and foreign currency non-resident FCNR account. While talking about that itself, I had made a distinction very clear that these deposits are not to be considered as remittances. Remittances go into someone else's account, deposits come into their own account. If it comes into, let's say I am living abroad, I am depositing money, at any time I can withdraw. So it is temporarily there in India and I will be getting interest on that as well. So those two are also treated as loans. Yeah, that is the loans in the form of bank deposits from abroad. Non-resident external account and FCNR account are the examples inside this. Rini, what was the question about profit? I didn't understand. I didn't see in what context you had said that. Can you tell me the context? If you don't mind typing it again. Okay. So that is the loan account. All right. I'll wait for Rini to type it in. Meanwhile, we'll take a look at what is the situation here. We said current account, we are in a negative current account deficit. Okay. Now coming to capital account, in the capital account, we have we have foreign direct investment. Already we said we receive more foreign direct investment than we do. So foreign direct investment is a positive. Don't think positive means good for us. That is what I told you clearly. Positive means inflow. In this particular year, we have more inflow of foreign direct investment than outflow. That is what it means. Coming to foreign portfolio investment, there are years in which, a lot of years in which foreign portfolio investment is positive, but there are some years when it is negative also. Now you might wonder, if it is negative, does it mean that Indians are doing more foreign portfolio investment outside? Not necessarily. With respect to this account, because it is two-way, so I bring in money, I take money. So a foreigner brought in investment, when they take it back, that is also treated as outflow. So there are some years in which, when the Indian economy is not doing well, the earlier FPIs may now leave India. That is also the foreign investment outflow. Okay, in outflow of foreign investment, capital outflow is also treated as a minus there, negative there. So some years it could be negative also, but predominantly that is also positive. All right, Rini, I'll answer that. And then in the loan account also, we tend to receive more than we give, except in years where our principal and interest obligations are greater than what we take as loan, then it could be negative, but generally it is a positive, which means that overall capital account itself is in positive, but we do not use the term capital account surplus because that surplus is not real. We do not use the term capital account surplus because that surplus is not real. Okay, it is not an actual surplus that is there. Okay, but we have a surplus there, we have a positive over there. Now keep this in mind. Now we are going to bring it all together. Rini, I'll answer that question maybe at a later stage because we are in the middle of this topic. There is current account balance. There is capital account balance. Which is equal to balance of payments. An ideal situation. What is the ideal situation? It says balance of payments. An ideal situation of balance of payments is where you have a value of 0. Now assume everything being in dollars because it's about foreign currency. Okay, assume that we have a current account balance of minus 100 deficit, and we happen to have a capital account balance of 100. Then we'll have a balance of payments of 0, which is the ideal scenario. Okay, in terms of balance of payments, that is the ideal scenario because there is an automatic balance that is happening. Such an account is also called as autonomously balancing account. Autonomously balancing account. Such an account is called as autonomously balancing account. But this doesn't normally happen. Okay, it doesn't happen automatically. Unlike the budget, in the budget, whatever is the shortfall, whatever is the fiscal deficit, only that much the government is going to borrow because it is directly under the control of the government. Here, there is no one entity on the one side. It is all of India on one side and the rest of the world on the other side, which means there is no one controlling it. There is no one entity which is controlling it, which means that a perfect 0 is not a likelihood. Okay, what is more likely to happen is there is a current account balance of 100, we get a capital account balance of 150. This is what mostly happens in India, which means we have a balance of payments surplus of 50. Balance of payments surplus. or payments surplus of 50. Or in another case, we might have a scenario where current account balance is minus 100, capital account balance is only 50, which leads to a deficit, plus, which leads to a deficit of 50, balance of payments deficit of 50. Okay, this was India's situation. Let's say prior to 1991, a lot of years, this was the situation in India. We might have some other situation, say a country like China. What you will notice is that they'll have a current account balance of 100 and they'll have a capital account balance of, let's say, 100 or 50 or whatever it is. Okay, it could be 100 or it could be 50, either way. Okay, let us say it is 50 itself, which means they still have a surplus. Now you would wonder, how come their capital account is in negative? Obviously it will be negative because they have extra money. They have so much extra money. What they do, some they'll keep in reserve, the remaining they'll go and invest. But with respect to China, they're not investing. They're giving loans. They'll give a loan to Pakistan, they'll give a loan to Sri Lanka, they'll give a loan to Mauritius. They will try to put a garland over India. You would have probably heard of the string of pearls theory. You will learn about it in the bilateral classes or international relations class if you have not already done. So that theory is there. They are using that money for loan and investment purposes across the world, primarily in this region. They use that. How did they get that? They are an export-oriented economy. They are getting a lot of money through their exports. So they have a positive over here. Okay. So if you have a positive over here, a negative value here could actually be a good indicator. When you have a negative here, your positive here becomes a necessity. But this positive is not necessarily a good indicator. That is why we don't really care much about the surplus in the capital account. It's not necessarily a good indicator. Okay. So whenever there is an imbalance in the balance of payment, there is a deficit or a surplus, what happens is the Reserve Bank of India comes into the picture. Remember the roles of Reserve Bank of India? Manager of foreign exchange reserves, forex reserves. So they say there is an excess here, we need a balance. What I'll do is, whenever we have an excess, the RBIs will say, so ultimately all this money is in the hands of the banks. All this money is in the hands of the banks. So the RBI says, I'll take the $50 from you, I'll give you the equivalent of that in rupees. RBI is not just taking it away. RBI is exchanging this, and RBI will go and take this $50 and add it to India's forex reserves. Why does it do it? Because ultimately managing the balance of payments is the responsibility of the Reserve Bank of India. So when there is a shortfall in a subsequent year, RBI will not sit idle. RBI will go and tell the banks, you are falling short, I'll give you $50, you give me Indian rupees. So whenever there is a shortfall from the forex reserves, they'll use the money and they'll adjust the requirements. This sort of a balancing is called as balancing through accommodative transactions. I'm writing it over here. Balancing through accommodative transactions. All right. Okay, so Vamshi has a question. Why loans given by Indian banks to foreign companies? They are mentioned. I just did not mention it. I was mentioning only one side. When I say government borrowing, this loan account also includes the government loans given by the government of India. So I'm sorry about this. I only mentioned one side of it. This includes loans given by the government of India. It includes money borrowed by foreign companies from Indian banks also is included. Similarly, deposits made by Indian people living in India in foreign banks is also included here. So it is both. It is not just one side. I explained it with respect to the Indian side. That's all. Whenever you say account, it includes both ways. Okay. So thanks for pointing it out, Vamshi. I got carried away and I mentioned only one side of it. It is applicable from both sides. Definitely, Arsana, I'll do it. Okay. Or I'll do it right away. So just to give a clarity on this topic. So whenever there is an excess in the balance of payments, when there is a balance of payment surplus, what the RBI does is, RBI says we want ideally a balance. This is a good opportunity when there is a surplus to take the money and add to the forex reserves. So RBI will give Indian rupees to the concerned banks who have this extra foreign dollars and get the dollars from them by paying the Indian rupees, and it will fill up the forex reserves and thereby balancing the BOP account, accommodative transaction. What is the accommodative transaction? The RBI giving rupees to get the dollar. And whenever the banks are falling short of dollars, RBI will supply dollars and take in exchange for Indian rupee and say, use it for your transactions. So both these are accommodative transactions. Archana, I hope that clarified your question. Okay, that is how balancing is done. Now that concludes our discussion on balance of payments. Now we'll get to exchange rate determination. Okay. First, we need to understand what is meant by exchange rate. Okay, what is meant by exchange rate? Understanding that is very, very important. Exchange rate is a concept that is applicable in a lot of places. You go to a store, you want to buy a pen, you say, I'll give you 100 rupees for this pen, or they are charging 100 rupees for this pen. They are saying that if you give me 100 rupees, in exchange of that, I'll give you this pen. So that is the exchange rate of this pen. But why do we not use the term exchange rate there? Why do we use the term price? Because the term exchange rate is normally used when we are comparing two equal things, two similar things. When we are looking at the value of one in terms of another, where both the commodities are similar in nature, we use the term exchange rate. For example, let us say we are in a barter economy, where I say 2 pence I will give you if you give me 4 pencils. Then the exchange rate of 1 pen is equal to 2 pencils. This is called as exchange rate. You will not say what is the price of a pen. You will not say the price of 1 pen is 2 pencils. You will say the exchange rate between pen and pencils is 1 is equal to 2. Okay, the exchange rate of a pen is equal to 2 pencils. That is what you will say. When you have similar items being compared, that is when the concept of exchange rate comes into the picture. In both the cases, if you are talking about price of a commodity or you are talking about the exchange rate, both are talking about value of a commodity, value of a particular commodity. In this case, the value of a pen is 2 pencils. If you're talking about money, the value of a pen may be 10 rupees. Both talk about value. But when you have two similar comparable commodities on both the sides, we'll refer to it as exchange rate. Otherwise, we'll refer to it as price or cost or something like that. Okay. So now in this context, exchange rate is a word which could be used anywhere. But in this context, we are referring to exchange rate as the comparison of value between two currencies. In this context, between two currencies. For simplicity, we are taking dollar and rupee. It need not be dollar alone. It could be euro, pound sterling, mark, Japanese yen, Chinese yuan. It could be ringgit. It could be any currency. Exchange rate is available between any two currencies in the world. It is possible. For convenience, let us take dollar to rupee. Can someone tell me what is the exchange rate between dollar and rupee? Approximately $1 is equal to. Okay, let's round it off and write it as 70. It could be 71, 72, 69, doesn't matter, approximately 70. $1 is equal to 70. Now, what does this mean? What does the exchange rate between rupee and dollar mean? It means that if I require $1, if I have to get $1, how much will I have to pay? I will have to pay 70 rupees. Where will I get the dollar from? Here we are actually talking about getting a real dollar. Okay. So I am trying to get a dollar from a bank. I go to a bank, I say I want $1. Bank will ask, why do you require a dollar? The bank will not just like that give me. I'll show my import license and say, see, I have an import license. I have to pay a dollar to that person. Okay, give me 70 rupees, I'll give you a dollar. You pay 70 rupees, you get a dollar. That is what is the exchange rate. Or I might be an exporter. I might have sold my commodities at $10. Now I have $10 with me. I cannot use $10 domestically because it is not legal tender in India. It is not legal tender in India. I cannot use it. So I go to a bank, I give $10. Bank will ask, where did you get this from? I show my export bill. See, I exported. That is how I got it. This is my source of income. Bank says, okay, fine. And they'll give you back 700 rupees because I gave $10. They'll give 700 rupees. Actual exchange rate of exchange between two currencies is what this shows. This is what is exchange rate. Okay. This exchange rate is of no relevance to you or me in a normal sense. Because we don't transact in foreign currency, we don't require it. It is mostly required for exporters. The closest where you and I, we may have to use it is when we ask our friend to buy some Apple product from USA and we have to make a payment to them. We'll have to look at the exchange rate and we have to pay the corresponding Indian rupee. Even then, we don't deal in foreign currency. We look at the concern because your friend would have paid in dollars. Now you are paying him, you will be paying in Indian rupees. So there you might require, other than that, in a practical scenario, we don't require this at all. It is the traders who require this, the importers and exporters who require this. Okay. Now let us look at how do we arrive at the value of $1 is equal to 70 rupees. Let us have an imaginary situation where $1 is equal to 1 rupee. It is not such an imaginary situation. In 1947, when we got independence, this was the actual scenario. $1 was equal to 1 rupee at that point of time. Even in 1990, $1 was somewhere equal to around 20 rupees. 1990s, around 20 rupees, 17, 18 or something like that. So that is how the exchange rate was. Let us assume this is the exchange rate. Okay. Now, exchange rate, I told you, is the price or the value of a product. Value of a dollar in terms of rupee or value of a rupee in terms of dollar. That is what is exchange rate. How is the price of a commodity determined? We have already discussed this in the chapter called as inflation. How is the price of a commodity? Not just inflation. Right at the first chapter itself, when you learned about circular flow of income, we would have discussed this. How is the price of a commodity determined? Thank you for the exact value, Harini. Okay, Sri Lakshmi has an answer. It depends on demand and supply. As simple as that. Okay, supply first and demand later. Why do I say supply first? Supply refers to the cost of production. If you're talking about a pen, what is the price at which this pen, cost at which this pen is produced? I cannot sell it at lesser than that. So the price is first fixed based on that. I produce 10 pens. My cost of production is 100. I can sell the pen at 10 rupees. Assuming in the cost of production, I'm also including profit. I can sell it at 10 rupees. Okay. Now, 10 pens are produced. I'm selling it at 10 rupees. But there are 20 people who are asking for this pen. They are competing with each other and saying, I'll pay 11 rupees, I'll pay 12 rupees. Based on the demand, the price of the pen rises to, let's say, 15 rupees. So I'll probably sell my pen at 15 rupees. So price is determined, one by supply, the other by demand. Now let's look at what is supply here. Okay. Let us look at a scenario where there is supply, there is demand. Who supplies US dollar into India? Exporters supply US dollar into India. Why do I say so? Exporters earn foreign currency. They cannot use it here. They go and give it in bank and exchange it for Indian currency, which means who's supplying it to the bank? The exporter. The earner of foreign currency, the receiver of foreign currency is the one who's supplying it, which means the exporters who earn through goods, through services, the remittances that we receive, the grants that we receive, the income that in the form of profit, dividends and interest that we receive, plus the FDI that comes in, the FPI that comes in, the loans that come in, all of this is leading to supply of foreign currency into India. Because the foreign currency that comes in cannot be used as it is because it is not legal tender. So it goes into the banking system, supply of foreign currency. Who demands foreign currency? The importers, the payment, the ones who are making payments, the ones who are doing FDI, they are the ones who are demanding. For convenience, we can simply say exporters supply, importers demand. For convenience, we can say that exporters supply, importers demand. Okay, so let us say exporters have supplied $100. Exporters have supplied $100. Okay, there is a given price. Right at the beginning, there is a given price. Let us assume this given price is fixed as $1 is equal to 1 rupee. That is the given price. That is like the cost of production to begin with. Okay, they have supplied $100. Now let us say the importers are also demanding $100. Sorry, I meant $100. Now they are demanding $100. This does not automatically mean $1 is equal to 1 rupee. We also have to ask a question: how much are the importers willing to pay for it? The importers have, let us say, 100 rupees in their hands. If the importers have 100 rupees in their hands, then the $100 which will be supplied, they will get the $100. They are demanding the $100, but when 100 rupees being available at $1 is equal to 1 rupee. Let us say that $200 is being demanded for export now. Automatically, the Indian rupee supplied should also go up. The Indian rupee supplied, because if they are demanding $200, what is demand? I've told you this previously. Demand is not just a desire. Demand is desire backed with the ability to pay for it, which means they have the corresponding Indian currency. They have 200 rupees, because at that time, $1 is equal to 1 rupee. If they're demanding $200, they have 200 rupees with them. So 200 rupees is available to get $100, but there are only $100 available. Automatically, the price of the dollar becomes $1 is equal to 2 rupee. Why? Because demand is $200, 200 rupees is available. Looking at the prevailing rate, 200 rupees is required, it is available. So $100 will be going at, sold at 2 rupees per dollar. Let us say, once again, this is sold. Once again, another $100 comes in. The import goes up even further, which means they'll have, in this case, already the price is 2 rupees per dollar. So for 300, they would require 600 rupees. They would require 600 rupees. Okay, but only $100 is available. So with 600 rupees available for $100, now $1 may even be sold as high as 6 rupees. Depending on why 6 rupees, because 600 rupees is available. At the prevailing price for $300, you need to have 600 rupees, because $1 is equal to 2 rupees already. So they need 600 rupees. They have 600 rupees. They are willing to pay 600 rupees for that $100, which means $1 will be equal to 6 rupees. This is how the price of dollar keeps on varying. Now, what is impacting it? As the demand for dollar increases greater than the supply of dollar, then you need to pay more and more for the dollar. Demand for dollar is higher, you need to pay more and more for the dollar. If in the converse, if in the opposite scenario, if the supply of dollar is greater than the demand for dollar, then the price of dollar will keep coming down. Then the price of dollar. So what are the suppliers of dollar demanding? The suppliers of dollar are demanding rupees, which means the demand for rupee is going up. The demand for rupee is going up, the supply of rupee is going down. Who's supplying rupee? The importers are the ones supplying rupee, going to bank, giving rupee and asking for it. So the demanders of rupee are demanding more of rupee. The suppliers of rupee are reducing the supply of rupee, which means that the rupee will gain in value, which is the same as dollar losing value. Okay, you know this, right? 1 pen is equal to 10 rupees becomes 1 pen equal to 20 rupees. It means the price of the pen has gone up, or you can also say the value of money has come down. I explained this with an example in the inflation class. Okay, you could say inflation is increase in the price of a pen or decrease in the value of money. Similarly, here also you will find that when the dollar's value is increasing, automatically rupee's value is decreasing. When the dollar's value is decreasing, the rupee's value is increasing. So far clear? This is how the exchange rate is determined. Okay, I'll just finish with one last concept, because we have discussed this. On a related note, I'll explain with, leave with one particular concept. Imagine this scenario where $1 is equal to 50 rupees to begin with. $1 is equal to 50 rupees to begin with. Okay. Now, let us say India is a country where there is a lot of imports happening. Our imports are significantly greater than exports. We always are dependent on oil for our imports. When the imports increases, what happens? Demand for dollar increases. When the imports increases, the demand for dollar increases based on what we have seen so far. When the demand for dollar increases, what happens to the rupee? The value of rupee goes down. Okay, the value of rupee goes down. What is the process of decrease in the value of rupee called? It is called by the name depreciation. There are two terms: depreciation, appreciation. Depreciation is decrease in the value of money. Appreciation is increase in the value of money. So increase in the demand for dollar leads to appreciation of dollar. Why? Dollar, which was fetching only 1 rupee earlier, dollar is now fetching 2 rupees, dollar is now fetching 6 rupees. Here, dollar, which is fetching 50 rupees, is now, let's say, increasing and is fetching 100 rupees. A dollar is fetching 100 rupees now, let's say, which means that Indian rupees value is going down. You can call this as either appreciation of dollar or depreciation of rupee. When the value of rupee depreciates, what happens? Who's benefiting here? See, look at the importer. An importer had to pay 50 rupees to get a dollar. When the imports are increasing, more and more demand for dollar. So the bank is saying you need to pay more and more to get a dollar. 50 rupees has become 100 rupees. Now the importer is having to pay 100 rupees to get a dollar, double the price to get a dollar. Importer will say, I don't think it is profitable for me, I'll reduce my imports. But there is some other entity who's gaining. The exporter, who was earlier selling his product for $1, was getting only 50 rupees. Now, producing the same product for 40 rupees, he's selling it outside for $1. Earlier, he was gaining 50 rupees. Now, he's getting 100 rupees with no extra effort, just because the rate has changed. So now the exporter will feel, wow, this is an amazing opportunity. Let me increase more and more production. So the exporter will try to increase exports. The exporter will try to increase exports. This will lead to exports increasing. This will lead to exports increasing. Now, exports increasing will lead to supply of dollar. Supply of dollar increasing. More and more exports, more and more dollar gets supplied in the banking system. The exporter will earn the dollar and supply it in the banking system. Okay. That would mean when the supply of dollar increases, the value of dollar goes down, the value of rupee goes up. It leads to appreciation of rupee. What is happening? It goes back to $1 is equal to 50 rupees. Now, once again, the exporter is feeling, now I had some advantage earlier. I don't have that advantage anymore. I don't see the point of increasing exports. I'm going to restrict it. But the importer says, I had reduced my imports because it was very costly. Now it is not very costly. I'll start importing again. It will lead to increase in imports. So this is the cycle where imports leads to exports through depreciation and appreciation, or exports leads to imports and further exports through appreciation and depreciation of the currency. Okay, so there is this concept of depreciation, appreciation. Time is past 8:15 that I had told you. Sorry about that. So tomorrow when we join at 1 o'clock, right? 1 to 4:30. Tomorrow when we join at 1 o'clock, we will once again take a look at depreciation and appreciation, like a continuation of today's class. I'll define depreciation and appreciation for you. I'll also introduce the concept of devaluation and revaluation. What is that concept? And then I'll probably give you a better idea of this. If you have queries with respect to this, you can ask me this again tomorrow. And then maybe in hour and a half, we should be able to finish external sector. Purchasing power parity is not done by ma'am, I assume, in the second chapter. I didn't do the second chapter for you, right? So that also will be left over. And then we'll move to the financial markets. Financial markets is a very small class. 1.5 to 2 hours should be enough. Okay. So we'll finish that because it's only the basic introduction that I give you. So at 4:30, we'll be done with core economics class. Okay. If you have any questions, you can stay back and ask. If you want to, talk to me, if you want to unmute and talk, you are free to. Otherwise, you can disconnect and leave. Thank you so much, Jawahar, Sri Lakshmi, and Rini. Jawahar, you seem a little confused probably towards the end. If there is any question that you want to ask, you can ask me. Seem a little confused, so you can ask me that. Thank you for coming on video. I hope tomorrow also you guys continue to be on video. I hope you guys come tomorrow, and then if you come, you continue to be on video. Thank you. All right. Welcome, Sri Lakshmi. Yes, Ashwin is asking, sir, once again, can you explain bank deposits from abroad? Ashwin, just hold on for some time. That's a different concept. I'll explain it maybe in some time. Just related concept. If there is anything, I'll try to answer that first. Harini is asking, sir, what if that again happens? That is 1 rupee equals $1. Does that mean our economy and our GDP has been increased, or will the situation remain same as of now? There is no straightforward answer to this, Harini. So what we'll do is, in tomorrow's class, we look at what is the impact of appreciation and depreciation. So for $1 to become equal to 1 rupee, there is a significant appreciation of currency that has to take place. I'm talking to Harini here. So a lot of appreciation has to take place for the currency to fall from, or for Indian rupee to gain from $1 is equal to 70 rupees to $1 is equal to 1 rupee, which means that it will encourage a lot of, it will be a discouragement for exports. Because when $1 is equal to 1 rupee, you produce something, you sell it in the foreign market, you come here, you are only going to get very little money. 1 rupee is what exporter will get. Okay. So the problem with a very strong currency is that exporters will not gain, but it will lead to a lot of imports, which would mean that maybe Indian industries would suffer in the sense that India would start importing a lot. This is something that you observe in America. America, the cost of production is so high that they tend to import almost a lot of their stuff they import from outside, because their cost is very high compared to that. So it is not necessarily a good situation, nor is it a bad situation. If overall we are in a good position where India is at the peak of production, then $1 is equal to 1 rupee is okay. But in the current situation, where the production itself is not at its peak, if our currency is undervalued, it would mean that we might end up importing a lot from outside, which will harm our domestic industry. So our currency being at this level is not very bad for us. I hope that is clear. I think my mic is working fine. Is my mic not working? Jawahar, are you not able to hear properly? Okay, it's working properly. Rini, I don't know. Oh, at that time it was not working. Okay, yeah, I'll explain that. Yes. With respect to US has trade deficit with India, then how dollar is greater than rupee? See, Shivapriya, US has trade deficit with India. That is only with respect to trade, right? Trade of goods. Then there is trade of services. Then there is, you also have other things like FDI. There is a lot of FDI coming from USA into India, right? That all that has to be taken into consideration. It is not just trade alone. Trade deficit only indicates the trade in goods. There are other factors which play a role as well. Okay. Plus, US dollar is always demanded for other purposes also. India is asking for a lot of US dollars, not just to trade with US alone. India uses US dollars to trade with other countries also, which means India's demand for US dollar is not just to trade with USA, but to trade with other countries also. So that means that the demand for dollar is always greater than the supply of dollars. That is the reason why Indian currency seems weaker. All right. Vamshi is asking, could you explain balancing through accommodative transactions? Yes, Vamshi. Whenever there is an excess in the balance of payments, whenever there is a surplus in the balance of payments, where in the current account or the capital account there is excess than in the other account, then what happens in the overall economy? There is an excess of foreign currency available with the banks. RBI feels if there is excess of foreign currency, it could lead to appreciation of Indian currency beyond what we want. To prevent that from happening, the RBI will intervene and RBI will buy those dollars from the banks and ensure that in the balance of payments, there is zero, there is balance. Similarly, whenever there is a shortfall of foreign currency in the banking system, where importers are demanding a lot of foreign currency, but the banks don't have that. So the RBI may step in and the RBI may say, we require this money right now, so I'll give it to you, you give me Indian rupees, which means the bank will buy US dollars from the RBI. This process is called as balancing through accommodative transactions. I hope that is clear, Vamshi. Then 208825 is asking how depreciation of rupee value results in high exports. Okay, so $1 is equal to 50 rupees. $1 has become 100 rupees. That is depreciation of Indian currency. That concept is depreciation of Indian currency. $1 is equal to 50 rupees, now becoming $1 is equal to 100 rupees is depreciation of Indian currency. Indian currency's value has gone down. American currency's value has gone up. So that is depreciation. Now, an exporter is exporting for $1. Let us say I produce something, I produce a pen and I'm selling it in the foreign market for $1. Whether there is appreciation or depreciation, it doesn't matter. The sale price is going to be $1 itself. My sale price is going to be $1 itself. Okay, so I sell it for $1. When I bring that $1 back to India, earlier when currency $1 was equal to 50 rupees, when I gave the dollar, I was only getting 50 rupees. Now, when I give that dollar after depreciation, I am getting 100 rupees. So as an exporter, I am getting unbelievably huge profits. So this will motivate other exporters to produce more and more for exports. That is how it acts as an incentive for exports. I hope that is clear. Nameless person from Ananagar. Okay. All right. So bank deposits from abroad is something that you have asked, plus someone else has asked me about profit shifting. Yes, I'll explain both. See, bank deposits from abroad, as I told you in the class called as money. Okay. So some non-resident Indians may want to deposit some of their money in India, in an Indian bank. Why? Because they might say eventually they'll come back and settle in India, so they would require it, or they want to save for the interest. India is providing a higher interest than, let's say, US bank, so they might want to save in India. So when they deposit their money into their own account, it will not be treated as remittances. When they give the money to someone else, that is when it is called as remittances. Here, when they deposit the money in their own account, at any time that they want, they can take the money back, which means from a bank's perspective, it is a loan that they are receiving, which they'll have to give back after some time. When you deposit some money with the bank, it is like you are giving a loan to the bank, which the bank has to give back whenever you ask. Similarly, when they deposit money from abroad into their account, it is like a loan they are giving to the bank, which they might take back at any time. That is why bank deposits are treated as loans. I hope that is clear to you, Ashwin Sriram. Now coming to, yeah, welcome. Rini asked me a question. Gopi, just hold on one second. I didn't see your raised hand. I'm sorry. I was answering the comments questions. So Rini asked me a question about base erosion and profit shifting. What about base erosion do you want? Okay, you had a doubt. Let me go back to that doubt. Okay, yeah, your question was whether, see, if they, I had told you that they will buy the product which they were buying at 80 rupees domestically at 100 rupees from a foreign company. Okay, from a foreign company, or they'll say they'll buy it domestically from 80 and then they will show that there is some services which they have received and they'll transfer 20. Either way, their expenditure becomes 100 crore. Now your question is, how come they get a profit? Because their profit is gone away. This is where the trick is. That other company is not some other company. That company will be a subsidiary company of this own company, which means ultimately from this company to their partner company, they are transferring the money. Ultimately, the profit comes to them itself. The profit is getting shifted. I hope that is clear, Rini. Okay. Let me just check 1 second. All right. So there is one more question. External commercial borrowing. I'll take that in a moment, Anu. Gobi has been raising his hand for a while now. I had missed it. Sorry about that. Gobi, yes, you can unmute.
Good evening, sir. Sir, my question is regarding the evergreening concept that you mentioned after the banks. They are not able to recover the NPA, they give the loan and then they reduce the NPA like that. So, but when we look at it, from the banks or a regulator's perspective, it can be disaster. But when you mentioned about businesses, when they want to do the business and they want to repay the loan, but they are not able to do because their business is not good. In that case, this concept, like this evergreening, can help them, right? So that means like you are also reducing the NPA, but you're also giving the time, or you're also giving some more leniency towards the business, so that they can work and then they can give you the money back, right? So how come it becomes a bad thing, sir?
It becomes a bad thing because whose money is the bank giving away? It is a risk, right? You agree, Gobi, that it is a risk. Why? Because already the company is performing poorly. So let us say a loan of 1 crore is given to them already. That money itself is under risk. Now you are giving another 50 lakhs to them, thinking that the company will work well, hopefully. Now, what is the guarantee that it will happen? And the other thing is, if it is your money, you can choose to give. This is not the bank's money. This is the people's money. So if they take a risk like this, then the people's money, not 1 crore, now 1 crore 50 lakhs is under risk. Who are the banks to do that, take that risk, is the RBI's question.
But the 50 lakhs comes into the bank, right? 50 lakhs comes into the bank, and again the outstanding becomes 1 crore, right?
If it comes back, but it does not in any way. What if the company uses it for some other purpose and does not even give back? There is no guarantee. Okay. And you are saying that it comes back, it is ultimately manipulation of account, right? They could have declared the other loan to be an NPA and given another loan, right? So in reporting, they are hiding the fact that there is NPA. When you hide an NPA, the regulators will not be able to take proper decisions. That was the problem. The banks were given the freedom to reconstruct a loan in SARFAESI Act, which means that the banks can give extra time, the banks can give extra loan. They are free to do all those things. But they were hiding certain features. They were hiding the NPA, which is wrong. That was the whole point. Your point is correct. Giving more time to them, giving them more support might help them recover. But there has to be a certain level of threat assessment or safety assessment, risk assessment. What if that business invest this money somewhere else instead of giving back? Once you give the money, there is no guarantee that it is their money, right? You put it in their account. If they happen to use it for the right purpose and repay, it is fine. What if they use half the money for some other purposes? So maybe only half the money comes back. It is not under the bank's control once you give a loan to them. It is under the business's control.
Yes.
So there is no guarantee of that even 50 lakhs coming back.
Okay, got it. So that's me.
Conceptually, what you said is right, though. I won't debate it at all. It might be beneficial for them.
Okay, thank you.
Okay. All right. Welcome. Jawahar, just 1 second. I'll take up your question. I'll just answer one more question that is there in the chat. Anu has asked me. Anu, is she still there? He or she. Okay. Anu, to answer your question, you want me to explain ECB once again. ECB, external commercial borrowing, is loan taken by an Indian firm from a foreign bank or a foreign firm from an Indian bank. Both of these are external commercial borrowings. Okay, that is the general definition for it. Now, in addition, why would an organization or a company take a loan from outside? Maybe they have a head office over there and it is easier for them to get the loan from there. Maybe they feel the interest rate is cheaper in the foreign bank. Any of these reasons, they may be taking a loan from abroad. Okay, that is external commercial borrowing. If you have further questions, raise your hand and I'll give you clarity on that. Jawahar, yes.
Hello, sir.
Hello. Yeah, Jawahar.
So, how does this appreciation of rupees actually increase the import?
What happens when you have appreciation of rupee, Jawahar? So when you have appreciation of rupee, $1 is equal to 100 rupees becomes $1 is equal to 50 rupees, right?
Yes, sir.
So earlier, to get a see, what do importers want? Importers want dollars because they have to make payment in dollars.
Yes, sir.
Okay, so importers are demanding dollars. Earlier, dollars were available for 100 rupees. So which means that importers out of their pocket, they'll have to pay 100 rupees to get a dollar. Now, if the dollars are available at 50 rupees, will they get $1 or will they get $2?
$2.
With the 100 rupees that they have, they'll get $2. With $2, they'll import two. Instead of importing one commodity, they'll import two commodities, whatever is available at $1. So that is leading to increase in imports, right? When the price of something goes down, the demand for it goes up, right?
Yes, sir. Yeah.
That is how it is leading to increase in imports.
Okay. Okay. And
there is some other point
yes.
unclear about, right? Open and ask that also.
Yes, sir. But does export is related with now with the rest of the world. But how does that increases our demanding capacity?
Demanding capacity of what?
Like, how does export decrease with appreciation of rupees?
Okay. Now, exporters were earlier, they were selling their commodity at $1. Okay. Initially, they were getting only 50 rupees per dollar. So they were selling at $1. They would come to the bank, they'll give the $1, they'll get 50 rupees. Now, because of depreciation of rupee, they sold their commodity at $1. They came back to the bank and they realized that they're getting 100 rupees now for no extra effort. So they think if I am selling one, I am getting 100 rupees. If I sell two, I'll get 200. If I sell five, I'll get 500. If I sell 10, I'll get 1,000. So they'll start producing more and more and more and more. So when they do that, the supply of dollar increases and the demand for rupee goes up, which means that Indian currency will appreciate. When the supply of dollar increases, okay, when the supply of dollar increases, Indian currency appreciates and the foreign currency depreciates.
Yeah.
That part is clear to you?
Yes, sir.
Now, when they go sell their commodity outside at $1, they once again come back, they'll find that for giving $1, they're only getting 50 rupees now. They increase their production so much, they increase their export so much because they were getting 100 rupees per dollar. Now, when they realize that they are getting only 50 rupees, they will go back to their old level of production, which means they'll reduce it and they'll start producing at the older level itself, because now export is not getting them any benefits.
Okay. Oh, yeah. Okay, sir. Yeah. And one more thing, does this relate to inflation anyway, by any chance?
It could relate to inflation. If your imports, if there is excessive depreciation,
yeah,
and you still have to import, let's say, certain commodities you have to import, right? Like oil and all those, you compulsorily have to import. There is no other option.
Yes, sir.
Okay. So when you import at high prices, when depreciation is happening, you are importing it at $1, but $1 is costing a lot of money. So an Indian importer who's importing at $1 is paying, let's say, 100 rupees per dollar. So the price of oil has doubled. When the price of oil doubles, the cost of production domestically increases, the cost of transportation increases. It could lead to inflation. Depreciation could lead to inflation.
Okay, sir. Yeah. Thank you, sir.
Okay. Welcome. Any other question, guys? Okay, there is one question. Shivapriya, prohibition of double loans is something like prohibition of double jeopardy in polity. Am I right, sir? Can we mention in paper? See, there is no prohibition as such on double loans. Double loans for the same purpose doesn't serve the purpose, but sometimes the bank does give. I don't know if there is a prohibition. It is not the same as double jeopardy though. Double jeopardy is a completely whole different level of seriousness. Being punished for the same crime twice, that is different. But yeah, you can say double loans is you are doubling the risk. Already the first loan is at risk. The second loan will also be at risk. You can mention that though. Okay. Is there any other question that I have not answered? If you want me to answer, please let me know. Otherwise, there's only 6 people left: Gobi, Jawahar, Gunal, Anu, Shivapriya, and one more person without name. If you have any questions, please ask me, or else you can disconnect and leave. I don't see any further questions coming up. Thank you so much, Shivapriya. See you tomorrow. Thanks, guys.